stocks I couldn't do, but there's certain stocks I excel at. Some people are like, oh, I can't touch penny stocks. I get killed. And so it's not for them. So you have to basically go back to your trades and examine which ones you win and which ones you lose. And I was like, dude, I kept losing it when I'm trading like Amazon. So that just cut it off altogether. I don't even need to bring up the symbol. So basically review your trade. It's very simple. You know, if you go to the casino and you make all your money playing blackjack and you lose all your money playing roulette, stop playing roulette, dude. Unless it's for fun, right?
Exactly.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
It sounds like once you went full-time, a lot of it sounds like you almost had it too smooth in some ways. Like you were making money pretty much every day.
That was the negative. So let me tell you the negative and the positive of that.
Yeah, well, that's what I want to get to is like, what challenges did you have? Like, what were some of those greatest challenges you encountered?
You remember when I said when you're too complacent, shit goes to hell and all that? So it was very predictable for me to make my little small money. Because I never took a chance. I was like, why rock the boat? I'm happy doing what I'm doing. You know, it's working. But the things I realized, you know what, man? Things like this don't last forever. You know, you find a little niche and you take advantage of it. Like you milk the cow. Eventually, the cow's gonna die. So what you need to do is milk the cow for as much milk as it can before the cow dies. And so my problem, I thought, oh, the cow's going to live forever. So I kept on milking a little bit. And then, towards the end, I realized, oh, shit, man. I'm making money every single day, trading super tiny size relatively, right? So once I started upping my size, then it's like, oh, crap, the same strategy did work. But by then, everybody else caught on. Everyone started trading it. And then the Wolf of Wall Street movie came out. And the SEC started banning all these stocks, halting all these stocks that saying it's a scam. Then they started, then the market makers saw that I was making too much money and they were losing money from me because I would like kill them in a trade and then they would shut me down. So then at the end of my career, what happened was this. I got shut down from most of the routes. They wouldn't let me trade anymore. And the SEC shut down pretty much all of those kind of plays. Those bulletin boards started to come back now, but for a good 2 years, from like 2 to 3 years, it was dead, man. They shut everything. Wolf of Wall Street made it very popular, that movie. So they thought everything was a scam, and so they shut everything down.
What do you mean by the market makers shut you down and banned you from routing to certain venues? What's that about?
So when you trade these bulletin board stocks, these penny stocks, you have to route it to, let's say, at night capital markets or a Schwab or something. So it's not like how it is in NASDAQ. NASDAQ, you have an ECN, which is an electronic system. Over there, you have to route it to a market maker, like NITE, NITE. And so there's no way to go around them. If you want to fill the stock, you have to route to them. And when they really, at the end of the month, they realize their P&L is down, and they're like, who the hell is banging me for this? And so I got shut down. And so, which leads me to this, the biggest trade of my life, which I guess a lot of people like, I guess my claim to fame. I don't know what the word, but this was not what I think is my claim to fame. But so it was Fannie Mae, FNMA. That one day I made 1.5 million in like 4 hours. So after that, the market makers shut me down. I killed Citadel. I raped all their. So basically, in order to get this, I had to basically play against them. So they would show huge sizes, like hundreds of thousands of shares. I would just sweep them all. And they're like, so now they're dead. So basically, so my whole career culminated to this one day, May 29, 2013, where I decimated the market makers. And the very next day, all the algos disappeared from that stock. And then I got banned. They shut my accounts down. And so that was the beginning of pretty much the end of the penny stock era.
How did you know you were banned? Did they just actually close your account, or did they send you a letter? Like, what happened?
They called my broker and they said, you better shut him down before we shut the entire firm down.
And are there any legal, like how does that stack up legally?
See, that's what screwed up, man. This whole, you cannot fight a $1 billion company. If they want to shut you down, they shut you down. What are you going to do? They claim that they reserve the right to do business with anybody they want. And so they say they don't have to even give you a reason why. They never gave me a reason why. They just shut me down.
Right.
So one day I woke up and every single broker said, they shut you down, dude.
So you obviously got to keep your profits.
Oh, yeah. I just was not allowed to trade anymore. And so that led to another thing. So I never thought this stuff would end. And so I really never thought about what would happen if this thing was over. And so the biggest day of my life, my career-wise, should have been the happiest day. But in essence, I look back, and I already told my friend. I told Nate, he runs Investors Live. He told me, dude, this is the worst day of your life. I go, I know, man. I go, you would never hit this high ever again. And so after that day, the whole thing unraveled. And then and I had to find a new niche to trade. So imagine, I've been doing this since I started trading. This niche, right? And now it's like the niche has been taken away from me. They shut the whole thing down, right? So then I had to transition to now NASDAQ stuff. And so that's but let's go back to people think this was my biggest achievement. I don't think so. My biggest achievement, in my opinion, is being consistent all those years. It's not even talking about the money. I could care less about how much money it was. It was just basically being able to every day perfect a system where, dude, man, it's like a 90% success rate. I'll give you an example. My best year, I only had 8 days, something like that, 7 to 10 days out of 330 days of trading. Only 7 to 10 days where I actually had a loss. I was like 320 wins, 10 losses days. I mean, so that to me is like proves that it is not gambling if you are disciplined enough and stick to your game plan. So I had that niche mastered. Oh yeah, and then that day they took it away. So.
Okay, so a couple things. 90% success rate. When you say a 90% success rate, you're talking about like your P&L at the end of the day, right? Not your actual strategy. Like not every trade you put on.
Yeah. So I mean, I hate talking about success rate, win rate, but I track it like how many days. Yeah, you're right. It's not. Yeah, I mean, I made tons of trades. I made like 500 trades a day. I made like 1 million trades during that time. So, but at the end of the day, as long as your P&L is up.
So when you made $1.5 million in a single trading day, what did that feel like before you got shut down, before you realized you'd been shut down? What did it feel like that night?
So this is how you get to that point. I didn't even freaking know I was up that much. So I was so into the trade, I didn't even look at the P&L. And then when I turned over and I looked at P&L, I almost shit myself. and when I looked at it, that's when I started to bail. Maybe I would have made more if I didn't look at it. So the thing is, like, when you get into your groove, it's not, for me, like I told people, don't believe it. It's not the money, man. If you're passionate about what you're doing, I care less, If you're passionate and you're good about it, the money will come. Don't think about the money. Think about mastering your process, your niche, your work, your passion. You master your passion, and then the rewards will come. For me, trading I never thought I was going to make money. What the hell I need money? I mean, I'm a very simple guy. If you look at me, I don't, this was just my going back to the kid. Remember when he said, one day I'm going to be your boss and say, screw you. All you bullies are going to regret bullying us. So my whole lesson was kind of like, you know what, man, I was trying to prove to the world I had a chip on my shoulder, and then that's what led me to always try to be the best at what I did.
Yeah. Now you talk about like needing to really love doing what you're doing and have a actual passion for the market. I mean, why do you feel as though you have a passion for trading? Like, what gets you excited about trading if it's not just for the money?
In the beginning, it was gambling, and gambling for Asians is very exciting. Things in our blood, dude. For an Asian tradition is this, dude. Asian New Year comes, the whole family gambles. The first thing you do is you gamble. When you wake up, that's what you do on Chinese New Year. It's to gamble. That's the funniest shit. So gambling is part of our whole culture. But I was never a big gambler. I mean, this is how so when I was making a shitload of money, I would go to the casino and I would never bet more than $25 or $100 on a single blackjack hand. I mean, this is how I am. I was like, why would I gamble when I trade for a living? It's stupid It's stupid to be the chump at the table versus being the house when you trade, So that was so that kept me out a lot of trouble when cause my mentality was never like to gamble blindly, but the excitement of trading is just it's the same thing as when people gamble, but the difference is this is a calculated gambling. I could bet anytime I want, not when I'm betting a big hand of blackjack and shit. I have 16. What the hell am I going to do? There's absolutely no control.
Yeah, I think a lot of people who are on the outside of trading have a hard time getting their head around that kind of concept, that a lot of traders actually don't enjoy going to the casino and gambling, you know what I mean? Because they feel as though they genuinely don't have an edge unless they have a strategy down pat, you know what I mean?
Dude, I to this day, I go to Vegas, I don't even gamble. It just freaks me out, dude. I hate that.
Yeah, I went to Vegas like for the first time, I think like 2 years ago, and I think I spent about $50 gambling the whole like 5 nights I was there. And I don't know if that makes me really strange, but I didn't see the point in it.
Did it make you scared? For me, it scares the shit out of me, man. It's just because I'm a control freak, man. It's not the money; it's just the fact that I'm so stupid. It's like this dude just took my money and I have no choice but to give it to him.
Yeah. You're like, oh man, I could have spent that on so many better things.
Yeah. So
maybe walk us through what happened after you got shut down. I mean, you had to kind of reinvent yourself in some ways. How did you go about that?
So life is full of adversity. So that's the whole theme of this interview. I'm trying to stress. You know what, man? If I can do it, anybody can do it. It has nothing to do with being anything except like, you know what, man? Have trust in yourself. Have a plan. Not be a good person. Don't cheat, don't steal, don't do any of that shit. Just work your ass off. People beat you up like they did me. It's okay. You are always going to have adversity, regardless of how rich or powerful or experienced you are. So now, once again, I thought I had the whole world in my hand. I mastered this niche. I'm like, damn, I'm going to be filthy rich. This is, like my biggest year would be like 3.3 million. That's crazy doing this shit, right? So that's sort of shit. So I was like doing like 7 figures for a long, So it got to the grand scale where, dude, man, if I could do 3 million a year for fucking 10 years, I'm fucking filthy rich, right? Boom, SEC comes, shut the whole industry down. So now I'm like, holy crap, I've just reached the pinnacle of my career, and they just took everything away from me. So now I have to start over as a newbie. So now I have to reinvent myself, figure out a new niche. So now I started trading NASDAQ stuff. And it's a whole different ballgame, man. I was like, fuck. I used to be the Goldman Sachs of the bulletin board. I'd never lost big trades. Boom. When I started over there, I started taking freaking $100,000 losses. I've never taken that much loss before. My biggest loss trading penny stocks was $300,000. But that was because I was up $3 million that year, so I didn't give a fuck. But which is stupid, but But besides that, I'd never taken these crazy losses like $100,000. My biggest loss would be like $25,000, $50,000. I mean, and compared to how much I was making, that was like nothing, I have months where I was making like $1 million in a month, But anyway, so when I switched over, now I'm like a newbie, dude. Every niche, every different thing you do, you're no longer the master of it. It's like, yeah, I understand the basics of it, but shit, man, in order to know it inside and out and to be able to make money on a consistent basis, you can't just be a jack of all trades, right? You got to be like, you got to pick something, a discipline, and do it. So I sent you that spreadsheet where it shows like this loss on Lake, LAKA, for $126,000. I mean, so when I switched over, those are the type of losses I was seeing. So now it humbled me hella fast. It was like, I was like, oh shit, what the hell am I going to do? I'm not fucking good like I thought I was. I came over and I thought, hey, I'm going to freaking be the best NASDAQ trader in the world too. Nope. Rude awakening. So I had to pretty much humble myself, start over, take money out of the accounts, and just make sure I don't fucking blow up. Start with very small positions. And so this is the same thing. You have to build your experience and your confidence. So my confidence was whacked down to nothing. Remember, I came from like a $3 million year to like making like nothing. Just starting over, you know? And which is, in essence, is good. Making nothing is better than losing $3 million. You see what I'm saying? So a lot of people like, this is easy. I can switch and do something. I used to be the king of this. I'm going to be king of that. No, dude. You see what I'm saying? You have to be able to humble yourself and say, you know what, man, I am now an amateur once again. I'm a student.
So how did you move on from that point? Like you said, you came over to NASDAQ stocks. You started taking these really big hits, like $100,000 plus losses. I mean, what was the cause for that? Were you too cocky? Did you just think your same strategy was going to work in a different market that moves in different ways? What was the root of that?
Because back in the bulletin board days, there was not enough liquidity to get into $1 million of a stock. So to lose like $126,000, I was in like $1 million of that stock. You see what I'm saying? And so basically it's just like, holy crap, I threw the kitchen sink at it and that thing won't budge.
So how did you go about finding a new way of trading? Like what did you do? Like, because you said, you're now essentially an amateur all over again. How did you develop a new strategy to profit in this new market?
So, you know what? In my opinion, I am still learning. I never wanted to teach when I was trading bulletin boards, just like I don't want to ever teach now, because I never think I'm a master. I think the moment you think you're a master is when you get dinged, dude. To me, people go, teach me. I'm like, dude, I'm still learning. Same thing was when I was making millions a year. I was like, I'm still learning, dude. And so the caveat is I would always be a student. I would be a student for life. But what I'm doing now is I'm starting over. So now I'm thinking, how did I become so good at trading the penny stocks? So I'm trying to get back into that mindset where, I start back doing smaller trades and figure out, trying to find my niche within this new market. Because still, when you say, how did I find my niche? I think I found my niche, but who knows? It's still too soon. The only way I'll know is in another 10 years when I look back, right? Because when you're in it, you really don't know. And so I'm always trying to learn, in my opinion. That's the best way to do it. He's like, you stay on your toes and you always try to learn. So I examine what I'm doing wrong. So now I cut off a lot of stuff. I used to trade a lot of ETFs, and I got burned on a lot of stuff. So now I cut them all off. So it's the same process as before. You find out what the only way to know is to do it. And unfortunately, it's a cost of tuition. I lose these dollars. And you can either think of it as two ways. Think of it as, I got unlucky and I lost $100,000. Or for me, it's more like, dude, that was $100,000 lesson. That was tuition. And I better make damn sure that I got my money's worth from that education, right?
Yeah. It's an expensive price to pay. So how do you... I think what might be cool if we could talk about is maybe sort of the psychology and a bit more about the mental aspect of trading. Like, how do you have the confidence to pull the trigger after a bad trade like that?
Yeah, that's the biggest thing. When you're making money, your confidence is off the charts. And you know how it is. When you're confident, you can do no wrong. And then boom, sometimes you get overconfident. There has to be a balance. So when I'm on a crazy streak, I start to get cocky and I go, and I think I could do no wrong. And then that's what happened. So in my opinion, the biggest hurdle for any trader, any experienced trader, is you can make money, let's say 100 days in a row. It's that one loss can wipe out your entire year. You see what I'm saying? It doesn't matter how much you made before. It's how to control that one loss. And so that was what I mastered before. I mastered before how to immediately just take the loss and not have it affect me. And so, but when you're a novice, once again, every loss you use is kind of like a personal loss. Like, damn, I suck. You see what I'm saying? Sometimes you take it too personal. So you gotta be almost like a robot to like. So I call you have to be like I call trading like a reflex. And this is how algorithms and algos they're robotic, dude. Sometimes you have to be robotic. It has to be like a reflex for you to like, oh, I see the situation. Either I go in or I go out. You don't hesitate. You don't think. You don't. Every time you doubt yourself is when you get screwed up. And so that loss I did, I was like, oh man, I don't want that loss. I could have easily taken like $5,000 or $10,000 loss, which is a lot, but it's better than $130,000. And after a while, you're like, so before that would never happen. But when I started new, I was like cocky. I was like, dude, that's embarrassing. I don't want to take that loss. or like maybe it's tricking me. It must be tricking me. If I take the loss, it's gonna go my way. Nope. So you make all these excuses in your head. And so what happens is, dude, I wasn't ready for that kind of size to trade. So you have to build yourself up, first of all. It's like everybody wants to get to that next level. Getting to that next level doesn't just mean increasing your size, dude. You need to be able to have enough bankroll to be experienced enough to be able to take the hit, things like that, right? And so a lot of traders want to go quickly. And so my advice to them is, dude, your bankroll is huge. So in order to get to the next size, you better make sure your bankroll can support that. And then when you lose, like, okay, I'll go back to your question, like, it's the confidence. So what I usually do, which helps me, because I've taken a lot of these losses when I switched over. I've never had so many losses in my entire life of this size when I switched over. I mean, they're like 6-figure losses, like boom, boom, boom. And I don't know how the hell I didn't lose all my money, but I would make it back. But it's like, but the thing is like, it just kind of like every loss you make, the confidence level is just multiples higher, like exponential, right? It's not just $100,000 you lose. It's $100,000 to like the factor of 10, how stupid you are, and oh my god, like what am I gonna do now? I lost my money, stuff like that. So how you rebound? Well, you have to start from basics. So I rebound every time I do that. I would rebound by making one trade at a time. Make $1,000 trade. Make $2,000. You see what I'm saying? So have a couple days of green in a row. So I get back to my old routine. A few days of green in a row, then you start to forget, and you're like, oh no, now you become more confident. Then you can increase your size once again. So it's always getting back to basics. After a big loss, always get back to basics. And after a big win, you better be disciplined enough to also get back to basics. Instead of saying, oh, I have a big win. So the problem with winning, to me, is this. It's very dangerous. I know a lot of people who have a good streak and then they just blow up. It's because they always think, I had a good streak. Oh my God, imagine I put in twice as much money. My streak would have been even more huge, right? So now their next trade, they're like, dude, I'm going to double up the next trade because I was right the last 100 times I did this. And then boom, you're dead. So it's all part of the discipline, right?
Yeah. I'm glad you brought that up because I did want to ask you about like the other end of the spectrum about how you handle, large winners and, when you do get on a good run, how you like don't get ahead of yourself in some ways. So, because I think that's equally as important, right? Yeah,
that's exactly what I said. You got to make sure, because when you get on a streak, like I said, man, the one thing is you become cocky. You're like, shit, I should have put more money in that trade. I knew it would go up. Why didn't I put more money? So what I'm going to do in the next trade, I'm going to do a makeup trade. That's the makeup trade that kills you. I'm going to make up for the fact that I was a pussy and I didn't put more money in that last trade that I won. So now I put double the money in. And you know what happens, right? It always goes down. So Yeah. So I call it the makeup trade, which is equivalent to the revenge trade. So when you're down, you want to double up so that you can make back your money quicker, right? So that's the revenge trade when you're down. So when you're winning, you do the makeup trade because you're like making up for the fact that you're too chicken to put more money in. But a lot of times I tell people this, dude, it's not trading smaller size can actually make you more money because you can hold it longer. You can be more clear-minded and not be freaked out. Because if you're scared, it means you went in too big. You know, it's like if you get shaken out, it means you went too big. So you have to find the right balance of size. Because a lot of times, like if you were smaller, you wouldn't have been shaken out. Because you're like, okay, I'm still with my plan. I'm not gonna go broke. But if you size it way too big, any little deviation in your in your price, you're gonna get shaken out.
Yeah. So I mean, here we've kind of talked about how to get the confidence after a losing streak and how to keep a level head when you've got a streak of winners as well. What about when you realize that you're just not trading as well as you normally would? You're not trading at your best. You're just sort of maybe out of sync with the market a little bit. Like you just can't get a good gauge on what's going on and you're just not really getting anywhere. How do you deal with that?
Yeah, I mean, I've gone through slumps a lot of times. The only thing you do is scale back your size and stop thinking about how stupid or an idiot or like when I trade, I don't think about anything. I just think about trading. It becomes like a reflex for me. The moment I start thinking about money, how I gotta pay bills, or oh crap, what that loss could have paid, I start doubting myself. When you start second guessing yourself like that, is when you're just doomed, dude. Maybe you should just not even trade that day. You see what I'm saying? Yeah. In order to trade comfortably, you have to get your personal life in order. You know, so that's the key thing that listeners should understand too. It's like when your personal life is shit, your trading is gonna be shit.
And when you say personal life, like what sort of things are you talking about? Like your relationship, your job, like
exactly, all that stuff. It's like you're fighting with your freaking spouse, your girlfriend, and then you go back and you're pissed off and you trading. It's gonna affect your trade, right? Or when even if like you don't have money. If you don't have money to pay the bill, stop fucking trading. Get your life in order before you trade. Because if you have no money, it's like entering a poker table and you're the shortest stack. You're gonna freaking lose. Those sharks are gonna kill you, right? So sometimes it's best to like save up and like come to the battlefield with a gun. It's a minimum of a gun instead of a freaking knife. Some of these guys they try so hard to trade. And they're like, oh, I got $400. What the hell is $400? The commission is like $20 already. You're dead. You see what I'm saying? But it's okay if you understand that that's a tuition you paid to learn. A lot of these guys like, I have $1,000, pal. Let's make me rich. I'm going to turn $1,000 into $1 million. Bullshit. That $1,000 is basically your tuition money, dude. You have to understand that he's going to be learning, right? Don't fall for these furus. I coined this term a long time ago. So you hear that around the internet? That's me. I coined it. Furu. F-U-R-U. It's basically a fake guru. So you see all these guys selling shit and selling services. I'm the guru. I'm selling you all this crap. And they're like, oh, I turn $1,000 into two. I'm like, dude, I don't know how real or unreal it is, but that's not realistic. That one guy may be able to do it, but you ain't going to be able to do it. You know?
That's funny. I was waiting for you to bring that up.
Yeah. And so, I mean, it's a basically simple rule of thumb, dude. If you have the secret formula to make gold, why the hell am I going to sell it to you for $100 a month? I had the formula back then for bullion port. I had the formula to make gold. I knew the formula. I would never sell it for any price. You see what I'm saying? So it's like, don't be conned by these guys. It's like they can't trade, therefore they sell you this crap. And so so I want to say one thing. I tweeted something right before this thing. Because they're asking like, oh, who are these life coaches? Oh, this guy's a life coach. He teaches people to be successful. I go on his page and he talks about how I used to be broke. Now I'm successful. So I tweeted, I said, reminder to myself, if I ever become broke, I will sell a course on how to become successful and rich. That's pretty much what they do. It's like, I'm poor, so I'm going to sell. So I tell these students, like, don't fall for that stuff, man. So I created a site called the Trading Fish. It's M Rock Rules on Twitter, and pretty much I have like tons of tweets, and it was my way to give back on teaching people the basics of trading and how to be there. So M Rock Rules. So basically people say what maybe one day I'll do a course, but I'd rather do it for free for now. If I ever win the lottery, I would definitely do it for free for everybody.
For sure. And that's I definitely suggest anyone listening to this podcast right now to actually follow, what is it? At MRock Rules, and the rules is with a Z, right?
Yes, with a Z. But it's on my page. It's on my all the information is on my Twitter page, moderate_rock. So I have that part.
Yeah, a lot of good info. Now, just while we're still talking about psychology here, I know a big issue for a lot of traders is FOMO, fear of missing out. How do you suggest others try and combat this fear of missing out?
Don't worry, I still have that same exact problem. You never have the same problem. The fear of missing out. It stems from greed and envy. Because I'm like, oh shit, man, I don't want to miss out because my friend's gonna make hella money. And then you just look at your friend. You see what I'm saying? So all these questions are all personality questions. So like I tell people, trading, only a small part of trading is mechanics. I can teach anybody the mechanics of clicking the buy button, the sell button. But the problem you have later on is the mental aspect. When people blow up, it's never because they don't know how to trade. It's because they broke a rule. They know they should not be adding to losers to infinity. They know that they just got to take the loss, or they know that they shouldn't be entering something early because of FOMO. So it's a lapse in discipline, and so it's a mental thing. So when people ask these questions, the only person that can answer is yourself. It's like, why are you entering it early? Because of what reason? So for me, I have a lot of problem where. So for me, an example would be like, oh man, it just sucks if I hear my friend or whoever make all this money and I didn't make it. And I like, damn it, man, I must suck. There's two ways I can look at it. Like, damn, I'm an idiot. Or, I'm smarter than this guy. How the hell he make more money than me? And so that's where all these problems come in. So then the next trade, I'm going to double up on my size. And then, boom, you get hit. Or, I'm going to make sure I don't miss this trade. And then that's the fear of missing out. And you enter early and get crushed. So, see, it's all psychology. So, shut everything out. So sometimes it's better not to fucking even go on to Twitter, to go online. Don't talk to your friends. Just concentrate on yourself. Don't need to ask people how much they make, because that's only going to affect your brain too. Be happy with making what you're making. So imagine you're happy making $100 a day. You hear your friends making $500 a day. That's going to really screw your brain up, and it'll throw your game off too, And so a lot of times it's like, dude, man, turn everything off. Just focus on yourself. And back when I started, it was really helpful because they didn't have Twitter, didn't have anything like this. And so I think that was another reason why I was successful. I was just basically in my own element, in my own zone, and not have to worry about how much people are making or competing or talking crap about you. You see what I'm saying?
Were there any other traders who you did speak with frequently, though, when you were coming up as a trader?
So I had a really good system. So I needed to teach someone a system. So I don't want to really throw his name out or anything, but he did quite well. He made millions of dollars. So my system did work.
What do you mean by he made a system or you made a system?
Well, I had a very good system of I figured out a certain pattern, after a while. So that's how I made money every single day. So basically I became very good at that one niche, right? And so I needed someone to help me find those stocks. So there's a certain criteria of stocks, certain pattern to look for when you scan. So I've mastered. Back then I could look at a stock and tell you with like 85% certainty if it's going to go up or down, based upon like certain criteria. And so I showed someone how to do this, and so they found the stocks. So the more stocks you find, the more you can make, right? And so I used to be I would hold like 10 positions overnight. And each one would make me a bunch of money, and then it adds up, right? I don't need to make much. If you hold 10 positions overnight, each position makes $500. That's $5,000 just off the bat. 5,000 every single day, multiplied by 300 days. That's $1 million right there, right? Without having to trade.
Okay, so there was no one when you were still kind of learning the ropes on how to, find your way as a trader. There was no one who you were kind of who you could speak to and ask for help and that sort of thing?
I started so long ago. There were none of this stuff. So when I first started, there was this guy, Stock Gappers. And so it was in New York. He used to be my friend. And so he ran a chat room. So that's how I got into it. He was doing it. So I started doing it. And so I guess, we haven't really talked for a long time. But so that was the one person that started this whole thing. But he kind of disappeared. And but really, no. There was no Twitter back then. There's no nothing, dude. So it was I just did it myself. There's a lot of people that I helped, like Nate. I've known him since he was like 19. There's a bunch of people in his chat room. I was like the oldest guy though, so I started all this stuff a long time ago.
Sure. So I think what might be really beneficial for people who are listening to this podcast is if we can kind of, I guess, summarize some of what we've been talking about and kind of bring it all together and really drill down into the trader development side of things. So, if you had to start all over again, how would you do it? Like, with hindsight on your side, what steps would you take? Like, think about someone who might be listening to this podcast that's been keen on trading for 6 months, 12 months, 2 years, whatever. They're still in that, I guess, what you could classify as the beginner stage. Where do they go?
The number one thing you should study is charts. Go to like stockcharts.com or something. There's a bunch of like online reading how to read a chart stock, learning resistance, all that. To me, charting is the number one tool when you start out. If you know resistance and support and can draw a trend line, half of your problems are over. So that's number one. Number two is determining what stocks to trade. That's half of the easy part of trading there. It's like there's a bunch of different stocks you can trade. It's like, why choose one over the other? So learning what I can't really help. The only only through experience you can figure out like which stocks you should avoid, and like choppy stocks with no trend should avoid. I outline a lot of this stuff on my free tip Rock rules as well. But basically, so there's two things, right? You have to learn to chart, dude. Figure out. So you have to learn how to do a scan. There's a bunch of free scans online you can look. And so based upon that, you can look up the chart and see which stocks are smooth to trade and which one's just choppy and will fake you out. People worry too much about level 2 and all that stuff. It's like over time you'll figure it out. But charting is the most important thing. Learn and read a chart. Don't look at level 2 when you start out. For bulletin boards, level 2 is very important. For NASDAQ, it's not as important. Charting is more important. Together, you need both. But if you start out charting, and basically have some rules you print out, you don't break. Rules are very important when you start out. It helps you from blowing up. So I provide a lot of these rules on my free tip site too. And knowing the right broker to use, because it sucks now because now there's a pattern day trading rule. You have to have 25,000 a day trade. My suggestion is, if you don't have that, is to split up your money. I don't know how much money you have. Let's say you have $5,000. Instead of putting it into one account, you can put it into 2 accounts, and so you have twice as many trades a week, right? Another thing would be, until you get to over 25,000, it's very hard to make money, man, because the fees will just kill you. The moment you make over 25 or get 50,000 in your account, you can open up brokerages where the fees are pretty much free. Like I get rebated for ECNs. Like every time I put an order out for ARCA, I get rebated. So basically, if I get rebated, it's free. They pay me to trade. And then the commissions, so it offsets the commission. So basically, in theory, I can trade for free. Whereas if you have a small account, it'll just nickel and dime you, dude, to death. And then all the money you make is just going to be paying commission and stuff. But like I said, when starting out with that small account, you have to remember it's tuition. And so my suggestion, just like I did when I started out trading, I didn't jump in, dude. I worked my ass off. I went to get a job. I saved. So these guys that want to get started, nah, dude, you have to put in a lot of work before you even get to the point where you can open an account and be serious. So basically, get your life in order. If you don't have a savings, why the hell are you trading, dude? You can learn. Nothing wrong with learning. But get your life in order before you can do this. Like have some savings. You see what I'm saying? Stuff like that. So because that teaches you responsibility. Versus if you have nothing going for yourself in your life and all you have is this trading account, you're going to treat it as gambling because you have nothing to lose. YOLO. You see what I'm saying? And so my advice to everybody is like, dude, go to school. I worked and traded at the same time. I had a job. So you basically got to get your life in order because I guarantee you don't have your life in order, your trading is going to go down the tubes.
Now, I think this kind of leads on from that point, and I think this is something that a lot of traders maybe struggle to get their head around and think about, and there might be a bit of a disconnect in some ways as well. How would you categorize the major milestones or stages between being a new trader and the level someone like yourself is playing at? Like, someone who's made millions of dollars trading. What are the milestones to get to that level? Like, what are the different stages?
So that's a very good question. So the first milestone is to understand all the terminology of trading. What is a buy order? What is a sell order? We laugh at that, but when I figured it all out, I was like, oh, crap, that's a big milestone for me. Another milestone would be charting. Oh, I know I can see a resistance line and a support line. So that's a very good point. It's like education, any formal education, you need to have milestones and mini goals. Don't just say, I want to learn a trade. Well, that's like a million steps between there, right? And so put yourself milestones. Like today, I'm going to learn how to learn support graphs. What's a resistance line? You see that? So charting and all that terminology, and then learning my platform. So I'm an engineer, so whenever I get a new platform, I customize it, I tweak it. I know every single thing about it. And so that's another milestone. So comfortable I can do anything as a flash. Some people just, all I know is buy and sell. No, dude, you need to go and play around with every single button. Because that'll teach you like all the stuff about stocks. And the next milestone would be getting, if you're not a pattern day trader, get over pattern day trader. And for me, a good gauge is this. I created an Excel calendar where every day I would put in my P&L. And green is up, red is down. And so every day, make yourself accountable. Put it in. So your goal would be, I'm going to try to get through this week without a single lost day. You see what I'm saying? So that was how I started doing the green challenge streak I had. And so after that's why I was like, dude, I hated when I was down. So I made sure I would close at the end of the day up all the time. So just being conscious of that and gave myself a goal, I was like, oh my God, I had 5 days in a row of being green. That's a big accomplishment for some people, for a lot of people. So maybe that's something they can try to do. Because once they get consistency, that's the ultimate goal of a day trader. It's not how much money you make, dude. It's being consistent. If you're consistent, you are making money. It's not, my goal is to make $1 million. Nah, dude. Your goal is to be able to have 5 winning days in a row, and the next day you lose, you only lose a day or two of work, or not even a day or two. You see what I'm saying? It's not going to wipe out a year of your gains. So basically, the ultimate goal is to be consistent.
Yeah, I like how you highlight consistency as being something that's like just extremely important. What tips and pointers do you have for someone to try and gain that consistency? Like, is there any key ingredients to that?
Once again, it's your discipline and your rules. Print it out, stick it up somewhere. I bowl this all the time. I know I shouldn't be adding to a loser over and over, but and then so I implement a bunch of different things. One thing would be if you're up for a day, just eat the loss and not turn a winning day into a losing day. That could be one of your rules you can have. You see what I'm saying? And then just walk away before you lose it all. Another one could be max loss. Like if I have $5,000, $10,000 a day loss, don't trade anymore. So you have to. Everybody's different. You have to know your own. Like for me, I break all sorts of rules because I was able to get away with it in the past. Which is also the problem when I transitioned to a new niche. You see what I'm saying? That's why I blew up like that, right? So you have to have some sort of rules. So it's like if I taken my own advice, like I would have a hard stop at losing 20 grand. I wouldn't be losing $120,000 that one day. I would calm down, you know? And so you know yourself. And so you have to place upon yourself these disciplines.
Yeah. Now, this is a question I ask quite frequently, as listeners will be well aware of. And I do like to ask this question. So I'm really keen to hear how you answer it. Why do you believe most traders never succeed?
Because they treat it as gambling. There's a couple of things. One is they think it's gambling. YOLO. They have no plan, no system. The stock is up 100%. Why aren't you taking some off, dude? You see what I'm saying? YOLO. Another thing is lack of preparation, lack of... So there's this whole reason I told you about the backstory and all this stuff, because it's very important. You have to be a responsible person. First of all, you have to be real. You have to be respectful of money. If you treat this as gambling, you're not very respectful of your money, and you're gonna lose your money. Discipline. A lot of this, once again, comes from personality. See, it all is in your it's not mechanics. Not because you're stupid. You can be stupid and make a killing in this industry. It's whoever has the most discipline and can stick to their game plan is the one that's going to be successful.
No, that's really good. Well, let's start to wind things down here. Just a couple questions I'd like to ask you. I guess this one's kind of outside of trading. Is there anything you do outside of trading to, grow your wealth, or that you have interests in? Anything else you do? Like, do you do any longer term investing? Do you do real estate? What is there anything which you're involved in besides trading?
Yeah, that reminds me of something very important as a trader in general, and as also someone up and coming. Get a network of friends that are traders. Get some that are mentors that are above, and more importantly, get some that's on your level. So you can discuss how things are going. Have a trading partner. Have a trading buddy. I feel that is going to speed up your success, because if you have a buddy who's on your same level or whatever, both of you guys can work together to learn. Okay, but anyways, but yeah, outside of it, in my opinion, trading. Dude, man, trading is the hardest freaking industry in the world, because that's the only job I could work for a freaking entire day. And not only do I not make money, I have to give someone money. Even guys like McDonald's will make more money. Even sleeping in will make money a lot of times, right? And so when you have it, you got to save it. So real estate is the best place to put your money, in my opinion. Rent. I don't really want to talk about this stuff, but rental incomes would be like the best thing to do. Okay. But the more thing is save your money.
All right, Bao. Well, are there any final words of wisdom which you would like to leave us with? Is there anything you'd like to add or into what we've already discussed? Take the mic.
Slow and steady wins the race. Slow and steady. Consistency is the number one thing. Don't get ahead of yourself. Know yourself. Discipline is the main thing. Don't compare yourself with others. That's the worst thing you do. You can see someone with a nice car, and it's passion. You have to make sure you want this for the right reasons. My passion was never about doing this to be rich, get a nice car, stuff like that. If you're doing that, dude, there's so many other things you can do to make money like this without jeopardizing your fortune. Otherwise, you're gonna lose. So be passionate. Passion is the number one thing. And be passionate for the right reasons, okay? For me, it was helping my family. Things like that, not just having fancy cars. And I think if you do that, karma will reward yourself, and you work harder. You have a main driving reason. Because if your only passion is to have a nice car, and when things get tough, you're like, oh, screw it. I don't need that nice car. I'm cool with my Honda. You see what I'm saying? Versus I have to do this because my family's depending on me. You see what I'm saying? There's a big difference. You cannot quit when your family's depending on you, but you can quit when your Honda is just good enough for you.
I truly appreciate you coming on, man. This has been a lot of fun. Yeah, thank you very much.
Awesome, dude. Thanks, Aaron.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool.
Articles engaging schwab.com/.
You are listening to episode 101.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's happening, traders? Aaron Fifield here. You are listening to episode 101. Thanks, Emil, for tuning in. My guest this week is Siam Kidd from Norwich in the UK. He's a former Air Force pilot turned retail trader, but he's also much more. He's a serial entrepreneur, and he's also on a quest to improve the schooling system, which I can respect. I really enjoyed the conversation I had with Siam, as you can probably tell by the length of this episode. We got to chat about his shaky beginnings as a trader and his rock bottom moments, how he trades currency pairs with a technical driven approach with the goal of catching major trends when they occur. During the later half, I asked Siam about why he got into business, how he's found the ability to think big, which is something I think many people actually lack, and how he's gotten to a point where he now owns 15 businesses. Then we also talk about flaws in the schooling system, Siam's grand scheme, and what the future has in store for us. Now, there's a lot packed into this episode, but before we get into it, I have a very small favor that I'd like to ask from you, okay? I'm running a survey again, guys. So if you can spare just 2 minutes, please go to podsurvey.com/traders. Your answers will help Chat with Traders to win sponsors that are a great fit. And as you know, sponsors allow us to keep the lights on and continue producing free podcasts each and every week. It's a very short survey. It's totally anonymous. And even if you did the survey I ran earlier in the year, I'd be really grateful if you can participate once again. And in doing so, you'll have the chance to win a $100 Amazon gift card. So that link once more is podsurvey.com/traders. That's PODSURVEY. podsurvey.com/traders. Thanks so much, team. I appreciate the support. Now, please enjoy this episode. Here is my guest, Siam Kidd.
So I'm sat in the Tesla right now, and Chat with Traders is in Spotify, and like you get so Spotify is like woven within the Tesla sort of main screen, and I saw Chat with Traders come up because I've liked it on my Spotify account, and I was like, wow, you're on
That's so cool.
You're in my car.
Yeah, it's very cool that some cars are coming out with apps built into them now. Like I know there's a few cars here in Australia that have like a Stitcher app and obviously Spotify and podcast iTunes and that sort of thing.
It's cool.
So yeah, I think this medium's only going to get bigger, which is pretty exciting.
Definitely. Are there many Teslas in Australia at the moment, or?
I've seen like one in Brisbane. I've seen one, and I don't know how they got it. I think I might be wrong on this. There may be a Tesla dealership down in Melbourne. But yeah, I think that they are on their way to Australia. I know there was something a little while ago where a whole bunch of people were sort of putting down a deposit on them, but they haven't shipped, pre-ordering. But yeah, they haven't really arrived yet, but will be interesting to see when they do.
Yeah, they're going to take over the world over the next 5 years. I really think.
Why did you decide to get a Tesla?
I love tech. It was actually, sort of a half-hearted thing. I love Elon Musk. I really do. I genuinely, I really want to do a green energy type project as an equal partner with him at some point over the next sort of 10 years or so. But the speed, honestly, I just test drive one if you ever get the chance, as in the top line. And I've driven all sorts of racing cars and Ferraris and whatnot, but I've never in my life experienced acceleration like this. It's relentless. So this one is 0 to 60 in 2.8 seconds, and it's just nuts. I just can't. Yeah, the novelty hasn't worn off yet. So
That is very quick. Especially when you compare that to that's the speeds of Ferraris and Lamborghinis, isn't it?
Yeah, it's nuts, and it looks really modest. It looks like it's a family car at the end of the day. So
yeah. Do you like the idea of the car being electric though? I don't know how I feel about that, and it's strange because I'm not a hard out petrol head or anything like that, but it seems kind of a little bit bizarre.
Yeah, it is weird. I mean, I love the sound of a nice V8 or whatever, but it is freaky. I mean, it's really convenient because there's Tesla chargers all over the UK, so that's free, and it takes half an hour to charge up. And I charge up at home, so every time I leave home, I've got 250 miles of juice, So, it is convenient.
It's interesting to hear. I've never actually spoken with someone who owns one before, so very cool to hear. Okay, so I know you're sitting in your car there all propped up. Are you on any time constraints?
No time constraint. No.
Okay, cool. Well, I hope you're comfortable because there's a lot I want to ask you about. So when we were speaking the other day, you told me that when you were 25, I think you are around about 30 years old now.
Yeah. You
said when you were 25, you were stone broke. So let's just start right there. What was your situation?
Okay. So sort of rewind a tiny bit. So I think the year before, we in the Air Force, the station commander got all of the pilots in a room, and once a year they always had this sort of big pep talk. And he was talking, and he basically said, if you guys work hard, one day you'll be in my boots and you'll be, talking to your pilots, etc. And I sort of wondered, what is a station commander actually earning? And I quickly asked around, and within people sat next to me, and they're only earning about sort of 80 to 90,000 pounds per year. And I was like, wow, I have to work another 20 years to earn just that. And I wanted more something like 50 grand a month, etc. And it was that point I reread Rich Dad Poor Dad again properly, and realized, I've got to do something. I've got to get out. And that was literally around the same time as my trading started to get more consistent. I mean, by then I'd done 7 years of trading. And it was, like every new self-taught trader. I mean, the first 4 years, I was every horror story you've ever heard, that was me. And I thought I was getting a bit confident because I'd have, these streaks where 3 or 4 months in a row, I'd be on fire. And obviously, my trading psychology wasn't fully formed because I would feel like I was, Gordon Gekko. And so, yeah. And that, I call it Billy Big Ball syndrome. And yeah, it really flattered me because I left the Air Force. I was like, right, I'm going to leave the Air Force. I'm going to trade full time. And So fast forward to being stone broke, I left the Air Force with no safety net whatsoever. I only had 10 grand to my name, which all went into my trading account. And what I then made the worst trading mistake I think I've ever done. Basically, I didn't have a job. I just left the Air Force and I was like, right, I'm just going to trade full time. And I was going to pay my rent, my utilities, live my whole life, through my trading returns, because I was, coming off the back end of one of these Billy Big Ball moments. And I mean, for the next sort of 2, maybe 3 months, everything was great. I was turning that 10 grand account into sort of 2.5, 3 grand a month. And I'm cringing now just retelling the story, because it's just dreadful risk management. I was making 30% per month. And then lo and behold, either month 3 or month 4, I think I lost like 50%, and it was just ridiculous. And it was to the point where, I say I was flat broke. You're never going to starve to death in the UK, but I was setting up payment plans with energy providers because I couldn't pay the bills. We're shopping in like Lidl, which is like in the UK, that's our sort of cheapest store. And like the people around me know the cheese and mayo story. Or basically Ellie, my fiance at the time, came up with cheese in one hand and mayonnaise in the other and sort of shrugged. And basically we were struggling to decide whether to buy cheese or mayo because we couldn't afford both of them. And yeah, so we just had to buy more pasta and rice because that's dirt cheap and it grows. So yeah, that was sort of rock bottom. Yeah.
Full on. So what led to you getting into trading in the first place? Like, we're sort of talking around the time when you're about 25 years old at this point, but obviously you started trading a lot earlier, or like at a younger age. When did you start trading, and what led you into it?
So I was 18, and again, I feel quite embarrassed telling this story because I just joined the Air Force and I was going through officers training, and at the same time, I've always liked stuff. So I like cars and gadgets and stuff, and the Air Force wage really is quite poor. And I was thinking, right, how can I make money in my underwear in bed on my laptop? And 2 options came up, and one was online gambling, and the other one was trading. And I thought, well, trading is going to take too much time because that's, the pros are screwing up. What am I going to do? And so I got into online gambling, and being the idiot that I was, I looked at online roulette, and I thought, right, I've got it. I've hacked the system. And I now know, I think it's called the martingale system. Basically, I was doubling up every time I lost.
It's a recipe for disaster.
Yeah, exactly. I thought, what are the odds of me losing, 10, 15, 20 times in a row? And I quickly made about 3 grand's profit in like an evening. And I remember going to, so this was in the mess, and I went to like at dinner with all my other sort of Air Force mates. I was like, guys, I've got it. I just made 3 grand doing online roulette. And I've hacked it, and basically they're all asking how. And I was like, well, I start with 50p, and every time I lose, I double up. And by then, I think the most losses in a row was like 7 or 8. And I mean, yeah, I'm cringing now because like the numbers and the stats behind it is just silly. And what I didn't know was that there was a maximum cap to how many times you could do that. So all my friends went into my room after dinner, and there was about 8 people watching me, and I turned that 3 grand into 4.5 grand. And then I think like 15 reds came up in a row, and I lost everything.
In front of everyone?
In front of everyone. I was literally squeezing the mouse, and everyone sort of left very quietly as I was silently raging. And I made my first big financial error. So I was 18 and everyone left, and I did the typical trying to revenge gambling. And I was like, right, I'm going to get it all back. And I maxed out a Virgin credit card. So about 3 hours later, I lost 4.5 grand by maxing out my credit card.
Oh no.
And yeah, so I haven't gambled since. Literally that night was like my big dose of reality, and I haven't done since. And then, so I then moved on to trading, where I did considerably worse for the first 4 years. So
that's funny. So how did you go? Maybe walk us through your first year of trading. What was that like?
a disaster. I'm sounding like I'm a bit of an idiot. Well, I was, but I'm not now. But it was Alta Vista back then. I don't think Google was around, and I did a bit of Alta Vistaing. And after about a few hours of Google or research, I thought, right, I got this. And so I opened up some sort of I didn't bother with the dummy account because I didn't even know that they existed. So I opened up a $2,000 account, and I lost it within that first day. And that was my first experience of a margin call, and that wasn't very nice. And the thing is, with the Air Force, I managed to live off just 10% of my income. So literally 10% of the income paid for everything, because the Air Force sort of looks after you and they feed you and clothe you and whatnot. And the remaining 90%, I was literally just blowing on the markets. And every single month for the first year, I was blowing $2,000 a month on the markets. And so I think I lost about 50K in my first year. And I think through stubbornness, I just carried on doing that for the next 4 years. And I think all my mates thought I had a bit of a gambling problem, which I think in hindsight, I think I pretty much did. I was just obsessed with the 1 minute chart.
Yeah, that does sound like a bit of an issue, especially if you're losing $50,000 a year pretty consistently.
Exactly, it's pretty much all of my wages every year. And I mean, have you found that yourself? Like, from seeing like new traders, people do always slip down into the lower time frames, and I feel for beginners, that's really quite dangerous.
Yeah, we'll definitely get into that a bit more. I'm interested to hear, what did your fiance or your girlfriend at the time, I forget which it was, but what did she make of this? Obviously you weren't in a great financial situation, and most of your wage was supporting your trading habit.
Yeah, so I think she was hoping that this trading thing would be a bit of a fad. And she, obviously she said, why are you leaving the Air Force? Because it was everything I, dreamt up, aspired to achieve. And, but she was supportive when I did leave. And yeah, it's hard. She didn't approve, especially when I'd lost, turn a $10,000 account into 5, and then later on a $3,000 account. So that wasn't too good. But I don't know. I suppose she just trusted me that I'd sort of dig myself out of my own sort of shithole, so to speak.
You'd work it out.
Yeah, and in the end, I just had to. It was quite sobering because I had to just go and get any old job, and it was a massive reality check for me, because I went from having a really nice paid job to having a $16,000 a year admin role at some recruitment company. And it was just it was quite demoralizing, basically. And because of the lower income, I couldn't, my trading pretty much stopped.
So why did you decide to go into this admin role instead of going back into the Air Force? Did you just want a job that was just giving you enough money to get by that you didn't really have to care about too much? What was the idea?
Well, one, I couldn't rejoin the Air Force like that. Like, once you quit, the door is closed. And I literally, because I screwed everything up, I just needed some income because I couldn't pay any bills. So I literally went to, not the job center, but I think it was one of the online job boards, and I just applied, the standard, applied for 20 odd jobs, had 10 interviews, and all of them turned me down apart from this admin job. But yeah, so I was still trading. However, I was trading a $2,000 account, which is literally peanuts.
Very difficult.
And I was I had to go back to the drawing boards, basically.
Okay. So how long did it take you to become profitable?
I think it was really soon after that. I think after really screwing up, I went back to the drawing boards. And I think only 6 months after that huge screw up, I just started being sensible. I was being extremely picky. I finally got my head overnight. There was one morning I woke up and risk management finally clicked in my head, so to speak. So I think from year 7 onwards, I started I traded way less. I was going back to the daily charts only. I was placing probably one trade a fortnight, and I was just being really selective and making sure that the triple R was there. And I mean, I'd always paid lip service to triple R, but I made sure my triple R was 1 to 3 minimum, and preferably at least 1 to 8. So yeah, I mean, I was on a massive self-development sort of drive. I mean, I was reading, like, I was going through about 3 or 4 books a month through audio books and stuff. And I'd read, Market Wizards and like all of the standard books, so to speak. And Van Tharp was a huge help.
So, with the power of hindsight, looking back, you said it took you about 6 to 7 years to become profitable consistently.
Yeah.
How would you have shortened that amount of time?
I would, if I had someone who knew what they're doing, that would have been rather handy, someone to actually ask questions to. But all I was doing was just Googling and trying to basically trial and error and developing my own sort of BS detector, basically. And I fell into every pitfall you could ever make, from strategy hopping to buying black box type things to day trading to, scalping. And scalping is alluring because sometimes you can make, a hell of a lot very quickly, and then the next day, obviously the underlying thing here is that I had very poor risk management. I mean, there's no good or bad forms of trading as long as you have good risk management. However, my caveat to that is that if you're a new trader and you're like in your first year or two, I would highly recommend staying away from day trading.
I know you feel very strongly about this. Let's just get into it right now. Why do you say that? Why do you try to encourage new traders away from day trading?
Well, I've got this sort of mantra that boring trading is good trading. And my trading has always been really good when I'm bored out of my mind. And the thing is, with day trading, maybe it's because I've just been burned massively through just sheer stupidness. But when you're looking at the 1 hour charts and below, or let's say the 5-minute charts, because that's quite popular. You're sat there staring at your screens, and every 5 minutes you have that new candlestick, and you're constantly second guessing yourself. You're looking at the markets, you're staring at the P&L, and it sort of forces you to sort of make decisions, quicker than you really need to. And what a lot of people do, because like if you're looking, like everyone has done Investopedia or whatever, or gone on to Baby Pips and taught themselves the basics of trading, and everyone's aware of support and resistance and stuff like that. And the thing is, when you're looking at support and resistance on a 5-minute chart, like the ranges or all these levels, they're all very small. So you may look at something and go, oh cool, yeah, I'm gonna go long here and have like a put my stop loss below this level of support. And your stop may be, 10, 20, 50 pips. But when you look at the bigger picture, you'll see that where your stop loss is right in the middle of all of the chop. So I suppose the learning point there is that even if you are trading the lower time frames, you need a multi-time frame analysis. You need to always look at the big picture. I mean, don't get me wrong, I do day trade when I want a new toy or whatnot. But again, even when I'm doing that, I'm still not placing that many trades, and I'm super, super selective. So only taking trades, going with the trend and etc. And also, like, you have to understand that a lot of, I don't know what the stats are globally, but I know in the UK there's only 0.1% of the nation that actually trade. So at any point in time, there's about 100,000 traders in the UK trading, and I would hazard to guess at least 95% of them are losing hand over fist, because most of these traders are, retail traders that have done a course or they're teaching themselves, and the people that are winning are, the institutional investors, the prop traders, the banks, etc. And like all of the smart money, they know how retail traders think. They know that, you know, people are putting stop losses below support or above resistance, or they're looking for head and shoulders and putting entry orders, you know, below the neckline or whatnot. And so when you're looking at price action, you can really tell what the banks are doing. So are you familiar with stop runs?
Yeah, but just explain it for any of the listeners if they're not.
Okay, so a stop run is basically where, let's say you have a level of support and lots of people are going long, and no doubt there's lots of stop losses below that level of support. So what happens, I mean, if you go back to the basics, when someone goes long, there needs to be, you know, in order to be filled, there needs to be like an equal sized trade going short. And so if you're like a big institutional, like let's say you're a big bank and you've got hundreds of millions, if not billions of pounds or dollars to play with, if you want to have a big position to go long, you can't just go long willy-nilly. You need to find sellers. And one of the easiest ways to, you know, get sellers is effectively stopping people out, because when a stop loss is activated, that acts as or that sell side for you there, and so they can get filled. And if you look at a lot of sort of key reversals and whatnot, you'll always see some sort of spike into that level of support or resistance in order, you know, to stop everyone out or to activate other entry orders, so to speak. Yeah, I mean, like the moment a lot of people listening to this can probably relate to this. Like when I was like inexperienced, it felt like the whole world was watching me every time I placed a trade. And the moment I went long, it's like everyone, oh, he's gone long, let's all go short. And like there are times where I just place a trade and the market just bugger off in the wrong direction, like instantly. Okay,
and you mentioned a little earlier that another challenge you had when you were coming up was strategy hopping, and I think this is something that a lot of traders coming up also struggle with. You know, you're definitely not the only one who struggled with that. What exactly is strategy hopping? Like, how can you kind of identify when you are doing it, and why is it such an issue?
Okay, so I suppose there's two ways when you can approach this. So if you're a typical punter, and I know you've gone on some forum and you found some sort of guru saying, oh, you need to do this system or this, you know, moving average crossover type system, and then you go along, you trade it, whether it's on a live or dummy account, and let's say it works for a bit, and you'll go, oh wow, I've found, you know, a really cool system here. So you then do this system, and then after a while you start losing, and because you don't really know much or have, you know, much trading psychology or, you know, risk management at all, you think, oh, well, this was a waste of time. It must have been fluke. And so what you then do is you go back to, you know, the forums and the, you know, or books and whatnot, and you try and scour the internet for other systems. And that's an endless rat race type cycle, which I found myself in for, you know, a good number of years. And anyone that's, you know, listening to this, if you're in that sort of cycle, please be aware of it. Now, so that's the bad way to go about it. Now, obviously, if you're starting out and you don't have a system, well, obviously you need to find a system. You need to find, you know, that sliver of an edge on the market. So if you're aware of, you know, I mean, obviously you need to test things. You can do some Monte Carlo testing and whatnot. I mean, there's only so much back testing can do, because, I mean, there's a certain amount of curve fitting that you can do when you're trying to test out a new strategy using past data. But yeah, I mean, please, by all means, you know, test out new strategies, you know, but be aware that not every strategy is going to work all of the time. And this is why I've sort of, I think, slowly migrated to swing trading and, you know, technical trend trading, basically. I mean, this is just a matter of opinion, but I personally believe that trend trading works simply because it doesn't work all of the time. I mean, as I was saying, I think the other day to you, that when you look at the markets only trend 15% of the time. The other, all the other times they're either ranging or chopping or, just being horrible looking, so to speak. But when they do start to trend, they then have a higher propensity to carry on trending. And trends do trend a lot longer than people think. And so if you can get on these sort of these trends, I mean, there's a lot of potential profits to be made. And like the way I look at things is that if you look at any, so I'm predominantly a currency trader, so majors and minors. And when you look at any sort of individual currency pair, more often than not, each pair will trend at least 1,000 pips, probably once, maybe twice a year. I mean, some more than others, because like pound Aussie will have far bigger trends than say euro dollar, but it's the way that they're sort of geared. But and I now look at basically 20 different pairs that I have on my sort of radar. And it's just a numbers game for me. So I know that roughly 20 different pairs will trend in at least 1,000 pips, at least twice a year. So that's 40 different opportunities to try and jump onto. And really, I only need one, maybe 2,000 pip plus winners for me to have a good year. So I'm just playing a numbers game. And I mean, you've looked at my track record or, my reports, and you'll see that I'm flat most of the time, if not negative, because all I'm doing is I'm trying to get in these runners, and I get stopped out a lot, so I may have 3 or 4 like losing or flat months, and then I have a big win. So I just make sure I have only 3 outcomes: small wins, small losses, and huge wins.
Yeah. No, I did see that, and I thought that was interesting. I've actually got a couple questions that I want to ask you around that, but before we do, you're talking about these big trends that happen in some currency pairs. How do you define a trend?
Okay, well, I mean, if you're trying to jump on a trend after it's formed, you're far too late, because normally the market's already moved like 200, 300, 400 odd pips. So you need to try and get in at the beginning. So what I tend to do, I mean, I try and so I'm a swing trader. I try and sort of get on the reversal. So this is a lot why I get stopped out quite a lot, because sometimes I effectively jump in front of that steam train, so to speak. But I do also manage to get in near the bottom or near the top of some reversals. So one of the key things I do when doing sort of support and resistance trading is that, like, if you're looking at a any odd market, a currency pair or an index or whatnot, and you see a huge level of support. Let's say the market is coming down nicely, and you've seen, let's take the FTSE. Let's say it's it's bounced, it's hit the 6,500 level, and it's bounced off. So all of a sudden you're thinking, okay, that's a key psychological level of support. It's a 00 number, and it's bounced off. And let's say it rallies a bit, and then it comes back, and over time it starts migrating down a bit, and it's now approaching the 6,500 level again. Now, in terms of support and resistance, what I've found is that level of support is its most strongest that second time round. So first of all, it's hit that level once, and the second time it hits that 6,500 level, I believe, is the strongest part. So what I would then do is put an entry buy order at literally on the 6,500 level, in anticipation that it hits that level again and then sort of bounces off, back north. And obviously I then have, support, stop losses and whatnot, below the 6,500 level, but I will also scale in. So I may put an entry buy order on the 6,500. I'll probably put another entry buy order on the 6,450, and also I'd scale up as well. So if it does overshoot and punch through the 6,500, which it will do, but then retraces, and let's say the market it can't close below it, so to speak. That's how I can get on the reversal. So I'm in the trade, and if it then starts going up, and 200-300 odd pips later, it's starting to form a bit of a trend. Well, you're in near the beginning, and I mean, obviously there's the standard definitions of trending, higher highs and higher lows, so to speak. But really, I just like to see the market break out from distinct levels of ranges, really.
Okay. So a lot of the way you're trading is really in anticipation of a trend playing out, essentially. Yeah.
Yeah, and also you get the best triple R when you're doing that, because if, let's say, the market bounces off 6,500 and I know it's now shooting above the range and it's starting to break out, the market's probably already gone up, 2, 3, 400 odd pips. And if you then try and go long, on the breakout up, north of that, range, then, yes, you can still make profit, but ideally, where are you going to put your stop loss? Ideally, you always want to put your stop loss far out of harm's reach. So, you'd like to put it below the actual range. So you'd end up having like a really big stop. Whereas if you're trying to anticipate the bottom of the range or the bottom of a potential reversal, you can afford to have a far smaller stop loss. So you could have a 150 to 250 pip stop, and then end up, bagging a 1,000 pip or whatnot, and making, anywhere upwards of 1 to 5, triple R.
Yeah, so I guess the other side of that is you also get stopped out quite a lot. Your stops get hit very quickly, which then leads you to have quite a low win rate.
Correct. It's 32% for me.
Okay. And, a lot of people aren't comfortable with this, or they find that difficult to actually stomach. And I guess that's maybe one of the reasons which kind of leads to strategy hopping, which we spoke about a little bit earlier. But how did you get comfortable with having a win rate around 30%?
Well, don't forget, by that time, I'd had years of unsuccessful day trading and scalping. And like one of the things that allures people, to these sort of day trading or, any sort of beginner or black hat strategy is that, do this system and you're 95% accurate, etc. And I was well aware that, you could make up a system right now which is 99% accurate, and you'd have all these win. But when you had that loss, it would wipe out like a month or more worth of profit. And so I was well aware of, triple R and expectancy and whatnot. So, and I, going back to the question, what made me feel more comfortable is that, well, one, I'd just given up on, staring at the charts, 5 hours a day, etc. And I wanted something which is, I could just run and get on with my life. So I sort of came up, as I said earlier, I just sort of got into the mentality that all I need is 1,000 or 2,000 pip trades, and that'll make me, 10, 20, 30% per year. And I was just trying to play the numbers game. And even though because I'm trying to get on, I am literally stepping in front of the train a lot of the time, I only dip my toes in. So those first few, couple of entry orders that I'm, trying to jump onto the trend, I'm only going in at 0.25% max risk instead of, what, a lot of people go, 1% is, max risk. Well, if I kept going in at 1% max risk, I'd be destroying my account left, right, and center. But, so all of these initial trades are 0.25% max risk. And then if I'm stopped out, well, great. Well, I don't lose much. And I know that, that trade idea is a dud. But when the trade starts to go in favor, I then scale in. So my second entry order, once it's going up, so probably 100 pips, once I'm about 100 pips in profit, that will be about 0.75% max risk. And then all subsequent sort of scale-ins would be anywhere between 0.25 and 0.5 or 0.5% max risk. And and I'm mitigating risk as we go along. So I'm like, for example, on the Black Monday debacle, there was, I think on the GR30, so on the DAX, I had about, whilst it was spiking down, I probably ended up having about 25 trades all on the DAX. And as it spiked down, it was just activating like all of my entry orders. I call them fishing nets, if that makes sense.
Yeah. So, that's interesting. How did you go about, or were you involved in trading what's just happened this week with the elections?
I haven't done too well, to be honest. So like on my Facebook 6 months ago, I said Trump's going to win. and I'm expecting the markets to tumble. And so a few weeks ago, I sent out to some of the people that follow me. I'm setting up some positional trades, and I'm putting my shorts in now because we've been hitting all-time highs recently on all of these on the indices and whatnot. And I thought, right, I'm gonna get a positional trade in, and I literally. I wasn't watching the markets because it was like 4 a.m. in the UK here whilst this was going on, and I was and I had a fair few trades open. I mean, not much. I mean, I'm down. In fact, I'm down 5% because of Trump. Because even though I got the direction right, I mean, the S&P did spike down, and I was massively in profit, or I had a massive floating profit. What I didn't expect was it to rebound and then rally like an absolute mother.
Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too big?
We're built for what you're building.
Link in the show notes to start trading with Trade the Pool's capital.
Ambition comes in all shapes and sizes. At First Citizens Bank, we roll with your goals because we're built for what you're building. Fit for your ambition. First Citizens Bank.
A lot of what we've been talking about here has been, actually, just before I get on to this next point I wanted to ask, you're talking about how you like to catch the really big moves. Okay, so you're taking a lot of small losses, just waiting for that big move to come along.
Mm-hmm.
Now, how do you anticipate when that big move is going to come along? Because obviously just trying to trade each reversal and that sort of thing, like the market is more likely to put in a big move at a certain point than it is off each, little reversal. So how do you, I don't really know quite how to word this question, but I think you know what I'm getting at. Like when is the market most likely to put in a big move?
So, well, the honest answer is I don't know. No one's got a crystal ball, but what I do like looking for is coiling. So, well, basically, whenever we see a big move, what you'll find is that if you look at any big spikes like Black Monday and whatnot, volatility tends to sort of drop for some reason just before these big moves, and we see a sort of coiling in the market. So the range, the range of the candlesticks for the a week or a few days beforehand gets really small, and it's like it seems like it's a big spring that's being compressed, and then eventually, it's basically market compression, and after compression is always expansion, and normally, you see these on flags or wedges or triangles and whatnot. It's all these patterns, these wedges and triangles are a form of compression, and you can see at the focal point, that the zenith of the sort of the triangle is the maximum coiling, and then you see the release of some sort, and then you see a big spike. Now, I do like some sort of flags, where you see a real distinct coil, and you see really distinct levels of support and resistance in these sort of wedges and whatnot. In which case, sometimes you don't know the level, so you can straddle it, and then obviously you have your fishing nets above and below, so to speak. But also, I like really strong defined levels of or ranging, i.e. bullish and bearish rectangles. So if I see a huge downwards trend, let's say in a market, and then all of a sudden over a month or so, the market just hovers around a level, and it's creating like a nice 200, 300 pip range over a month or so. But when you're looking at the big picture, you can see that it's a big bearish rectangle. That is when I like to get in my shorts near the top of that resistance. And what you'll normally find with bearish rectangles is that when it does finally spike down to the downside, you will always see some sort of stop run. And that's where I get my shorts in. And so the honest answer is I don't know when it's going to happen, but when I see these really defined levels of support and resistance, I know something's going to kick off, because the way I look at support and resistance is like, imagine you're by a lake and you pick up a soft pebble and you wing it across the water, well, that pebble is gonna bounce, isn't it? And every time that pebble connects with the water, it loses some kinetic energy, and it keeps bouncing and bouncing until it's got not enough kinetic energy to bounce, and then it just plops through the water. Well, I see the markets like that, and the more times the level is attacked, the weaker that level becomes. And so as I said earlier, the strongest a level is when, the first or second time the market is smashing into it. And the weakest part of a support or resistance level is when the market is smothering it. Does that make sense?
Yeah, no, it does. And just a question based off what you said there. What's the difference between a bullish and a bearish rectangle?
Yeah, sure. So if you have let's say on the daily and weekly charts, you got huge downward, momentum, and then all of a sudden the market stalls and it then starts going sideways, and then breaks to the downside. You can see it's created like a long rectangle, and that will be a bearish rectangle. And the opposite is for a bullish. So if you see a big bullet, rising market, and then the market sort of takes a breather for a few weeks or a month and creates a distinctive level of support and resistance, and then breaks to the upside, that is a bullish rectangle. And I mean, what a lot of retail traders do you go on any trading website, and you'll see all these patterns, head and shoulders, double tops and whatnot. A lot of people trade them and get in way too late. So with a bullish rectangle, a lot of people get in when the market's breaking on the upside of these of the bullish rectangle, where in fact the most profit and the least riskiest time to get in one of them is on the bottom, is literally on the support level of that rectangle, because that way you have the smallest stop loss and the highest R multiple, basically.
Okay, so what defines a bullish and a bearish rectangle is depending on what side it breaks out of.
It's the overall trend of the market. So, for example, let's take euro dollar. If you look in the big picture, that's falling. Let's go pound dollar. So, cable has been falling massively over the last sort of 2 years, hasn't it? Well, and there is still downside pressure. So, if all of a sudden the pound dollar starts ranging, and over the next, month or so, and it creates a really strong level of support and resistance, i.e. a rectangle, that would be a potential bearish rectangle. Does that make sense?
It does, yeah. Just moving on from that a little bit, a lot of this has been, it sounds as though you're a very technical trader. How important are fundamentals to you, if at all?
So in my overall investment sort of life, fundamentals are crucial. They're really important, but for my trading, negligible. Because I've just got a system. I stick to it, and it's just a numbers game for me. And I'm very technical. And the thing is, every now and again, probably once every 2, maybe 3 years, I'll be jumping on 1,000 pipper trade. And I'll be sort of 1,000 pips up, but it'll then turn into 2, 3, 4,000 pip trade. And when that happens, that single trade, I will be riding it, and I'll have, God knows how many positions on it. I may have sort of 20, 30 positions on that trend, and that one trade will make me sort of 2 or 3 years worth of profit. So that's all I'm doing. In terms of fundamentals, I use that for my overall investing. So trading is just one pillar to my financial parthenon, so to speak. And I believe everyone needs to sort of identify that they have a financial parthenon, whether they know it or not. And you need as many pillars as possible. So trading is one of them. Business needs to be other. You have business, properties, alternate investments, gold and silver, all sorts of different things. And so, especially for businesses and my sort of longer term investments, fundamentals are big. So I've got a lot of physical gold and silvers because of where the fundamentals are, really. It's just a safe hedge.
Got it. Okay. Yeah, I'm gonna ask you about all your business related ventures very shortly. Before we do, just going back to this point about you trying to catch these really big moves, 1,000, 2,000 upwards pip moves. How do you actually manage a trade like that? I know you've talked about how you actually scale into it and that sort of thing, but nothing moves up in a straight line 2,000 pips. There's some really big retracements during that time. How do you manage those? Like, how do you know where you're going to get out if it continues and if it, starts to turn around? And like, how do you actually manage that position?
Yes, it's a good question. So when I'm in a trade, what I've learned is that you really need to make things mechanical, and the more thinking you do, the worse your trade will be. And so I do not like to top pick or bottom pick once I'm in the trade, because you're just going to scare yourself out. Especially when you're looking at the P&L, you'll see that you're not, 800 pips up, and you're looking at the pound, how much, the monetary amount you're up, and every bone in your body is going to want you to snatch, basically. And you're spot on. Like, things do not go up in a straight line. So the reason I love the daily charts is because, most people around the world are looking at the 1 minute, 5 minute, and hourly charts. But when you're looking at big trends, so 500 plus pips onwards, but long story short, I use 2 moving averages to monitor, to maintain my stop losses. So I used to be quite technical and have my stop loss in accordance with ATR and whatnot, but now I just keep it really, really simple. So simple trading is good trading for me. So I just plot an 8 and 21 EMA, and what I do is I will trail. So once I'm in a position, once I'm in profit, once I'm 100 pips up, I'll then start trailing the 8 EMA. And what I do is I make sure that I have a nice gap between the 8 EMA and my stop loss, and also a layer of protection in between that. So when I say protection, I mean like a 00 number or a 5 or a 50 number, because they are natural sort of psychological levels of support and resistance. And so as the market goes up, by the time it's sort of 250, 300 odd pips, because I'm trailing 8 EMA, I'm only breaking even by the time it's, a couple of hundred pips up. And what I then do is I keep on trailing the 8 EMA, and then when I've locked in 200 pips, so, I mean, this hurts. It really does hurt, because by the time I've locked in 200 pips by trailing the 8 EMA, the actual trade is probably, 400, 500 pips in profit. And you're sat there going, oh, I'm only, locking in half of that. And then, so the 200 pips part is quite key for me. And then I then leave the stop loss there and wait until the 21 EMA catches up. And so that's even harder, because the market will carry on going in your favor. And by the time the 21 EMA is sort of caught up, like the whole trade may be 600-700 pips up, and you've only just started trading the 21 EMA. Yes, there are times where, the market, goes up 600-700 odd pips and then just pulls back or reverses. And, I've only bagged 200 odd pips or, 400 odd pips or whatnot. And that can be really frustrating. But what I have found by trailing the 21 EMA, that gives you enough space from the market to trend. And just pull up a chart, get any major pair out, and look for any big trends and plot the 8 and 21 EMA, and you'll see that the market does always pulls back to the 8 and 21 EMA. And as long as your stop loss is below, the 21 or above it, if you're shorting, you'll be fine. And then eventually the market will, reverse or pull back into my stop loss, and I'll be out. I mean, there's zero thinking involved. And so I literally spend less than 5 minutes a day trading, because all I'm doing is I'm looking for my setups. If I see none on my radars, I don't do anything. And if I've got some positions, I just smidge up my stop losses by, every other day or so.
Right. Now, you said your trading takes you about 5 minutes a day, and this is something I was going to ask you about, because you'd mentioned it the other day when we were speaking. That's going to sound really absurd to some people, that you spend no more than 5 minutes a day trading. I don't know what question to ask first, but like, is is that realistic for someone who's still finding their way as a trader?
No, definitely not, because I'm a firm believer that you need chart time. I mean, we've all heard that 10,000 hour rule, where, it takes 10,000 hours to be good at something. I think it's actually a lot more than that. I mean, you can do 10,000 hours of, something and still be pretty shit at it. So it has to be quality time. And I think I've had well over 40,000 hours of staring at charts. And so it gets to the point where you can look at a chart and, you can see all, the price action, and you get to understand price action a lot more. And so when you're starting out, you need chart time, basically. You need to understand price action, because like I have basically 2 moving averages, the 8 and 21 EMA, and pretty much that's it. I mean, I may have a sort of another indicator to help me get in, but I and that's it. So to begin with, when you're finding your feet, you need to put in the time. You need to read the books. You need to read everything Van Tharp has kindly made, and all the other all the Market Wizards books, etc., and really get into trading mindset, because that is everything. But for me, I mean, I am of the opinion that, like, I personally, I know that I'm going to trade until the day I die, simply because it doesn't impede in my daily life. Whereas we are all busy, no matter who you are, what you do. I mean, we all, have a job or a business of some sort. And then, if you have to come home and, feed the family and walk the dog, and then have to spend like another few hours staring at charts, it's going to get in the way of your personal life. And that's why a lot of people, they may start getting into trading, but, 3-6 months down the line, they just give up because it takes too much time. Whereas if something takes 5 minutes a day, well, you're far more likely to continue doing that. And so I've just got a set routine. I wake up whenever I wake up, and I sort of stumble into my office in my dressing gown. I load you don't need multiple screens, but I've got 3 screens, and I load up my sort of radar, so to speak, and that is something I've sort of developed myself, and I just look for potential setups. So this radar is effectively like a tiny. I'm just looking for a certain sort of indicator, so to speak. And if I see a potential one, I'll then open up a proper chart and have a look at it. And I've got a rule that if I've got to think more than sort of 3 seconds about it, I don't place the trade. If I've got to think about it, it's not a trade.
Yeah, I like that. That's actually, I interviewed John Carter on the podcast. I think it was like episode 69. And he said something very similar. He said, I'm going to butcher it, so I'm not going to bother. I'm just going to link to it in the show notes. But yeah, he said something very similar to that, which makes a lot of sense. So this radar is essentially like a scanner of some sort. Like, that's really what saves you a lot of time.
Yeah, massively. And I'm getting quite lazy, actually, because I'm actually about to get a trading assistant. So I'm going to get another PA, and that person's going to also do my scanning for me. So the plan, I'm literally probably a week away from getting this. I'm doing the recruitment as we speak. The plan is for that person I'm going to teach that person, my methods, etc. And then every day, or in fact, look at the charts a lot more than I do, and get that person to look at my radar. And then if there is a potential setup, by the way, every time I see a potential setup, in order for me to place a trade, I'll go through about 10, maybe 20 potential setups for me to actually place a trade. And so I'll get this person to go through the radar. If there's a potential, look at the big chart, like a proper chart, and see if it's a goer. And if it is a goer, what I'll do is I'll get that person to, WhatsApp me, they're going to be in the same building. I'll just say, Simon, here's a setup. I'll then have a look. And then if I say, yeah, it's a goer, I'll say, right, place the trade for me. And that person will know, what to do next. So I'm just trying to leverage everything in my life, everything from time, money, assets, resources, everything. I'm just lazy, basically.
Well, no, I think that's a good thing in some ways. That's what you got to do to scale. There's a quote by, is it Bill Gates? Something around that, how he'll always hire the laziest person over someone
Yeah.
else because they'll find a quicker or easier way to do it or something like that, which I think is maybe relevant to this.
Yeah, I've got a concern about what I'm going to do though. So like, it'll be interesting to hear the feed on this, because this is sort of an ask from my point really. So one of my concerns is if I do this and fully outsource my trading, I'm going to lose touch with the markets simply because I'm not doing any looking. And like one of my rules is that, if you go abroad on holiday or you're traveling, I purposely turn the charts off. I do not trade at all, because for me, it's like, imagine you're in the cinema and you're watching a movie, I know, the Avengers or whatnot, and you can sort of, you get the storyline. Normally it's not that complicated, but let's say you've got to exit the cinema for 20 minutes to take a phone call. When you get back in, you sit back down, you're going to be like, what the hell has happened? And it's going to take you, 10, 15 minutes to catch up with the storyline. And I think the markets are very, very similar. Yeah, so I think if you do go traveling and whatnot, you should trade very small position sizes, when you get back, just to get your eye back in. And I'm actually worrying slightly that by outsourcing things, I'm just going to lose track of the markets.
All right, so we've spent a lot of time talking about trading. And obviously that only takes up a small portion of your day. What's the rest of your day made up with? Talk to us about your life as a businessman.
Okay. So to begin with, the only reason I love business is because I've scoured the globe, all its asset classes. And I'm of the opinion now that the asset class of business is by far the most lucrative and best ROI or best, triple R business or asset there is by far. I mean, if any of my businesses don't grow 50% in a year, I'm pretty pissed off, to be honest. Whereas, can I make 50% per year on my trading account? No, not consistently anyway. And so over the last 5 years, I've been getting into business, but really over the last 3 years, I've been really dedicating all of my time into it. So I've got about 15 businesses now. 5 of them I've started up myself, so they're my sort of babies, so to speak. But I've been really getting into mergers and acquisitions, and like the ROI on that, the ROI cash wise and also time ROI is just it's unlike anything I've ever seen before. And so all I'm doing is what I say to new traders is that they need to ignore all of the hype that they see on Google, because trading categorically will not make you rich anytime soon if you don't have any capital to begin with. Whereas most people think it will, when it really won't. I mean, you can be busting out 20, 30% ROI years every year, but if you're trading a 10 grand account, it's not going to get you far. So you need the capital. I mean, capital is crucial with trading, as you can imagine. So all I'm doing is I'm siphoning all of the dividends I'm getting through the businesses are all flowing upstream to my holding company, and I'm just siphoning all the profits from my businesses into my trading account, and then I'm using trading as sort of like my computer is like a cash machine. It's like a compounding interest machine. And when you look at lots of rich people around the world, you'll see most of the billionaires out there have not got rich through, gambling or trading, whatever. It's through business. It's by, setting up, running, growing, and then selling the business. And when they get that huge liquidity event, they then, by default become investors. And so no one really ever got rich through compounding interest. That's sort of this, marketing myth. They go, make 10% per year and in 40 years you'll be rich. Well, who wants to be rich in 40 years when you can't do anything? So yeah, I think you need to use compounding interest to grow your capital and, exacerbate the returns that you get, if that makes sense. So I've just realized I haven't actually answered your question. So yeah, the day in the life is, I suppose, the day in all I'm doing every day is just, or I don't even run the businesses anymore. So I like to utilize other people's time. So I have people i.e. staff that run everything for me. And I mean, a lot of people poo-poo staff and whatnot, but I think they're the most important assets of a business. Like, they are the most important things in any business, which your staff, and you've got to look after them. And like, when you're first starting up in business, you're literally clueless, just like with most things really. And you're the salesperson, the accountant, the sales marketing manager, the customer relationship manager, the bookkeeper. You literally have to do every job. And what you get tied in to, you get right down into the weeds, and you end up working in the business when in fact you need to be working on the business. And that's so crucial. You have to work. I mean, this can apply to everything. I mean, you have to work on your business or on whatever it is. So I'm of the opinion now that, I mean, if anyone else is listening to this and you are a business owner, you need to get out of the weeds. I mean, if you're still doing the bookkeeping or the cleaning or anything like that, you need to get out. And if you're doing anything other than looking for JVs, a business to buy, or strategic partnerships, you're in the weeds. So literally on a daily basis, all I'm doing now is just trying to find companies to buy.
So what was your first business?
Well, I had a few that flopped. So my first 2 or 3 businesses failed miserably. So do you want the first flop or the first sort of successful one, or?
I'd like to hear about both.
Well, like most traders, you get into the whole, journey of financial education. And, when I started realizing and finding out things about, fiat currencies and how the global financial system works, and, how, things like the Federal Reserve is, a private bank owned by private shareholders, and, all those sorts of sexy things, etc. I was like, wow, the average Joe has no idea about this, or, how interest rates worked, etc. So I set up a website called hownottoloseyourshirt.com. And I think I was selling, this really crappy e-learning ebook or online course, just basically how the world works. And I think I got 10 people on board, and then, I just had to wind it down because it was just sapping up way too much time. So that didn't work. So this is all when I was stone broke, by the way. I was trying to just do anything to get out of my crappy admin job. I was known as toilet boy in that job because I used to literally I used to work on my business, my part-time businesses during the lunch breaks when I wasn't at work. And I used to go to the toilet 10, 15 minutes at a time. And I'd just be sat in the cubicle, just not going to the toilet, but just sending out emails, invoicing, and, stuff like that. So I apologized to the manager when I left.
So what was the first business that got some traction and started to take off a little bit?
I was a bullion dealer, actually. So obviously, I was a big fan of Robert Kiyosaki, and then I found Mike Maloney and all the, people like Jim Rickards, Chris Martinson, and people like that on YouTube and whatnot. And I found, I started getting into gold and silver because I really do see, especially with silver, it's the second most used commodity on the planet. All electronic needs it, and the world's running out of it. And I thought, wow, this is such a huge fundamental play, like a medium-term play. And I started trying to find out how I could buy bulk silver, to get it cheaper. And I found, I didn't know how big they were, but I managed to come across Europeans' biggest bullion dealer through a networking event. I met their MD in London, and I was just saying, I need to get into this. And he was like, well, if you find if you place orders over 100 grand, you can get some really great discounts. So I was like, okay, well, I then put a Facebook status out saying, I'm buying a load of silver. Anyone want to chip in? And my first order was about 100K, over about sort of 10, 15 people. And I then did that same status every month for the next 3 or 4 months. And I was like, wow. And so I managed to get silver for myself really cheap. And then basically a bullion business. I became a bullion dealer by default. And that was a pretty it was successful, but it was painful because the net margin was 1.4%. So in my first year, I turned over 1.4 million quid, but made under 20 grand net profit, which was just horrendous for all the hours I was putting in. And so, after about a few years, I sold that. And then, that left me with because I had a database of, paying subscribers, so to speak. So I managed to sell it for a nice sum. And then I used that capital to start some other businesses, really. And I put a whole whack of it in my trading account.
Yeah, right. So how have you gone from having one business to now having 15 businesses?
Well, I set up, so I sort of redid my, hownottoloseyourShirt.com sort of business, and had an education company, and that did well. So I had created sort of a following that way, and about 3 years ago. Oh yeah, so I started some other businesses I had a consulting business I set up. I set up an aviation brokering business. I mean, that did well, and then it did horribly bad, so I had to shut that one down. But like anything, I sort of muddled my way through. But about 3 or 4 years ago, I did this mergers and acquisitions course in Mallorca, and there's this guy who shall I say his name or not? I don't want to plug anyone, but basically, he's one of the world leaders for mergers and acquisitions, and I got one of his sales emails. It was in the spam folder. The subject line caught my attention, and it was a really long form. I mean, it led me to a long form sales page, and I'm like a salesperson's wet dream because I just buy everything. I'm easily sold to, and by the end of that, I read it all. I pressed buy. And it was a £7,000 course for 2 days in his home in Mallorca. And I told my wife, and she was like, "Oh, you muppets, you've been you've been had." And I was like, "Yeah, I probably have, but I mean, if I can just get one nugget." So with every conference I go to or whatever, all I want is just one nugget which I can go away and do. And so I went there with completely open-minded, and to be honest, I stumbled onto some apps like a gem. If that course was $100,000, it would still be dirt cheap. And he was a legitimate guy. The course was great. I mean, and I learned everything from how to buy distressed businesses, how to buy successful businesses for £1, how to basically buy and sell businesses. And that course was the beginning where I realized that there is no profit in running a business. It was quite interesting. The first line, but there was about 7 other people there, all business owners, and his opening line of the weekend was, "All business owners are mugs." And we were all sat there looking at each other going, "Wait a minute, yeah, we probably are. We just paid you $7,000 and you're calling us a mug." And then he went on to explain that basically, there's no profit in running and growing a business. That's where all the heartache is. That's where, all the growing and teething problems are, staff problems, and, getting to market, and it's costly. And businesses, like trading, is a huge marathon. And most people fail in the first or second hurdle. I mean, in business, 9 out of 10 businesses fail in year 1, and those that succeed year 1, another 90% fail within year 5. And so it's hardly anything emerges from 5 years. And so basically the idea is that I don't like buying businesses that are up for sale, because there may be skeletons or they may be selling for good reason. So I like buying businesses that are not looking to be sold. So I like nice profitable businesses, and it's chasing the girl at school. You always wanted the girl that you couldn't get. And it's the same with these businesses. And so I've got a criteria. So I only buy businesses that have been running for at least 3 years, have at least $300,000 net profit per year, and have a management team in place. So proper, staff. So that way, when I acquire it, I can put my own MD in, or I can promote the person, the ops manager in, to run the company. And then I can sit back and just get the dividends. And there are certain ways you can get the company for cheap, or do a thing called a bimbo, which is a buy-in management buyout, where you effectively use the company's profits to buy the company for you. So yeah, that's basically it. So really, I own about 15 companies, but I only really actively manage or really run sort of 3 or 5, and they're the ones that I set up just because they're my sort of babies.
Okay, so you might have already answered this to some degree, but why not just have one business and grow it as large as you can over having many smaller businesses.
Yeah, it's a really good point. And like some of my business mentors in the past said I'm a bit of an idiot for basically spreading my attention and time and energy, everywhere basically. And I mean, it is a really good point. I could just focus on one thing, but I'm also trying to mitigate everything. So I do not like risk. So I mean, as you can probably tell with trading, I'm going in at 0.25% per max risk per trade. I mean, so if you just have one business, you are susceptible to that industry. If someone disrupts that industry, you're screwed. If that one company is, based in the UK and we have something like Brexit or whatever, I mean, you can be screwed. So I have a very negative outlook on the world. And I had this, so years ago, I said to myself, for the rest of my life, politicians will always be crooks, bankers will always be bastards, prices will always be too high, taxes will always be too high, the government is not there to help you, and all the government cares about is being re-elected every 3-5 years or whatever. And so when you have that outlook on the world, you just think, right, okay, well, no one out there is there to help you. So I refuse to be the victim. So what I've done is I'm trying to just design my lifestyle. So I'm trying to design it so, one, I don't need to go on holiday to escape from my life. I try and make my life every day, a holiday, so I don't need a holiday. And also in terms of financially, I want to be completely hedged. So, I've got, gold and silver, I am hedged. And in terms of businesses, I mean, the businesses range from engineering, IT, recruitment, marketing, education, training, manufacturing. So like if the shit hits the fan and, Donald Trump, Brexit combined with China going bust or whatever, yeah, maybe a couple of the businesses will go bust, but will it hurt me? No, not really. I mean, even if I lost all my businesses right now, I would still be financially independent. And so, yeah, I'm probably missing a trick by not putting all my focus on one thing. But I mean, I'm just doing this M&A thing right now, and I'm getting into IPOs quite a lot now. So there's some huge, like buying stocks and shares is so 1990s. It really is. It's like you got capital gains tax. You've got stamp duty, you've got commissions, and as you know, most people, most retail people are dabblers. People are, most people that trade or are on the market are dabblers. And I mean, the high frequency traders have got the markets licked. They really have. The stocks, that market is licked, and they're now seeping into the high, so the HFT firms are now seeping into the currency markets. I mean, as you know, it's the world's biggest market. So, I only do pre-IPO stuff. So, for example, there was this this company which IPO'd in July. It IPO'd at €1, but I got in at 50 cents a share. And so the day it listed, I made 100% ROI, guaranteed, and it's now sat at €4. So, yeah, I only touch stocks if I can get in before the crowd, so to speak.
Right. Okay. No, that's a really good answer. And I think you did a really good job of explaining that too. Going back to a point you made earlier when we first started talking about, the business side of things, you said that you're not going to get rich from trading alone unless you have large amounts of capital. That's a fairly reasonable point to make.
Yeah.
And then you further made the point of saying that that's why you go into business, is to, make larger amounts of money, which you can then put into your trading account, and they kind of tie in together. They kind of work as one in some ways.
Yeah.
How do you actually suggest someone goes about doing things that way? Because we've got to think that if someone doesn't have a business already, they probably are employed. If they're just starting out in trading, it's likely something they do after hours.
Yep.
They've now got to try and fit in starting a business and getting that off the ground. How doable is that?
I always put my money where my mouth is, and I think it's really doable. But the thing is, when people think of business, they think, oh shit, I need to create the next Uber, or I need to create the next Amazon or Google or whatever. And no one ever got rich, really. I mean, unless you're Mark Zuckerberg, you don't have the one-hit wonders are like unicorns. They really are. Wealth is not made in one magic bullet. It's through it's the compounding of lots of toil, heartache, and effort. And you shouldn't. Your very first business, you must not think it's going to make you millions. I have this game which I play with myself, and I call it the 5 to 9 game. And years ago, this was literally 5 years ago, I was half drunk when I came up with this with my friends. And I said, right, I'm going to sell a business for 5 figures, then 6 figures, then 7, then 8, then 9 figures. And so that's what I'm doing. I'm the first business, yeah. So I've sold a business. I'm on, I've just done a 7-figure exit, or I'm literally in the paperwork right now. So my next number is I want to sell a business for 8 figures. And the thing is, every time you do that, you learn your skill set in business gets massively improves, and you start playing at bigger levels, so to speak. But going back to what you said, which I think is a really good question, the average person is in employment or whatnot, and I think, first of all, there's 2 things here. First of all, you need to change your view on trading. You must not think that trading is going to get you out of your financial hole if you are in one. Because what you need to do is you need to work on your skills. Don't worry about the money. Just you need to make it so that you know 100% in your gut that you can trade an account consistently and profitably and make even if you're consistently making it, 7-10% per year, you're already in the top 1% of global traders. And if you, and what I say is that if you can create a track record of at least 2 years of solid stats that prove that you have minimal drawdown, that you're consistently making 10% per year, etc., you can then go and around and flaunting that, that track record. Hell, get it audited by an accountant, so it's proper legit, or do it, trade through, MyFX or whatever, any online sort of logging software. So it's all legit. And then there are people out there that will be willing, like prop firms or banks or whatever, raising capital will be a lot easier. Now, obviously you got to be careful of, regulations. You can't be, doing money management without the proper sort of stuff, but you just need to get to the point where, you can trade an account and grow it by 10-20% per year, because when you can, then it's all about scale. It really is. So that's the first thing. So over time, over 3-5 years or so, just work on being a good trader, even if you have a tiny account. And definitely use a live account, not dummy. You need to do all of this on a live account. So that's the first thing with a trading mindset shift. The second thing is, let's say you're making 10% per year consistently. Well, you then need to know what you want to live off. So let's say you want to make, 200 grand a year. Yeah, most people could happily, retire on 200 grand a year. So, or at 10% per year, you need what? 2 million quid, right? So you then need to start thinking, how can I make £2 million in a lump sum sale? So obviously, because I'm going down the business route, it could be property, it could be all sorts of other things, but I go down the business route. Well, I need 2 million quid. So I've just got my calculator out here on my phone. So I'm typing in, 2 million quid. Now, I would I would basically look for a subscription-based type business. And the reason being is that if you have an automated business, online business, which has subscribers paying you money, you have a really good exit multiple. So what I mean is that you can sell your business for 10, 15, maybe 20 times EBITDA or profit. So what that means is, let's take 15 times profit. So if you want to sell something for 2 million quid, in fact, let's call it 2.5 million quid, because after taxes, etc., you're going to be screwed over. So let's say you need a 2.5 million quid exit. Well, let's divide that by 15. So that means, let's assume that you can sell this business for 15 times earnings. Well, that means you need a business that chucks out 166,600. So let's call it 170 grand a year. So you need a business, automated subscription type business that chucks out 170 grand a year. Now, so you've got to work backwards, as you can see. So So now we got this figure. I need a 170K business. So what I would suggest is that you find a product which has mass market potential at a very low price point. So for example, you could sell something at, I don't know, £21 per quarter or $21 per quarter. I'm going to stick with pounds because I'm British, but so £21 per quarter. So that's what, £7 per month. What's that, like 30 pence per day for the actual user. So you then need to work out the lifetime, the yearly value for that customer. So if they're paying you 21 quid a quarter, that's making you £84 per year in terms of revenue. So if you do 170K divided by 84 quid, that means you need 2,023 people paying you 21 quid a quarter. Now, obviously that's revenue. So let's call it 2,500 people. I'm always, round up. Hell, let's be even more conservative. Let's say 3,000 people. So you need 3,000 people paying you £21 a quarter or £7 a month. And then you can sell that business for 2 million quid. You can then dump that 2 million quid in your trading account and then live in Costa Rica forever or wherever you want to go. And like most people work a job for, 20, 40 odd years. Well, hell, do you think if you had a business with a product or a service where, do you think over the space of 10 years or even 5 years, you can find 3,000 people to pay you 7 quid a month? I'm pretty sure you can. And the beautiful thing is with a product that's, 21 quid a quarter, it doesn't have to be all bells, singing, dancing, whistles and gadgets. I mean, I'm not saying, deliver shit. You must never deliver shit. I mean, money is a byproduct of value. Please, you must remember that. But the thing is, once you have that database, let's say you have 3,000 people paying you, 7 quid a month or whatever, and you've created your own printing press because you have 3,000 people that effectively trust your product or service. So all you need to do is come up with a new product and go, hey, here's a new product. And guess what? It's, the same price. Or hell, you then just basically created another £2 million business. So a prime example of this is, dollarshaveclub.com. Yeah. Well, they started off with, really cheap razor blades. And they've now sold for billions, by the way, but they had that. And then once they had that following, they then created a new product line called, I think, One Wipe Charlie's, which is like a toilet paper type thing. And then nearly all of their customers became customers of that new toilet paper. So he then doubled his business overnight. Does that all make sense? I've sort of gone on a massive, rant there, but always work backwards.
Yeah. No, I really appreciate you breaking it down. I think that's really insightful and super interesting. One thing we should probably factor into those equations is churn as well, because,
Oh, yeah, definitely. Always round up. Realistically, you probably need 5,000 people paying you 21 quid a quarter. But and also, it depends where you exit, because if you get a private sale, most private sales will be done, they'll be like, yeah, we'll give you 3 times earnings or in this case, 15 times earnings, etc. Well, if you sell to a PLC, so another stock market, publicly listed company, a lot of the time they'll try and acquire a company because you're, one, probably taking their market share, 2, they see you as a future competitor, and 3, they'll try and get you to bump up their revenue. So I've got a friend who sold his oil company, and he went into the meeting, the final meeting. He was like, right, I'm not going to accept any less than 5 times EBITDA, so profit. And he was saying that at this meeting, there's just him on his own, and on the other side of the table, there's 9 people. So there's the main guy and like 8 solicitors or accountants or whatever. And they're like, I won't say his name, Mr. Blah, we're prepared to offer you, we're going to have to be quite reasonable. We're only prepared to offer you 21 times reveneu. And he was like, right, keep cool. And like under the table, he was like, yeah. And yeah, so they're trying to buy 21 times turnover, and all he wanted was like 5 times profit. And so he walked out. He sold it for 25 million quid.
So why are people willing to pay 15 times for subscription model based businesses?
Yeah, again, another good question. So put yourself in the investor boot. So what was it? 170k revenue. So let's say it's making, I don't know, call it 120k net profit. Yeah. Going back to that business example with the 3,000. So if a business is making 120k net profit a year, and if let's say, so let's say I'm an investor and I'm going to buy your business that's making 120k net profit, net after tax, and I give you 2 million quid for that, or just work out the yield. So 120,000 divided by 2 million equals 6%. So just by buying that business from you at 15 times profit, that business is going to make me 6% divvies per yield, and 6% on 2 million quid. It's not hard. I mean, it's good, and that's sorry, I'm stuttering now, and that's assuming sales remain flat. So let's say I'm buying that off you. I'm not thinking, right, I'm going to buy this off you and I'm going to keep the subscribers at 3,000, people. I'll be sat there going, right, I'm going to buy this, make you happy, give you 2 million quid. That's 15 times earnings. That's instantly made me, a 6% yield, and I'm going to, double the amount of subscribers. So all of a sudden that asset, which I've now bought from you, is now making me 12% per year. Does that make sense?
Absolutely. Yeah.
Yeah, just always put yourself into the boots of the investor.
Right. Yeah, I'd never really thought about it like that.
Yeah, and also automated subscription is the way forward, because you don't need a big business with lots and lots of staff. So like if your whole business is automated, and everyone's on a direct debit, that's music for an investor's ears.
All right, so just moving on from this, the last thing I want to pick your brain about is the schooling system. I know you're very passionate about this. Talk to us about your views on the schooling system.
So I'm going to have to condense this because I can talk forever on this, but I did a TEDx talk on this topic earlier this year, and I basically believe that schools are killing our kids, like mentally. I really do, because our schooling system was, derived from the Industrial Revolution, where it's designed to send as many kids as possible into the factories, because we were going through that huge industrial revolution. And the thing is, nothing's changed in the last 150 to 200 years. And what it's doing is it's setting, like at the moment, all schools are pretty much promoting the 40-40-40 plan, i.e., work 40 hours a week for 40 years and then end up retiring on a pension 40% what you struggled to live on in the first place, which is the worst plan ever. I mean, why work for 40 years when you can realistically bust a gut and retire in 5, maybe 10 years? Those days are gone where you just work in a job forever and get a really big fat pension. And so we are right now going through a technological and entrepreneurial revolution, and robotics is going to wipe out vast amounts of jobs, waitresses, factories, you name it. The law world, paralegal jobs will go because, the computer's more accurate now. So there's so many jobs that are going to, disappear through tech. And if you have a schooling system, tech is on an exponential growth. Yet our schooling system is still kitting out kids with bugger all skills. So what I'm in the process of doing, my son right now, it's now, November 2016. He's 5 months old. And I simply do not trust any school in the UK for my son to go to. Because I know they're just going to beat the creativity out of them. So I'm in the process of setting up my own super school. So financial education will be the number one topic, because as long as humans are around, there will always be money, currency markets, stock markets. So you need to understand the world financial system. So that will be a big topic. But also, my kids will, as in the kids that come to my school, will know that, they can be or do anything. They don't have to just settle into a job. And so the whole school, from 5 till 18 will gear them up into becoming a business owner. Because business owners are the the backbone and the bedrock of of society. Really, they employ the most people, pay the most tax, percentage wise anyway. And worst case scenario, let's say you keep on screwing up, well, you can always fall back and get a job. So money is not real. Money is just a concept. I mean, we're the only animal on this planet which has money, and it's no different from monopoly money or a glass of water. It's just people's perceptions and beliefs around it, and it's just I think it's not a real thing. So what you need to do, I mean, if you are in the position where you are wealthy and you are rich, I feel it's your moral obligation to the world to convert that paper, which is all it is, paper or ones and zeros in a computer, convert it into something real. I help with the environment, or create charities, or you do whatever, at the very least, try and become carbon negative. So yeah, that's my thing. I mean, what I really want to do is change every school in the UK. And it's going to take me 50 plus years. But I mean, if I can create just one school, I'm happy, because my son and my children will go to that school, and I know that they'll do far better than the average person leaving the average school. So maybe being a bit big-headed here, but it's my plan anyway. No,
I mean, I'm totally in agreement with you. Like, I think the schooling system is broken for sure. I mean, there's no doubt about it. You can't say otherwise. So you mentioned that there would be a lot more subjects around finance and, the financial world, which obviously I see value in that. What other subjects would you want to teach more of and perhaps less of?
So, I mean, less of the things which are completely useless and irrelevant for, everyday in life. Like, I mean, the parents for these kids that come to my school, I mean, if their parents want their kids to be a doctor or an engineer or a mathematician or a scientist, this really isn't the school for them, because for that you do need good grades, etc. And I don't think I will have a proper grading system. So I think, I mean, financial education, we're going to have like our own currency system within the school. So it'll be a fiat currency. So, I mean, if the kids can become a millionaire or a billionaire within our schooling system, when they leave into the real world, they're like, well, I did it, with school money. I can do it with, sterling or dollar or SDR or whatever it may be back then. But coding, I think, is going to be a huge thing. So at the same time, I'm going to self-fund this, but I want one of the UK's best centres for 3D printing, robotics, virtual reality and augmented reality. And what I want is for these kids to play around, create stuff, break stuff from the age of 5. And what I'll do is that, like, if a kid is playing around with all of this kit, 3D printing, robotics, and, augmented reality, by the time they're 18, they're going to be really clued up. They're going to be creating all sorts of stuff we can't even imagine right now. And what we'll probably do is, the school keep 50% of whatever business they create, and they keep half. And I don't know, I genuinely believe this school will create the next, Elon Musk or, Zuckerberg or whatnot. But at the same time, just real stuff, things that you need in everyday life. Like, I've never in my life needed Pythagoras or trigonometry or algebra.
Yeah, going back to what we're talking about here, what sort of challenges are you going to come up against in doing this? Like, I don't imagine that starting a school of your own is any easy task. What are the sort of challenges? Like, I'm sure there's some sort of regulations by the government and that sort of thing. Like, how do you plan on tackling that?
So, there's going to be quite a few regulations or challenges. So, luckily in the UK, there's a thing called a free school. So you can create a school with, and do effectively whatever you want, so to speak, or within reason. I mean, look at school holidays. The only reason we have 6-week or 8-week holidays in summer is because of harvest. Not many people know that. Like, the only reason we have these huge summer holidays is because the farmers back in the day needed, their kids, to help out with the harvest. It's silly. I mean, I found a school the other day that did 6 weeks on, 2 weeks off, all year round. And that, I mean, that seemed like a far better solution. But so regulations, there will be one. Funding is going to be another one. So I've worked out I need at least 10 million quid to do all of this thing, or everything that I need. I want to buy, at least 100 acres of land so I can build stuff on it, and get the kids to build stuff on it, etc. And the thing is, if I get government funding or external funding, all of a sudden I am like a puppet of, the fund managers or whatever. So I want to completely put every penny I have into this. So hell, it may be like a dictatorship, but the thing is, I don't have all of the answers. I'm a simple bloke with average qualities from Norwich in the UK. I'm a very average, and I don't know. I mean, when I did this TED talk, it was full of educators in the room, and it was so Marmite. Literally, half of the teachers in the room hated my guts, and half the teachers in the room loved it. Another thing is that I'll put the minimum wage for all teachers at least 60 grand a year, minimum, because I don't want a teacher that has debt problems and money worries looking after my children. I want them to be 100% focused on my kids, not their mortgages or whatever. So teachers do need to be paid more, because they're like, your kids are the most important thing in your life. But the thing is, what I'm going to do when I fully press the go button, I'm going to pay the best minds in the world. I'll find the best, forward thinkers. I'll get the best business people I can find. I'll get, some of the best teachers and whatnot. Sir Ken Robinson is high on my list. If you haven't heard of him, read his books or just YouTube Sir Ken Robinson. He is amazing. And I want to get like 20 odd people, the best people in the world, into a hotel room and go, right, I'm going to pay for all of the expenses and go, right, for the next 2 weeks, you are not to leave here until you come up with the new blueprint for the best schooling system that will gear people, kids up for the next 100, 200 years, and no doubt it's going to be tech, led and whatnot. And so I don't know what that blueprint is, but after this big conference, I'm pretty sure we'll have a really good idea of what, a few possible blueprints could look like. And once I've got that blueprint, I can then implement it. I mean, I just use my business skills and whatnot. It's I'll just treat this like a new startup business. Yeah. So the first step is literally getting the best minds in the room, and forcing them to come up with, ignoring all procedures and the norms and whatnot. Just go, right, if there are no laws, money's not a problem, blah 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 blah. What would be the best system? And once I've got that blueprint, I can then do stuff with that.
Sounds like a solid plan, man. That's big. That's big.
Fingers crossed. I mean, it's probably. Well, I've got a hard deadline. I've got to get this school set up over the next 4 years or 3 years before my son is, schooling age. But I mean, to affect other schools, it's gonna be probably a lifelong mission for me personally.
Sure.
So.
Yeah. I mean, this whole. I mean, what you're doing here is pretty major. A lot of people. Like, you say these things, and I can just tell that you have a lot of confidence in what you're saying, and you genuinely believe it. A lot of people don't have the ability to think that big. Is this always something that's come natural to you?
No, not at all. I've had to I have to beat myself into this. So one, yes, I will fail massively along the way. I just know that. But the thing is, you're only a quitter when you give up when you fail. So I think I'm just stubborn. When the worst thing someone can say to me is, you can't do that, or it can't be done. Because I'm always like, well, why not? Why the hell not? Normally why the F not? And the thing is, you just got to, in the Air Force, we have a thing called do, review, apply. And literally, that's all I'm doing in life. I'm just doing, I'm reviewing, and then I'm applying, the things that I fall up on. And the thing is, a lot of people, when you're setting goals, goal setting, motivation is temporary. I mean, we've all set, New Year's resolution to lose weight on the 1st of January, but by the 15th of January, we're on our third Big Mac. And so the thing is, you need to focus on your habits, not the actual goal. So if you want to, let's say, lose weight, don't focus on, losing weight or whatever. You need to focus on the habits that will make you lose weight. So a habit may be, right, I will go for a 20-minute jog every single day. And you need to force yourself to get into the habit of doing that jog every day. And then you simply, successful people are simply the accumulation of good habits. I mean, I'm no different than anyone else, except I think I've just got better habits than people because I'm just stubborn. And also, when it comes to thinking, I mean, if you haven't read the book Think and Grow Rich, you really do need to do that and read everything by Napoleon Hill. I was going to say Napoleon Dynamite there. Napoleon Hill. So, and thinking big and thinking small takes roughly the same amount of time, roughly the same amount of energy, but it's so convoluted in the thinking small world. Everyone thinks small, and so it's so convoluted. So just think big. And there's way less competition. And then you also need to change the types of questions and also the quality of questions you ask yourself. So you need to condition your brain every single freaking day to say, what must I do to get this? What needs to happen to get this? Or what needs to happen so I can buy that Lamborghini or whatever? And nothing's going to change straight away, but eventually your brain's going to go, oh, okay, well, you'll wake up and think and realize we're swimming in an ocean of opportunity. I can't go anywhere without thinking, shit, that's going to be a really good business opportunity. And then I have to go, oh, no, too many spinning plates, calm down. And so that's the types of questions. And also you can use that with tragedies. You can go, right, or if something really bad happens, you go, okay, what needs to happen so this shit never touches me again, ever? And that way you can mitigate risk. And so that's the types of questions. And then you need to think the quality of questions. So you need to think, well, okay, instead of thinking what needs to happen for me to buy this widget, you need to say, well, just think bigger. So go, okay, what needs to happen so I own this shop, so I can have every widget? Or what needs to happen for me to buy this house? Or no, what needs to happen so I can buy the village? Just think bigger. And eventually, over, a few months of ramming this stuff into your head, I mean, this whole Tony Robbins type stuff, your brain will just change. So, yeah, some person after the TED Talk said, you can't do this, it just can't be done. And my brain just sort of exploded inside. I was like, why not? Why not? Why not? And they just couldn't give me an answer every time I said, why not? I was like, it's just not done that way. Well, why not? And I've got a filter. Sorry if I'm rambling, but I've last thing. I've got a filter in my head. So whenever I have a decision to make, and I'm not sure, I run it by this filter, and it's basically, am I going to die or is someone else going to die? No. Okay. Am I going to get hurt or is someone else going to get hurt? No. Am I going to jail or is someone else going to jail, or am I breaking the law? No. Well, they're the three worst things that can ever happen. So if it doesn't meet those three criteria, well, then just freaking do it. So what if you fail? So, yeah, that is literally the worst case scenario.
Yeah. Man, what a brilliant answer. I'm loving this. There's one more thing I want to ask you, and then we should probably wrap this up. Now, when we started talking about the schooling aspect, you were saying that as we keep moving in the future, there's going to be a point where more and more jobs are being taken over by technology and robots. How are humans going to stay relevant? Because not everyone wants to be behind this technology and behind these robots creating things. Some people are happy just working in the factories, like we talked about earlier. Where are humans going to go? What's going to happen when robots become more prevalent?
Yeah, so it's a really good question. And the thing is, people have been saying the same question for centuries now. So if you go back just 100 years, depending on what country, if you take the UK, 90% of people worked on the land. That's nuts, isn't it? 90% of the people were farmers of some sort. And then obviously we got tech, like tractors and, better tech. And now we have less than 5% of the population are farmers. Where the hell have all those people gone? And at the end of the day, humans are resilient creatures, and we always adapt. And basically we always upskill. So the farmers had to upskill and do something else. And it's exactly the same this way. However, I do think this is a huge topic which we do need to look at, because the rate of change this time round is going to be far quicker than anything humans have ever seen in history. Like if you look at the transitions of the energy transitions, it's long. So for thousands of years, we used wood as energy, and then we went to coal. And the transition from wood to coal was like 200 odd years. And then we went from coal to oil, and that transition was like 100, 150 years, depending where you are on the planet. And like, we're still using oil. Now, obviously we don't have a new form of energy. Ultimately, I think solar is the way forward. But like the rate of change is increasing massively because tech is on an exponential growth. And for those, I don't want to teach people get people to suck eggs. I mean, if you're not really familiar with exponential growth, please study the hell out of it. It's scary, especially when you're looking at global debt and global currency expansion. But so the next transition, robots are going to absolutely take over the world in terms of jobs before we even know it. And so that is going to be a massive shock. And so, there will be huge unemployment, in some sectors. I mean, China is leading the way. I mean, I read a fact, there's this region of factories, 160,000 people have just lost their jobs. Just because the factories have just got rid of the people and they've put robots in instead. Now, a lot of the news in China is being smothered because it's a nanny state, so to speak. But it will happen, and I think ultimately at the end of the day, we'll all have like a universal basic salary, just like like Switzerland just declined. We'll all end up being paid by the government like $1,000 or £1,000 a month just to live, and that way we can then start working on better stuff. That's what I personally think. But yeah, I think at the end of the day, those that like the taxi driver, like if you go, this is the prime example. Taxi drivers in London, so black cab drivers are the best example. I go to London a lot, and I always get a black cab because I just love chatting to the cabbies and just getting a view of their mindset. And no offense to them, they're so stubborn and so backwards. Like anyone can see that Uber is absolutely destroying the taxi world, especially in London. And like all these taxi drivers are just bitching and whining about Uber, when in fact they should be really being concerned. I mean, hell, they should, if they're really concerned, they should, at least, go long on Uber. So whatever they lose in, fares, they can mitigate on, Uber or whatever. But they need to start reskilling now. They need to, adapt now before, automated Tesla cars take over the whole taxi world, basically. So yeah, I ultimately, I think the next 5 years, we're in for an economic shitstorm like we've never seen before. I really do believe we're going to have an economic crash at least 10 times bigger than 2008. So this equity crash will spill over and start another property crash. We're going to have a bond market collapse as well. However, and we're going to have all this, upheaval. But I think 10 years plus, the world is going to be some awesome, it's just freaking awesome. Honestly, there's a book created by Peter Diamandis called Abundance. The future is brighter than you think. And I encourage every single person that's listening to this to get that book. It's a thick one, but just read it. Honestly, the future is so positive. It's silly, but just over the next 5 or 10 years, you just got to weather the storm.
Great stuff, man. I'm gonna check that out. I interviewed Michael Siding. I'm sure that's how you pronounce his last name. He's a or former fund manager in Sweden, and he was on the podcast a little while back, and he spoke a lot about AI and robotics becoming more prevalent in that. It was it was very interesting. I find this whole subject fascinating anyway, but I'm sure we could go down a whole nother rabbit hole again, but let's cut it off here. So I just want to say, Simon, thank you so much for doing this, man, and I appreciate you taking the time. It's almost 2 hours now to speak with me and share, a lot of really great insight with everyone who listens to this podcast. So, yeah, thank you very much, man.
No, thank you for your time. I'm sorry if I've rambled on for a bit. Yeah.
Not at all. That's the whole purpose of doing the podcast. We don't have any time constrictions, so it's good in that sense. Where's the best place listeners can go to find out more about you?
I don't want to plug anything, so I would just say just go, YouTube my name, Siam Kid, on YouTube. I try and put 1 or 2 new videos up on there. And if people want to do more digging around on me, I mean there are links on my videos and whatnot. But I think that's probably the best thing.
Okay, and do you want to share your Twitter handle?
Yes, Siam Kid. So it's SIAMKIDD. And I'm loving your program. Honestly, Chat with Traders you're doing more for the trading community than any other thing I've come across. Like the knowledge you're putting out there for free is just remarkable. So I have to thank you because I love listening to them. So
that's huge. It's awesome to hear that coming from you. So thanks very much.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokerage and trading.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's going on, fam? Episode 102, and I have something a bit different for you this week. Here's the rundown. My guest is Eugene Soltis. Eugene is a finance professor at Harvard Business School, and over the past 8 years, give or take, he's gotten to know and spent a lot of time with many big-time executives and professionals who have been convicted of major financial crimes, such as cooking the books, fraud, Ponzi schemes, and even insider trading. What began as nothing other than self-interest has escalated into a 464-page book, which was released in October this year, 2016. The book is titled Why They Do It: Inside the Mind of the White-Collar Criminal. Intrigued by the subject matter, I invited Eugene onto the podcast, and we got talking about how Bernie Madoff became the mastermind behind the biggest fraudulent scheme in US history, sucking billions upon billions of dollars from unsuspecting investors, some of the notorious insider trading cases, and ultimately why they do it. As I mentioned, Eugene's book is available now, so if you'd like to take a closer look or even grab a hardcover copy, just go to chatwithtraders.com/why they do it, and that'll take you directly to Why They Do It on Amazon. But also worth mentioning, you can get this as a free audiobook too when you sign up for a free Audible trial, all at the same link, chatwithtraders.com/why they do it. Okay, folks, here it is, my interview with Eugene Soltis from Harvard Business School in Boston. How's things? What's been going on?
Things have been well. I actually just been doing a pile of presentations on the book. So I actually just arrived back. I was doing one at another university. A couple of schools are actually giving it as I guess reading in some of the finance classes, and I guess it's both easier and I think probably a little bit more lively if I give a presentation than the professor. But given how many schools there are in Boston, I've now done this 5 times. So
So you're getting to know it pretty well.
yeah, at this point, I don't know backwards and forwards quite yet, but I think probably a couple more iterations I'll get there.
You're getting there. Nice, nice. Oh, that's cool, man. It's good that there's a lot of interest around it. Very cool. My copy arrived in the mail just the other day. Obviously, I haven't really had a chance to read too much of it, but it's definitely something I will be reading for sure.
Oh, good. Well, there seems to be it's certainly a different take on some of the, I guess, white collar crime compared to some other books written on the topic. So at least it spurred some different conversation, which seems to be well received so far.
So I wanted to bring you onto the podcast because I'm really intrigued by this book you've written, which is titled Why They Do It. But before we talk about that, let's hear a little bit about yourself. So, besides now wearing the badge as an author, what else do you do?
Well, my main job is I'm a professor at Harvard Business School. And in this role, I teach a number of our executive education programs, primarily in finance, accounting, and some of these, I'll say, gray area decisions like those described in the book. And most of my empirical work, this is a qualitative work we're talking about, the book, but most of my empirical work looks at issues around financial economics and corporate disclosure.
Okay. And is it true that you had aspirations of becoming a trader yourself before you went down this path?
I did. Actually, in many ways, this is what I expected to maybe hopefully do an interview with you, but in a different context, had I taken a different path. So I actually spent my background in college. I was in economics, and I did a master's in statistics. So very much thought I was going to be a kind of a quantitative finance guy. Spent some time at UBS trading options, exotic options, and but then I ended up going to get a PhD, and then the financial crisis hit. And I found myself looking at different prospects and was offered a position at Harvard Business School and had a couple other offers and thought that would be something interesting to try it very much. I didn't know if I would ever be truly meant to be an academic, but it turned out it suits me very well because ultimately I get to explore the same kinds of questions that I'm interested in the financial world, but I get a lot more time to delve into them much more deeply. So it's been a lot of fun.
Right. Okay. And how long have you been doing this for now?
This is I've been on the faculty of Harvard Business School for eight years. In this book, kind of strangely enough, actually has been continuing that entire time. It actually originally even began as I was a graduate student. So this project is very much one that's my entire life as a scholar.
Let's talk about the book. Like, what motivated you to write this book? What sparked the idea for it?
Well, it started out not as a scholarly project or intellectual endeavor. It started out very much as, I'll say, a question of a personal interest, the same that I think many people have. So actually, as a graduate student, when I was actually finishing up my dissertation, a big empirical data set looking at how dissemination by the media affects the volatility and cost of capital for firm shares. So a very kind of traditional asset pricing type project. I'm up at 3 a.m. watching TV, desperately trying to stay awake while I wait for some regressions to come out. And I came across a show on MSNBC called Lockup. And it's a great kind of show to watch at 3 a.m. That's a cross between a reality TV show and a documentary. And they go into prisons and basically interview people to understand what happened. And most of the people on the show are violent offenders, murder, assault, rape, things of that nature. And I'm watching this show and thinking about the people that are kind of closer to my heart, which is as a financial economist, I'm thinking about all these business leaders, people that I, like others, looked up to, people that were on the cover of Fortune or on CNBC talking, the titans of industry. And I was watching the show and just wondering if they were in this position, what would they say to some of these questions? These are the people that we hear so much about. We read, we hear from them when they're successful, but all of a sudden when they've made some errors and are sent away to prison, they disappear and we never hear from them again. And so that evening, out of just personal interest, I sent some letters to a couple of the people from Enron and Tyco that came to my mind that were very much still in the news at the time, 8 years ago. And went back to my dissertation work. And then A couple months later, I start getting letters back from people. Some started responding to my questions. Others, like the CEO of Tyco, Des Kozłowski, said, "Sure, I have time now. Come visit me and we can chat." And it's actually just from that really just personal curiosity of trying to understand what's happening here that this project was created.
So what sort of things were you saying to them in the letters?
Really, I think open mind and curiosity. So I would start saying, as I joined the faculty and I was writing people, I'm a faculty member at HBS. I'm a financial economist at heart. I've looked at your career and you did a lot of amazing things, impressive things. But simultaneously, I'm also trying to understand what happened. How did you end up in the position you're currently in? And could you spend some time and could we kind of just walk through things? And I'd like to better understand your perspective. I think one of the things that probably made that helped me create these conversations and kind of spurred interest on the part of people I was writing, people who were in some cases uncomfortable talking originally or haven't spoken to people in the media, is that I did commit. And the nice part being an academic, I didn't need to just have one conversation like a journalist and then have to write an article at the end of the week. I could commit that I would spend as much time as I needed to really try to understand their perspective, whether that was days, weeks, months, in some cases a couple years with some people, before I really felt I was understanding their perspective, because that's ultimately what the goal of this project was, is to put myself in their shoes and try to see the world as they saw it and convey that to my students and ultimately people that read the book.
So when you initially sent letters to these people who you've documented in your book now, did you actually have intentions of writing a book at that time, or was it still just general curiosity?
No. This definitely didn't start as a book. If anything, quite. I think had I realized how much time and effort that I would ultimately spend this project, I might have run the other direction. It started as, genuinely just as curiosity. I thought I was just going to have some conversations because it would just make me a more informed person. Frankly, I still do this now in a variety of other contexts. When I'm trying to learn about a new industry, I write leading people in industry and want to sit down and learn from them. And the same thing, if we want to understand successful people that have ended up making some mistakes, oftentimes quite significant mistakes, I think we need to spend time and speak to those individuals in the same manner. And then what kind of got the ball rolling is that one of the initial letters I received back was from Stephen Richards, who is the global head of sales of Computer Associates, an Australian, actually originally before he moved to the United States. And in this really articulate and I think thoughtful and reflective letter, he described some of the pressures and challenges that he faced. And I took this letter with Stephen's permission and actually wrote a Harvard Business School case around it. Basically, just literally reprinted his letter and then wrote the context behind what was going on at Computer Associates. A really kind of, I could say, subtle fraud in that they didn't make up anything, but rather they had contracts that came in on Monday and Tuesday, and they backdated them to the following Friday to make them go in the prior quarter. So a pretty, you could say, different from some of the more, larger and egregious frauds. But ultimately, because of this backdating for a few days, 8 senior executives went to prison for quite lengthy sentences. And so I took this letter that Stephen wrote. I wrote this case, and we taught it as the last class in the MBA curriculum at HBS. And students and my colleagues had a lot of interesting things to say after the hour-and-a-half discussion with ultimately 900 students read this case the first pass through. And it's still today, what's interesting, from this one case, this is now still taught to everyone that comes through HBS. It's taught at the end of the first semester for all the MBA students. And then it's taught in many of our executive programs, and it's taught it now around 60 other business schools around the world. So this really thoughtful letter is kind of it after actually hearing the discussion and questions that students and colleagues would ask me after doing this case discussion, that I realized there might be something really here more substantive than just a kind of personal curiosity, that learning from these executives' perspective, we might gain a deeper appreciation for some of the challenges and mistakes that they faced and made. So this is where I started delving more deeply into both the background about what might be going on, the psychology, the sociology, the different literatures that could explain this. And then simultaneously, I really started speaking to many more people to get their perspective.
Right. So it's evident that some people were responding to your letters, but, generally speaking, how willing were they to speak with you, or was there some hesitation? Because I imagine that most of them probably weren't overly proud of where they've ended up.
Yeah, I think this is one of the, I'd say 90 plus % of the individuals I wrote ultimately ended up speaking to me. There was 2 or 3 cases where people still had ongoing litigation, and for that reason, they didn't feel comfortable talking. I'll say in some cases, even people with ongoing litigation were still willing to chat. And there were 2 or 3 other people that were just simply, I think this was just such an overwhelming experience for them that they just literally couldn't bring themselves to speak about it. But by and large, people were willing. What I learned is that no one was, except for a couple unusual exceptions, no one wrote back that they were excited to talk about this. What they write back is saying, this was challenging, but I think I see that there's an educational benefit for helping students. Some of these people are graduates of Harvard Business School and Wharton and some of the top business schools. And so they do feel that there's things that they can share, both with the mistakes they made, but they also think, and I agree with them, that there are things that they could share about some of the better things they did in their career. So in most cases, when I would start talking with people, we wouldn't jump in and talk about the challenging parts in their life. What we do is spend many conversations, oftentimes, talking about how they got from college or even out of high school. How did they go from those modest beginnings to becoming a corporate superstar? So talk about the things in life that were actually really successful, that not only served to help me understand their background, where they came from, and some of their actually quite innovative things they may have done that were entirely appropriate, but it also helped build a relationship that we were able to then understand one another and actually kind of delve more deeply into various things.
And one of the people who I believe you spent the most time with in creating this book was Bernie Madoff, probably also the most publicized character. For those who may be unfamiliar, bring us up to speed with who is Bernie Madoff and what is he infamous for?
Yeah, so Bernie Madoff is will go down, at least I think in the history and certainly for quite a bit, is the mastermind of the largest Ponzi scheme in history, in on the order of $20 billion in terms of you could say misappropriated assets. Now, what's fascinating about Madoff's career, though, is that he actually began in the 1960s is kind of coming from a fairly middle class, nothing from an extraordinary background, but kind of started with these off exchange, over the counter securities. He came up kind of from nothing, so to speak, and from this built a brokerage firm that actually was extraordinarily innovative. In bringing in electronic trading, things that we take for granted today. Many of those innovations were led by his firm and then later the NASDAQ, which he became chairman of. He also was one of the pioneers of paying for order flow to help divert order flow from the main exchanges to other exchanges, something that we also now take for granted, that there's a lot of different exchanges where people can competitively trade securities. His firm also helped lead the practice of decimalization, of actually bringing down spreads, something that every trader can appreciate, of not having these extraordinarily wide spreads just by definition in every security. So his firm paved the way in a number of these regards. At one point, I believe it was in the 1980s, his firm traded actually 10% of all NYSE listed stocks off the exchange. Just an extraordinary volume. And so against this background of building a really quite remarkable brokerage firm, Madoff also created a investment management business and a kind of, you could say it started out as a side venture alongside this brokerage business, but ultimately grew to become this rather extraordinarily large fund in the tens and tens of billions of dollars that would ultimately become the heart of the Ponzi scheme. And it's for that we now, I think, remember and think about Madoff. And, one of the things that makes him different from any of the executives I spoke with, but then you could say any executives that have been convicted, is not only the size of his fraud. We're talking, if we go the second and third largest, looking at like Allen Stanford, we're talking there $5 billion type dollars. Madoff's is quadruple that. So we're talking a huge magnitude. But simultaneously, Madoff's victims were also people that in many cases he knew. These were family, these were friends, these were individuals that were close within the Jewish community. And that's what makes his fraud pretty exceptional, is that these are not distant, abstract victims, like when we think of insider trading, people that you can't even really identify. These were close, intimate contacts. And I think it's unraveling how he could do that to people that were trusted him, that were so close to him, that really has created so much I think fascination and just kind of horror about what he did.
So what exactly did he do wrong? Like, how does a Ponzi scheme work?
Yeah, so the basis of a Ponzi scheme is it's misappropriating assets. So, I mean, in his case, how it would be billed and how he described it would be quite this mundane description at first is a, quote, books and records violation. But essentially it starts with the fact that he was trading for securities. Specifically, you could say he likes to think of it as he was naked shorting a strategy to clients, but ultimately not repurchasing those shares, and ultimately had a capital violation. In that regard, it's not something you could say that exceptional. That's a regulatory violation to the extent that you have more securities. Basically, you're over levered, but you don't have a sufficient amount of capital. That's a violation, but that's something that many institutions run into. Now, what firms normally do in that case is you then get your capital under control. You do something to fix that problem. You raise more capital. Let's say you get out of that. Now, in Bernie Madoff's case, what he did is, in some sense, he continued kind of doubling down. And the problem is you do that and you keep having more losses. He basically was trying to tout and sell a strategy to people that ultimately wasn't successful. This notion of it's a strict something he called the split strike conversion. It's kind of an option arbitrage based strategy, and he ultimately wasn't able to trade that profitably. Now, ultimately, it seems like he was doing some trading for clients throughout the 80s and in even the early 90s. Not completely, but doing some. But ultimately, by the late 1990s, he wasn't trading at all. And this is when it became a true Ponzi scheme, is that ultimately money was coming in the door. So $100 would come in the door, and then ultimately he was paying out 50 of that to investors the following day to satisfy redemptions or other money going out the door. Where it's literally you're taking in money and immediately paying it out to someone else. There's actually no underlying business going on. And that's ultimately, by the 90s, what his business became, which is rather remarkable in that for at least a decade, and potentially quite a bit longer, there was no actually substantive actual business at this investment management firm he was running, despite the fact that it was probably one of the largest. We're talking, there's been various estimates. We're talking $50 billion plus in terms of money money under management, which would place it in the leagues of even some of the largest hedge funds today. But ultimately, he wasn't doing anything with it.
So that last part where you said he'd taken $100 and then pay out $50 to investors, are those investors who are invested with him, or is that someone else? Like, how does that part work? I don't quite understand that bit.
Oh yeah. So this is actually investments for him. So he has this group of investors that he had hundreds of people directly through him, far more even through some of the feeder funds that were giving him money, and they were as additional investors were paying money into his funds. And one of the things about Madoff is people were kind of jumping kind of head over heels over one another to try to give him more money. So. And he would always be saying, actually, I'm not going to take more now. I can't take more money now. But then ultimately, some people he did let invest. And so ultimately, this money that came into this fund would be sitting in this pot, so to speak. And then there would be redemptions. He was creating statements that were going out to people on a monthly and quarterly basis describing rates of return. We're talking, 8 to 12% in a lot of instances. And then there would be redemptions. And the question is, well, where'd the money from redemptions come? Well, the money ought to have come that if you were invested in this fund, it should have been kind of that pot that was designated in some sense to you, that was actually being invested in the securities that were described on the statement that you were receiving. Turns out in his case, actually, that pot, so to speak, wasn't not really a pot. It literally, when someone wanted a redemption of $15 million, he was looking around for $15 million of proceeds that were coming in to pay that money off that was coming in redemptions. Ultimately, what ends a Ponzi scheme is the fact that when the amount of redemptions exceeds the amount of money flowing into the fund. And that's what he ran into, when we talked to 2008, he starts confronting.
So when you say redemptions, you're talking about when investors want to take their money out of his fund.
Exactly. And this could be for their own liquidity reasons, to the extent that very few people were removing money because the returns were not adequate, because they were fantastic. If you actually look at a graph, any of us would jump into that. It's kind of like, it would be like the equivalent today if we could invest in treasury bills at 9%. That would be fantastic. But in some sense, also, you could say too good to be true. And one of the major accusations and also a delicate area, which there's been much discussion about whether some of the more sophisticated investors in some sense look the other way or even reckless in not recognizing that, they were getting for decades these kind of consistent, 8 to 10% returns, which, as has been shown, was totally infeasible with the strategy that he was touting, that he was actually trading in and selling to people.
Right. Okay. So the returns looked really good on paper, but in reality, the money actually wasn't even there. Is that correct?
Yeah, the money wasn't there. I mean, he would actually produce a statement, and I actually got one of these statements from eBay recently. But the statement would show a list of the various essentially calls and put options that he purchased, and then this underlying basket of S&P shares. But what if you actually look at so on the statement, it describes exactly the calls and puts that lead to the particular rate of return that investors expected to receive, the 8.6% they thought that they received that month. Turns out, though, this statement simply reflected a after the fact creation of some securities that led to that output. He actually never invested in any of those call options, any of those put options. In fact, if you actually look at the amount of money, the tens of billions of dollars he had invested, it was not actually even feasible for him to be running the strategy, because he simply had too much money to actually, he would have overwhelmed those various markets.
So how did he benefit from running this Ponzi scheme?
Well, I mean, that's an interesting question to ask now, given he's serving a 110-year prison sentence for it. But I'll say, you could say at the time, he was one of the most respected individuals in the securities markets. This was a guy that had a kind of the creme de la creme of investors wanting to give him more money. He was the leader. He had leadership positions in many of the most prestigious organizations. For example, the chairman of the NASDAQ. He was someone that regulators called. When the SEC wanted to talk about the changes that they were going to be making to the securities market, you would pick up the phone, you'd call the major banks, you'd be calling Goldman Sachs, you'd call Merrill, you'd also call Bernie Madoff. So he was a well-respected, admired leader in the securities industry. So that's one. Two, he also was very, very well paid. Even by the 80s, he was acknowledged as one of the higher paid people on Wall Street. In large part, it seems like at that point, actually, from his brokerage business. But obviously, to the extent that he was taking in billions of dollars to his investment management business, even taking a small spread, which is a question that people often ask, is hedge funds today charge, the common is still 2 and 20%, so 2% fees off of assets under management, and then 20% of profits. Bernie Madoff didn't do that. He basically was kind of like running a hedge fund, but in some sense of charging 2 and 20, he said, all I want to be paid for is for the trades that I do. In some sense, trading commissions. And that always struck people is, on one hand, people thought that he's just this generous guy, that he was doing so well that he didn't need to make more. He didn't need to take 2 and 20 and make, hundreds of millions of dollars a year. He'd be happy with, the modest, quote, millions of dollars a year that he would make from the trading commissions. I think we now look in hindsight, and the reason why he was taking, you quote, such a modest amount is simply because he wasn't actually doing anything. If he would have taken 2 and 20%, this would have capsized much, much earlier, because he would have been just taking so much out of the fund. But ultimately, he became wealthy because of this. So prestige and wealth are the things that you could say the benefits while this was actually ongoing. But I don't think that actually is what, you could say motivated him to start a Ponzi scheme. I don't think, even though I think is generally regarded as kind of the number one villain when it comes to harm done in financial markets, as a white collar offender, I think saying Bernie Madoff designed a Ponzi scheme and tried to create this is giving him, frankly, just far too much credit. There's no one that could have actually designed a Ponzi scheme that you could knowingly say would last decades and taken tens of billions of dollars. That's almost too brilliant of a thing to do, in a sinister way. What happened here is a series of mistakes, one leading to another, that got larger and larger, and because of a combination of his unique personality, which actually allowed him to, I think, allowed people to trust him very easily. I mean, he's a cordial, friendly, very, very smart individual, which allowed people to trust him. And then a series of, in some sense, luck. When regulators looked at his business a number of times, they overlooked a number of things that could have been red flags. And then ultimately, he just was able, as he describes it, it's a comedy of errors. But what really is it's a kind of just really tragic way of seeing a person who's incredibly smart and clever ultimately use that information and knowledge to perpetrate a really damaging Ponzi scheme that, ultimately for both friends, family, and the larger investor community has had so much harm.
Okay. So at the end of the day, how were his investors hurt or damaged by this?
Yeah, so the investors that were directly invested directly through him, and then there was another group that was invested through feeder funds, basically smaller investors that were being aggregated together through these feeder funds and then investing in him. Ultimately, when his Ponzi scheme unraveled, the question is, well, what was left? There actually wasn't that much left. There was actually, I believe, a couple $2 billion, which, yes, that's a lot of money, but that's not a lot of money considering the tens of billions of dollars that ought to have been sitting there. Ultimately, his fund was basically put in you could say, almost like a receivership, and a lawyer has basically been going after people that profited from that basically took out proceeds over time, profited from the fraud, and has been suing them to get their money back, in some sense, re-put in the hole, and to help repay investors that, in some sense, you could say lost everything. Because immediately after the fraud was revealed, the question is, was there literally anything left? People that had their life savings in some instances, some of the smaller investors, to even some of the wealthier investors that lost, we're talking millions and millions of dollars in individual accounts. So in that regard, it was pretty devastating to individuals that really trusted him as a leader in the financial markets.
So how did things come unstuck? Like, how did Bernie Madoff get caught out on all of this? Like you said, it was able to pull this off for over a decade or something like that. How was he able to do that for so long, and how did he come unstuck?
I think a series of there was a number of times in which he nearly got caught. So in 2006, actually, the Securities and Exchange Commission actually brought him in and for a deposition, because there was actually some accusations that he actually might be trading in front of some of his brokerage clients. Some people thought that one way to explain the fantastic returns of his investment management clients is that he was essentially using the data and orders from his brokerage business to allow people to front run. And that's what was producing it. So the SEC went in and basically brought him in and questioned him and looked into whether it was front running. at the end of that, they actually asked him where all the assets were being kept at this depository bank, and he actually gave them their account number. And he described how when he was coming home and he was thinking about it, he actually thought the game was up at that point in time, because he gave them the depository number, which had the regulators actually called and actually tried to verify that information, it would have been there was a problem of missing zeros. He had in the order of a couple $1 million of securities there, where one hedge fund that was invested in him should have had several $1 billion in that account. It was so wildly off. But ultimately, in that case, and regulators didn't look into that. And the interesting part is, well, the question is why, and there's been a lot of questions. A lot of people have been very, very critical that the SEC and others may have, for overlooking this. At the same time, Bernie Madoff was such a well-respected individual in the financial industry that to think that this guy could have been doing a Ponzi scheme at the time, that the guy that's the chairman of one of the largest exchanges in the world was basically nothing more than a fraud, is almost so inconceivable, so unbelievable that it's not really a plausible hypothesis. And so they were looking into front running, something that would be, you could say, he might have been doing sometimes. It could have been plausible. So they looked into a much more plausible charge. But ultimately, they didn't find any evidence of that. And as Madoff reflects, the reason they didn't find any evidence of front running is because he wasn't doing any trading at all, ironically. And but ultimately, so this is 2006. Ultimately, a couple of years goes by, and frankly, the scheme could have gone on potentially longer had it not been for the fact that as the financial crisis emerged, what happened? A lot of institutional investors, a lot of individual clients started to need to withdraw money. And so he ran into the problem of basically cash flow issues, that he needed additional inflows, significant inflows, to maintain the amount of outflows, and reached a point where the redemptions were going to get to the level where it was just unsustainable to continue to run the Ponzi scheme. So it's that point in which he, as it's described, told his sons and ultimately called regulators and quote, turned himself in for running this.
Is that really what happened? He actually turned himself in, did he?
Well, it's along with, I could say, technically, I believe his sons are the ones that technically turned him in. But ultimately, it was a family matter, in that he wasn't caught red-handed by an auditor or a regulator. The reason why that week, or that day in particular, everything unwound is because he, along with his sons, alerted regulators to what was going on.
Right, okay.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay.
Fathom blatantly ripping off our family members and close friends and that sort of thing. For him, it seems like it wasn't really an issue.
Yeah, the first time, I remember, my first conversation, you've read so much about someone like Bernie Madoff. It could, international news, for my first conversation, it was a couple years after he was convicted that I first spoke with him on the phone. This is someone that you've just read so much about that you wonder what is this guy going to be like? Is he going to be angry? Is he going to be reflective? What's his personality? What's kind of fascinating about Madoff is I would say my interactions with him have been he's cordial, he's smart as a whip. His memory, his ability to talk about detail. To go into the understanding of nuances in the financial markets, to really delve down. In many ways, I can say I think we've come to relate to each other in some ways in this academic sense that we can talk about really detailed things in the securities market. I mean, he's read papers and books that I assign to my students in class are things that we've spent time talking about, in part because I want to see how he thinks about matters that are not around his case, but the security market more broadly. He's a smart guy, and cordial. But that's simultaneously, I know in the back of my mind, I'm entirely aware of what he's done. And frankly, he has an awareness of it, but it's in a very kind of distant sense. I mean, once he reflected that in a quite genuine way, he said, I've often wondered, I can't believe how large these losses became. Like, it's just so unbelievable. I don't know how to explain how I did this. And, is there a flaw in me? How could I have done this? And I think my time with him is in some sense been that self-questioning of trying to understand why a career which could have in many ways led to a prosperous and career of where he would have retired as a successful, well-respected executive, ended up now he's known as the greatest corporate villain, and he's going to die in prison, which is something which he doesn't express anger. I think I think he'd be the first to say that he deceived people, and so in some sense, the fact that he broke the law, his punishment is justified for that reason. And he doesn't hold, in some sense, a grudge, which is what also distinguishes him. That someone that's about to be imprisoned for life and never have any of those comforts that he spent his entire life around, he's able to take that in a way that kind of take those punches in a way that is, I think, different than how most people would be doing it, which would be a form of a crisis, which is actually, I think, deeply revealing about his personality, is how he's able to kind of confront these just radical situations with a degree of almost unusual calmness.
Yeah, it's certainly an interesting tale. Another character who's profiled in your book is Michael Rand. I'm keen to hear a little bit about his story. I think what's interesting about him is he was someone who you got to know, and he was one of the few executives persecuted from the 2008 global financial crisis. What was his story?
Yeah, Michael Rand's case is fascinating, and it's not one that made the news as much, in particular because it was post-financial crisis, and there was already so much news of trying to understand what was going on. But so Michael was the chief accounting officer at Beazer Homes, a fantastic home builder that was doing spectacularly well in a post-2000 period as there was the mortgage boom. And what Beazer did was actually build homes and housing districts. They were the type that would build, the nice homes and then build the roads in the community around these homes. Business was doing fantastically well. Actually, the problem, if anything, you could say, was they were doing so well that every single quarter they were just blasting past estimates of both analysts and their own internal estimates of how well they were doing. And that actually became a source of challenge, which is ultimately where kind of Rand's case becomes both interesting and a turn for the worse. And so in his case, when the firm was doing very, very well, one of the things that he had to do was take reserves for the amount of expected expenditures to complete houses. So Beazer finishes a home, and after they sell it to the customer, there might be some additional paint work that has to be done. There might be some pipes that are leaky that need to be replaced. And so, like most firms, they would actually put a reserve associated with this additional work. And ultimately, Michael was brought in front of a judge. So, ultimately, mortgage crisis happens. Beazer, is struggling like most other home builders. And ultimately, he's indicted for what would be called cookie jar accounting. And he was being held responsible for not over-reporting earnings, as almost is invariable case, but actually underreporting earnings. And the charge against him is saying that when Beazer was actually doing so well that he basically instructed his executives, his subordinates, to basically over-reserve. and in over-reserving, try to actually lower earnings for the firm so they wouldn't blast past estimates as significantly as they were. And it's a pretty interesting case because I can't think of very many instances in which an executive is actually is ultimately, being in part criminally held responsible for underreporting earnings. But what makes this case even, I think, more interesting is if you actually look at how he was prosecuted, the attorney starts out the case against him saying that a accounting officer is like an umpire at a baseball game. And the umpire is supposed to call the balls and the strikes as he sees them. He's not supposed to look at the scoreboard and then decide whether it's a ball or a strike. And what the prosecutor said is that what I'm going to show you in this case is that Michael Rand was like an umpire who looked at the scoreboard and then decided whether something was a ball or strike. Now, what's interesting is to the extent people know a little bit about how accounting works, managers actually have discretion and actually have a fair amount of discretion, both under U.S. GAAP and under IFRS. And so the case really hinged around whether he actually used discretion within a kind of appropriate guidance or or outside. And if a lot of the emails that were brought up, for example, he sent one email that was sent to the executives that said, to the executive, it said, please put all the reserves you reasonably can. This quarter is too high. Now, as prosecutors looked at it, they said, Michael Rand expressed a normative judgment. He said this quarter is too high. Therefore, anything that his executives did with the accounting estimates were fraudulent. As Mike looks at it, he looks at the emails and said, I said, take all the reserves you reasonably can. To the extent executives stayed later and found more opportunities for reserve, that's totally appropriate. And it is. That's something acceptable within the accounting system. And to the extent that he said this quarter's too high, that's simply expressing a judgment. But it's not wrong simply because you have a judgment of whether this quarter is good or bad that makes an estimate right or wrong. So it's a really fascinating case because it really challenges our notion of actually what discretion managers have when they make these estimates for quarterly or annual earnings. And that you can actually be held accountable for not just fraudulently overstating earnings, but this is a case where someone's actually being held accountable for underreporting earnings. So it's a really interesting case and one that for Rand has been significant. He actually just started serving his sentence, which will be upwards of 5 years earlier this year.
So what was his motive? Like, why did he want to underreport earnings?
Yeah, I mean, he would look at it was never underreporting. He was saying he was using his discretion to, in some sense, to use his appropriate discretion to try to slow the growth. And the reason why you'd want to, slow the growth is because if you start blasting through your earnings estimates every quarter by 30 or 40%, what's going to happen is that analysts are then going to predict next quarter you need to grow by 40%. And in some ways, at some point, you're going to create unrealistic expectations. This is interesting. If you look at Microsoft during the 90s, when Microsoft was doing extraordinarily well, if you go to the earnings conference calls, management was actually trying to walk down analysts in the investment community, telling them that they're not going to do as well next quarter as they have done in the past. It's actually what Facebook is doing right now with their mobile advertising. They're trying to tell the market they're not going to grow as quickly as they have been in the past, because the problem is you can actually build in expectations that become so ambitious or so high that you actually can't meet them. And I think that's what they were worried about at Beazer Homes, is that they were just doing so well that they were essentially making their own kind of a problem. And so what they wanted to do is essentially say, let's be as conservative as we can with our accounting. Therefore, we don't want to be pushing it in any way to be aggressive. But if anything, we want to be the other extreme. We want to be overly conservative to try to slow down this just extraordinary growth we're showing to the market.
So, I mean, it would be fair to say from what you've learned from speaking with him that he had no intent of doing wrong?
Well, I think that comes to the question. I mean, there are different ways to interpret. I bring the emails and I show students and the email that says, take all the reserves you reasonably can. This quarter is too high. And if you ask a class of people, executives, say, how many of you think that this email is intentionally manipulative? how many of you think that this is perfectly acceptable? You'll see it'll be 50-50. Half the class will say this was the intent to do wrong, but trying to be clever about it in saying he's saying it's reasonable. The other half of the class was saying he said it's reasonable. This is the kind of stuff that firms do all the time. You need to be aggressive as a corporate manager. And so to the extent that you say, it's reasonable, there's actually nothing wrong with that at all. He's not even trying to be clever in this instance. And so I think ultimately, and I think this is the challenge, talking to the executives, we can never really know exactly what their mindsets were at the time. And I don't even think they, going back, can actually know exactly what they were thinking at any point in time. What we can do is look at the evidence and what it actually presents. And I think the question that Rand's case raises is if a manager is how much discretion can a manager actually have? So a great example that he actually gave to me, but I think is an important one, is so suppose your firm is about to prepare its annual report and you have some outstanding litigation. Let's say it's whether the government regulators or maybe a private civil suit, and you need to reserve, put in an account, reserve some expected liability associated with these future payouts from this litigation. And you go to your first lawyer, and your first lawyer looks at the charges, or looks at the case, and says, "I think this is going to cost around $100 million to settle." And you go, "Wow, that's a lot. That if we actually settle for $100 million, we're not going to meet our quarterly expectations." I want to make sure that that's that's actually the correct estimate. So you go to a second lawyer who's been just as good in the past at predicting your future obligations. Another great lawyer. This lawyer says it's $50 million. And you go, "Wow, that's better. If we actually do $50 million, that will hit our quarterly earnings." And you go, "Well, let me just get a third opinion." You go to the third opinion, and the third opinion says it's $25 million. Another lawyer, well-respected, has done good for you in the past. The question is, what are you obligated to actually reserve? Are you actually obligated to reserve $100 million, $50 million, $25 million, some average of those three things? In many instances, you could actually say it's up to there's a lot of managerial discretion involved. If you actually ask a class of lawyers, they will actually say you need to reserve the amount that's reasonable. Well, the question is, you have three all reasonable lawyers, and so you can kind of pick one. If you ask a class of managers, they're going to go, "We're going to pick $25 million." Well, the trick is if you pick the $25 million because you shopped around for a different estimate, you're able to meet your earnings estimates. You're going to blow through them, if anything. Stock price is going to go up. But the only reason why you've managed to hit those expectations is because you shopped around for the kind of estimate that kind of works well for you in that instance. That's pure managerial discretion. That's allowed under accounting. That's not actually something we would say is manipulative. But in a way, you could say it's certainly earnings management because you're trying to manage earnings by looking for estimates that kind of work well for you. So it's an example like that certainly shows how complex this is that what makes something fraudulent and what makes something the kind of discretion that managers get as leaders within a firm. It's not always clear cut.
Yeah, no, it definitely sounds like a very complex issue and quite a fascinating one. I mean, I had no idea that companies could use quite a bit of discretion in how they report their earnings. That's new to me. So
another interesting example is like pension assumptions. This was a wildly kind of practice that firms were employing. Is that if you actually go back a decade, if you look at the rate of return that a lot of firms expected on their pensions, they were putting 8 and 9 and 10%, which I think any of us, unless you were invested in Madoff's Ponzi scheme, you weren't going to get a 9 or 10% consistent rate of return going forward. Those were really optimistic. Why? Is because they found someone to justify it. But if they would say the rate of return on their pension assets were 6%, they would have to fund them a lot more. And so it was advantageous to find someone to say that actually an 8% rate of return for your pension assets are appropriate so you don't have to fund them as much. That helps actually maintain earnings. And we actually have some really nice academic work actually showing that firms, when they were actually having a tough quarter, they would actually meet their earnings guidance, not by cutting costs or not even by finding additional sources of revenue, but by changing their pension assumption. And by changing their pension assumption, that influenced their quarterly earnings. So really subtle ways in which firms can and sometimes illegally manage their earnings, and other cases illegally manipulate it.
Right. Well, Eugene, I'd like to narrow in on insider trading if we could. So I guess maybe the first question I should ask around this, and I'm pretty interested to get your take on it. What is insider trading? Like, how do the courts determine whether or not something is deemed as insider trading?
So let me focus on, I'll go according to the U.S. definition, because if we go globally, there's different definitions of illicit insider trading. But the U.S. is by and large where the vast majority, and we're talking probably 90% plus of the insider trading cases, are prosecuted in criminal. I believe actually the U.K., which would be second in insider trading charges, didn't have its first a criminal insider trading charge, I believe, till 2008. So it is really still a very much U.S. phenomenon in terms of prosecution. And in the U.S., so we can think of insider trading as any time an insider, a board member, an executive, an employee, someone with confidential insider knowledge, trades in a firm's shares. Now, a lot of insider trading is not illegal. Executives are allowed to trade in shares. Board members are allowed to trade in shares. And as long as they report those trades to regulators, that's acceptable. However, then there's another form, which is illegal insider trading. And illegal insider trading occurs when people misappropriate information from the firm and trade in it for their own personal benefit, or give someone else to trade with it for their own personal benefit. So the idea is when you're essentially stealing information from a firm, and then you're using that information in some way to benefit oneself outside that context. So let me give an example that shows how, I'll say, tricky this notion of insider trading is. And so one of my, you could say, favorite cases around insider trading, and this is a civil case about a year ago, is a couple analysts at actually Capital One, the credit card company. And these guys were basically acting like a sophisticated hedge fund trader would, that they had this hypothesis that the amount of purchases at retailers like Chipotle, McDonald's, retailers would be correlated with the sales, monthly sales, quarterly sales for the firm. So what they did was basically take the credit card database, there are two analysts inside the firm, basically come up with a very, very elaborate algorithm that would textually search the billions of credit card transactions occurring at Capital One. And they basically found that there was a significant correlation that when more people bought burritos at Chipotle, Chipotle would report better than expected same-store sales, and the stock would go up. This is the kind of sophisticated thing that goes on at hedge funds. Sophisticated textual searching to come up with a hypothesis to try to create tradable strategies. And so these couple guys came up with this and very quickly made just a tremendous amount of money, and hundreds of thousands of dollars. And ultimately, the SEC discovered this and then went after them for illegal insider trading. And the reason this was illegal is because these were two traders who misappropriated information. They took information that belonged to Capital One and then used this for their own trading purposes to personally benefit. Now, what's weird is that there would have been two ways to basically do the same exact thing that would have been legal. So Capital One could have actually hired these two guys and said, you know what? It's okay. We could use this credit card data for our own trading purposes. Can you make these trades on behalf of Capital One? If they were trading on behalf of Capital One and not themselves, it would have been acceptable. But even more extraordinarily would have been Capital One, minus whether they had an agreement with customers that might have not allowed this, but Capital One could have actually sold this data to hedge funds. And in fact, there's actually two credit card companies that actually do sell this kind of data to hedge funds. So a well-known hedge fund trader could pay Capital One $1 million to get these kind of aggregated these records of just not showing the person's name, but just showing the billions of transactions that were done, and just sell it. Let's say $1 million a month to a hedge fund. And then the trader at a hedge fund could have run the exact same search these two guys did and traded on it and probably made millions of dollars. And there are ways of actually legally doing this. And that would not be illegal insider trading. That's actually fully legal. So the weird part is that prosecutors and regulators, not only in the United States, but globally, often say that insider trading is illegal because it harms investors who don't have access to that information. It ultimately makes the markets unfair. And frankly, that's totally misleading, and that's actually wrong. That's not what illegal insider trading is. Illegal insider trading is misappropriating information. There's a whole lot of ways within financial markets to become appropriately more informed than other investors. Using information that they can't access because it's either too expensive or they don't have, and legally trade on it. So this is what makes insider trading so interesting, is that the rhetoric about what makes it right and wrong is actually totally different than actually what the law says is right and wrong.
That's a pretty interesting case study that you bring up there about the credit card data. I mean, that sounds somewhat unethical to me, that Credit One would actually sell, was it Capital One, sorry, would actually sell credit card data to hedge funds.
Yeah, I probably should clarify. I'm very certain Capital One actually doesn't sell that data, but I will note. But I believe it's actually footnoted in my book. If some of your listeners want to look, several companies actually do sell similar data. But we can think of a lot of other contexts. So, for example, there's a number of satellite data providers that actually sell satellite data of parking lots at well-known retailers, the Walmarts, the Costcos of the world. And using satellite data, you can see how many cars are in the parking lot to hopefully try to make better trading insights. There's companies that actually have these helicopters that go over basically oil reservoirs that actually can detect how much oil is actually in the reservoir to give a sense of how much oil is being basically sold and refined in any given month, so people can infer what oil prices will be. I mean, I can kind of give a laundry list of data sources that hedge funds, top hedge fund traders routinely use. Every top hedge fund has access to, because it's expensive data, but it's expensive data if you can afford it and get access to, that actually is extremely valuable. Now, the reason why we say that's not illegal is because hypothetically, me and you and anyone listening could go buy this data. But in fact, many of these data sources are expensive. We're talking thousands, tens of thousands, hundreds of thousands, millions of dollars in some instances. So practically speaking, they're limited to a small number of investors who can actually afford to acquire that kind of insight. But ultimately, it's not illegal because technically you're not misappropriating. You're not stealing it from anyone. You're acquiring it legitimately. But it does get on the borderline between what does it mean to act, could say fairly in a financial markets. But the only reason why someone trades a share is because you believe you have an insight that someone else doesn't have. The only reason you're buying a share is because you think it's going to go up, and the only reason that person is selling it to you because presumably they think it's going to go down. So in some ways, insider trading isn't actually deceptive, because the people who are, let's say, buying shares because they have privileged inside information, they're not being deceptive. They're actually telling the people, I believe these shares are going to go up in value. The trick is that, well, how do you actually acquire that insight? Did you acquire it legitimately or illegitimately? And that's a very, very fine and delicate question, and something that still, I think, security regulators are actually struggling. This is why we've seen a number of cases go in the United States to the Supreme Court, because it is it's a very gray area, especially when you're operating in these very aggressive kind of bounds of really unique data sources.
Now, who are the victims of insider trading? Are there victims of insider trading at all?
Yeah, this is I think the challenging part. Often, most time, people think that the victim of insider trading is the market itself. I tend to find that not especially convincing, because, as I just described, there's a lot of instances in which sophisticated investors are actually trading on information that I don't have all the time. So there's lots of instances where we have information imbalance. But what I will say, the harm of insider trading comes from misappropriating of information. If we actually think of insider trading not as someone having information that I don't have, but rather someone stealing information and then using that for their own advantage, it actually makes a lot more sense of why this is something that we could prosecute criminally and why it's actually serious. So the best instance we can actually think of this from some cases that occurred earlier in the 80s is that when people misappropriate information about a takeover or some M&A event, is that if you have some confidential information around a potential acquisition, if the firm's acquired, the stock price is going to go up. So what do you start doing? You start buying shares in the firm. And if you start buying heavily enough and you tell some buddies about it, you tell some other investors about it, what's going to happen? Those shares are going to rise in price. And what could you effectively do? You either make that acquisition more expensive, or ultimately you could make the firm price go up so much that it makes it infeasible for that actual acquisition to actually take place. So by stealing information from the firm that is thinking of doing that acquisition, you've actually harmed that firm. But that's a really subtle way of trying to interpret who's the victim. And because in some sense, in this instance, we're saying that it's the firm with information that's actually having that information stolen. One of the most interesting cases in the 1980s about insider trading is actually a reporter from the Wall Street Journal who actually wrote a well-known column called the Herd on the Street column. And he actually gave his columns and some of the information to his partner at the time, who actually would trade on it. So there's no evidence that he actually biased his column, but basically this guy would write one of the most influential columns. It was in the Wall Street Journal. It was the kind of column that would move markets. If he talked about, firm X and spoke positively of it, the firm X was going to rise the following day. And what was interesting about this case is that ultimately he was convicted criminally for insider trading. And the question was, well, what did he do wrong? He wasn't trading on this. It was actually just his column that he actually gave to someone. It was a column that he wrote himself about the firm insight that he himself believed. But what the judge ultimately explained is that he misappropriated information from the Wall Street Journal and gave it to someone. And although that's information that he wrote, this is his column belonged to the Wall Street Journal. And the only one that could do anything with that column was the Wall Street Journal. And by giving that to someone else, he could have jeopardized the reputation of the Wall Street Journal. And the only one that had the ability to jeopardize the reputation of the Wall Street Journal was the Wall Street Journal itself. And so this is just kind of shows you how people over time, insider trading has kind of evolved and changed what it means. But this case, you could say the victim was the Wall Street Journal. And the prior example I gave, the firm was the firm thinking of doing an acquisition. But it's subtle. It's not as oftentimes described simply as the quote market that's harmed, like in these instances.
Now, when we think about, I guess, when people hear about insider trading, probably one of the first things that come to mind is, someone who has information who maybe can't trade it themselves, ringing someone else and letting them in on something right away before it's known to the general public, sort of giving them a head start. In those types of situations, there's two parties involved, okay? What is the incentive from the party giving out the information to do so, generally speaking?
Yeah, this is one of the questions that's been evolving about, does the person need a personal benefit? And right now, according to securities law in the United States, the person that's tipping someone off of a hint actually needs to receive something in return. Historically, that's been viewed as money. They actually get some kind of monetary compensation in return. What's interesting is the recent case, which is Rajat Gupta, the former managing director of Goldman of McKinsey and Company. I mean, one of the most kind of celebrated executives in the world. He was actually sitting on a board of Goldman Sachs. And after one Goldman Sachs meeting, he actually called a billionaire hedge fund, Raj Radnatum, and actually divulged some of the confidential information that he just learned at the Goldman Sachs board meeting soon after that call. And so the question was asked, as so regulators went after him, both civilly and criminally, for insider trading, because he tipped, exactly as your example is, he tipped off some information to this hedge fund trader. And then the question became, well, what did he receive in return? Because in this case, he didn't receive any money or a sports car or a Rolex watch or anything. But the court prosecutor successfully argued that he basically received friendship. And so this just shows you how kind of nebulous this becomes. That and he was convicted. He actually recently got out of prison. But in this case, he is appealing his case because his view that there was no personal gain from this, and if there was no personal gain, he didn't engage in insider trading. But ultimately, the jury decided that he did receive something, and that something could be fuzzy, like friendship. Just showing you how kind of diverse these benefits can be.
Just speaking in broader terms now, Eugene, your book that you've written is titled Why They Do It. So, it'd be foolish of me not to ask you, why do they do it? Like, why do people who are already wealthier than probably 99.9% of people commit financial crimes?
Yeah, so most of the time we think of the popular explanation of why successful people engage in white-collar conduct is because it's a failure of reasoning. That coming from the School of Economics, this is that people, like executives, weigh the expected benefits against the expected costs, and to the extent that the benefits, could be money, could be power, exceed the cost, they go ahead. So this is a failure of reasoning. And what I argue in the book is this actually doesn't look like, in most of these instances, so much of a failure of reasoning, but rather, how I describe it, a failure of intuition. The executives themselves don't see the harm associated with these actions at the time they are actually making them. And the reason why they don't see this harm is because the harm itself is so distant. The victims themselves are psychologically and physically distant from them, and the harm itself is temporally offset. At the time they're actually doing the harmful acts, think of something like a Ponzi scheme, people are going head over heels trying to give you more money, putting you in prominent positions. It's not until later that the harm itself is actually revealed. And as a result, because there isn't not that negative feedback mechanism, like if you were to physically hurt someone, because this harm is actually so distant that intelligent, even quite smart people can actually do quite harmful things to the market and actually not viscerally see that harm at the time they are actually making it. And so that's what I explore in the course of the book, and some of the challenges that are associated with that. And at least how I kind of step back and think about that is that we all do things that we know are wrong. For example, anyone that drives, we all speed a little bit, and we find ways of rationalizing the speed limit's too low. We're not going to get a ticket if we're only going 5 miles per hour with the speed limit. We find all kinds of ways. Everyone else is going that same speed. We find all kinds of ways to rationalize why, even though we know what we're doing is wrong, it doesn't really matter. But if you want to know why people don't proceed to do things that are actually significant, is because they feel it's actually harmful. And if you actually feel something is harmful, and a particular act is harmful, you don't even consider doing it. It never even enters your decision set. And this is why, even if right now around the world in my town, we were to drop in Cambridge the prohibition against murder tonight. Police say there's no prohibition, there's no sanctions. I'm not going to be worried if I walk outside that someone's going to come up and stab me. Why? Because most well-socialized people know that stabbing someone is harmful, so it's not even going to enter their set, even if there are no sanctions associated with it. The problem with most white-collar crimes is that there isn't that visceral feeling of actually doing something harmful. And so you can actually do these really damaging things that ultimately harm investors, employees, and ultimately oneself, but not get that sense, a feeling of actually doing anything harmful at the time.
Right. So I take it you haven't seen the Purge movies?
Yeah, it's funny. I watched that just a month ago. It's an interesting hypothesis, but one that not to say I particularly want to test it, but I'm willing to say we could say that there are some countries. This is how at least I thought about it in theory. There are countries where you could say the rule of law is actually so weak in some of the securities markets, but effectively you don't see people running amok and doing everything that would be considered unethical. Countries in Western Europe, for instance, up until the late 1990s, there really wasn't any prohibition in most Western European countries against illegal insider trading, as we generally think some of the most egregious insider trading would be. And sure, there was probably some, but that wasn't what everyone was going to seeking to do in securities markets. Why? Because people had, I think, were reasonably socialized that there's more honorable ways to actually engage in trading. Much like to the Purge, I think there's more honorable ways of probably dealing with our problems than going to stab your neighbor. Fortunately.
I think that was a great analogy. I was just playing around. But one of the things I either heard you talking about this in another interview you've done, or I read it somewhere, but it was kind of getting at the point that, it's very easy for us to judge because we're not in the situation as these people who have been convicted of financial crimes. Do you think that most people in their same situation would have perhaps done the same thing?
Yes. So that's my hypothesis, that in a lot of these, maybe not all, but in a lot of these instances, we would behave similarly. And I think that's the humbling challenge which I pose to my students and to readers of this book. I mean, I think the trouble is we oftentimes think we view the world and questions and ethical decision making with our current norms and beliefs and values and incentives and pressures. But it's not the right way of thinking about how to actually resolve these issues in the context in which these executives are actually facing them. We would need to place ourselves in the position surrounded by their norms, intuitions, beliefs, pressures, culture, which is wholly different. And I think much more challenging. That if I took one thing away from this project myself, it's that to have a little bit more, I think, humility about where I think our limitations, as I described, these are failures of intuitions. These aren't necessarily failures of reasoning. And our intuitions as humans are not well designed to see these distant kinds of harms. So we're all susceptible to doing things that have these distant kinds of harms. Just we're generally not placed into the decision-making context in which if we mess up in one of these instances, it has such dramatic repercussions on other individuals as a CEO or CFO of a firm would. I mean, one of the challenges with, I'll say, corporate training, or you could say business school education when it comes to thinking about ethics and thinking about these dilemmas, is that we may like really easy in these kinds of training exercises that if we're going to talk about an insider trading dilemma, what do? We give you a case, which we then discuss in class or in that training exercise. And in doing so, we've actually made life really, really easy because we've identified what the ethical dilemma is. 2, we've now are talking about it in a group of different-minded individuals. And then 3, we're going to spend a while actually engaging in reasoning, maybe half an hour, maybe an hour-long discussion talking about it. In the real world, all 3 of these things don't exist in most instances. I would actually argue the hardest part for a lot of instances is actually identifying the ethical dilemma, the moral challenge in the first place. Because in a lot of instances, so I mentioned Raja Gupta earlier. Raja Gupta, 23 seconds after a Goldman Sachs board meeting, calls a hedge fund trader and divulges this information. I mean, this isn't something that you really need a case study to decide whether that's a good or bad decision. I mean, this is just a horrendously myopic and really pretty stupid decision. And if I'm confident that if he would have seen this on a sheet of paper talking about it, he would have identified this and probably changed his course of action. The problem is that even someone as smart as Gupta, I mean, really a brilliant strategic mind, could overlook the most basic challenge associated with this, which is identifying the ethical dilemma in the first place. And that's something that I think executives, especially as people go up within an organization, have a more difficult time actually trying to identify which are the kinds of decisions that really could undermine me and my success in my organization. Because it's very easy to believe that I know how to solve these myself, and my reasoning and intuition are going to be spot on each time. Which, in fact, I think the evidence suggests that that's not necessarily the case. So humility is what I've taken that out, and hopefully people that read my book will gain I think a bit of that challenge, and maybe think a little bit, become a little bit more self-aware by seeing these oftentimes just really extraordinary individuals do things that had just such extraordinary and really quite tragic consequences.
Yeah, I think that's a really fair point. Now, those who are living out prison sentences, what sort of life do they lead in prison? Like, does having money afford them any luxuries, or are they mixed in with, the gangbangers and the murderers? What's life like for them in prison?
Prison, I mean, as much as it's easy to say, I think casually because of the harm some of these individuals have done, that a couple of years in prison doesn't seem significant. I would push back on anyone who can kind of casually dismiss a couple of years in prison like that is, I think, being a little too cavalier. Prison's nasty. It's exactly, from my visits, it's exactly like one would expect. It's dirty, it's cold, and it's loud. It's just really, really unpleasant. Being privileged doesn't afford them. It affords them great lawyers to hopefully try to reduce their sentence, to hopefully try to get them out of prison in the first place. But ultimately, once they're convicted and if they're sentenced to prison, they don't get any, you could say, privileges, so to speak, that makes them really exceptional. Other than they have the resources to, call home, to write letters, to get a modest amount in their commissary account. They're fortunate; they generally have better family relationships. People will come visit them, but it's difficult. I'll say the part that I found interesting about this project is that, by and large, the executives were not remorseful. They weren't remorseful about their crimes. They recognized that they did it. They recognized that they were punished, but they didn't. The harm itself never really resonated with them. In part, as I explained, because the harm itself seems so diffuse and distant. But the thing that did weigh on these executives was the impact on their family. It's missing their son's graduation, their daughter's birthday. That's what weighed so heavily on these individuals. But the trouble is that no one thinks, I'll say, even when you're engaging in things that are clearly criminal, the kinds of things that are clearly going to potentially land you in prison, no one thinks that they're actually doing something that's going to land them in prison. People invariably see that's what those are other people that go to prison. Those are the bad guys. It's not me. That's never a position I could see myself in. And that's the problem, is that there are executives that are actually doing things that are going to land them in prison, but they can't recognize it even at the time that they're actually doing it, which makes deterrence challenging in that regard, is because you want people to think about, oh my God, if I do this, I'm going to miss I could miss my daughter's wedding. I could miss my son's graduation, because that would deeply impact, I think, decision making. The trouble is, while these decisions are going on, people are not thinking that.
Mm. Do you feel as though those who you've documented in your book, do you feel as though most of them were fairly prosecuted, or do you think some of the punishments were too harsh?
That's an interesting question. I've thought about that in some instances, where it depends how you want to, I think, look at it. I think by and large they're fair, because the impact of their decisions are really quite extraordinary. At the same time, I'll say, from the standpoint, if we're thinking from deterrence or even the impact on their lives, whether someone's in prison for 5 years or in 1 year, it almost is serving the same in some sense effect of what it's doing. Their ability to actually go back into business in the future is eliminated. Their reputation is gone. The only thing that really, in some sense, impacts by, in some instances, being in prison for 3 years as opposed to 1 is what they're missing out. Which, from my standpoint, missing out on more events in life, their time from their kids and their spouse, it would be, if that was serving a strong deterrent effect, I would actually be, I think, in favor of that. The trouble is, I don't think that's actually serving a strong deterrent effect. As a result, I actually don't know if a lot of the effort which has been created to lengthen sentences is actually serving the objective in which regulators oftentimes have kind of spelled out of why we ought to send to prison people as long as they do. I mean, many instances where I do think the sentences are pretty extraordinary, which I don't know if it's speaking about the white-collar crimes are too long or murder or manslaughter is too short. But a lot of these instances, I mean, we look at sentences like Madoff or even some of the CEO of Enron, they're in prison for longer than people who actually commit certain types of murder, certainly longer than manslaughter, but even people with, second-degree charges. It's pretty extraordinary to think that you could actually be a CEO and engage in a white-collar crime and actually be in prison for longer than someone who killed someone. That I think that's pretty humbling to think that. I think that actually, in one hand, recognizes that regulators think that is that serious, which it perhaps is. On the other hand, it actually suggests that in my view, that maybe people who convict some of these violent offenses, maybe they need to be in prison longer also. It's a challenging question, but these things are, I think, always kind of changing over time. And judges, the one thing I have been happy is that judges have been using a lot more of their, I think, own individual discretion to find out what's the appropriate sentence for individuals, rather than just relying on sentencing guidelines, which oftentimes produce just really odd and really just extraordinary sentences because it's based upon dollar losses rather than the underlying crime itself. Where really people should be punished for the underlying crime, not the dollar, so to speak, because that's in some ways unrelated. If you're a bigger firm and you commit fraud, that's simply going to have a bigger dollar amount associated with it. But that doesn't make that offense actually any worse or better than someone from just a relatively smaller firm that did the exact same offense.
That's a really fair comment. I think you answered that really well. Now, there's one other thing I'd like to ask you about, and then we'll probably call this a wrap. But I guess this probably comes under the category of financial crimes. And I'm not sure how closely you've been following this case, but Nav, the trader who's allegedly responsible for the flash crash, I don't think he's been sentenced just yet, but the latest thing I read is he's expected to serve about 6 years in prison. What are your thoughts on that?
Yeah, I'll say I don't know all the details of his case, so I probably I don't want to unfairly judge without knowing all the details. But I'll say the flash trading is actually pretty interesting in that, going back to our discussion around insider trading earlier, is that there's just a lot of, I think, opportunities in which people are trading on information or trading in ways that we would, if we step back, are saying that would be potentially unfair. A lot of these things are you could say, allowed, or in some cases, just simply haven't been deeply investigated or people are willing to overlook. So a lot of these kind of cases that pop in the news, for example, of this one, it makes me question if we were to step back and rather than having a specific individual, we could say the same thing with the LIBOR case, Tom Hayes in the UK. We have these individuals that become almost figureheads for these offenses, which really represent a much broader, I'll say, cultural and institutional problems that, frankly, a lot of other people are doing things that are similar, but are, for whatever reason, not being punished in the same way. And I think this goes back to what ideally would rather do is, rather than trying to find an individual, is actually think about, well, what institutionally is causing some of these things to arise, and then figure out how to, I think, fairly met out sanctions against all the people that are actually involved in this, rather than a single figurehead. But that's challenging. That requires many more resources. And I think the one area where I'm pretty sympathetic to regulators is that they're under limited resources. So what they have the incentive, and frankly they're forced to do, is not go after all the instances they see, but go after the ones where they have a great case and can create the really convincing evidence to make the conviction. And it's though that particular or two or three individuals that end up being sanctioned, rather than kind of all the individuals that are much more genuinely involved in that type of misconduct.
Eugene, let's leave it at that, man. Guys listening to this podcast, if you want to grab a copy of Eugene's book or just find out more about it, you can go to chatwithtraders.com/whytheydoit, all one word, no dashes, and that'll take you directly to Eugene's book, Why They Do It, on Amazon. So that's chatwithtraders.com/whytheydoit. Eugene, where else can listeners go to find out more about you?
Well, on my webpage, I describe a little bit more of some of my academic work related to this. And slowly but surely, I'm a social media, I'll say, amateur. But I've been slowly tweeting, slowly but surely, about some of the interesting and unusual cases that I do see pop up every once in a while. So trying to highlight, I think, some of these interesting issues that we've been discussing today in some of the work.
A good one. So do you want to give out the link for your website and also your Twitter handle?
Yes. So it's at Eugene Soltis, and then my website, it's at Harvard Business School. So it's either accessible via hbs.edu, and you'll see me pop up Eugene Soltis. And I also have eugenesoltis.com, describes a little bit more and also gives an excerpt, the first chapter of the book if people want to read that.
Oh, very cool. Well, I'll make sure to include all those links in the show notes as per usual. Eugene, thanks very much for doing the podcast, man. This was a lot of fun.
Thanks so much, Aaron. I really enjoyed it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Hey, business owners, the NFL season is a big revenue driver. Now there's a smarter way to get ready. EverPass is the only authorized commercial platform for NFL Sunday Ticket, delivering every live out-of-market regular season comm. Limited time offer. Terms apply.
Chat with Traders is brought to you by Trade the Pool. $200,000 in and join the...
Is the first candidate C.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, boys and girls? Welcome back. On this episode, I am joined by a quant trader who works at a high-frequency trading firm, though you might be surprised to hear he started out on the exact same path that many retail traders do. His name is Dave Bergstrom. Dave is someone who I've followed on Twitter for quite some time. He always has interesting things to share, and I've had the pleasure of speaking with him numerous times also. Now, the thing that I think makes Dave quite unique from most traders who have been on this podcast previously is how he uses data mining techniques during strategy development. Data mining in the realm of trading often has a negative connotation attached to it, but Dave believes this comes from bad practices and poor evaluation of methods. So in addition to data mining and ways to reduce curve fitting, we also talk about escaping randomness, learning to write code, Dave's 3 laws for strategy development, setting expectation, and a few other things too. And lastly, there are 2 links I'd like to share with you. So the first one being buildalpha.com. Dave has recently developed a software package which has the functionality to perform many of the techniques and different forms of analysis that we discuss on this episode. So if you're really into this sort of thing, you can take a look at that at buildalpha.com. And second of all, Dave has kindly offered to answer any trading questions that you may have. So if you'd like to take advantage of this, simply go to chatwithtraders.com/103, scroll to the bottom of the page and leave your questions in the comments area. All right, team, that is it. Without any further delay, please welcome Dave Bergstrom. So, let's start right at the very beginning. What was your introduction to trading? How did you start out?
Oh, geez. So actually back in undergrad, I was on track to go to law school, and about halfway through realized that I wanted nothing to do with law school. So I kind of searched around for, other things that, maybe I could pick up and change careers with, halfway to go in school. And, the market on the side seemed like a pretty good idea. And I had a little bit of a nudge from my father, who worked at Del Monte Foods and was kind of involved with their, corn hedging and all, and all that for their ingredients. But yeah, so just kind of, just see about it, hear about it, think it's an easy way to maybe get rich.
Yeah, so that must have been a pretty big decision for you to drop out of law school and pursue something like trading.
Well, yeah, I mean, just to clarify, I never actually made it to law school. I don't want to discredit any lawyers or law school people, but that was the career path. But yeah, the dropout, I mean, I did have some early success trading that kind of made that decision a little easier. But knowing what I know now, I'm not sure that should influence the decision at all.
Okay, so how were you trading in the very beginning? Like, what were your decisions to buy and sell based upon?
Yes, when I first started, I think I took a pretty common route now. I kind of just searched for information on the internet and found like finance Twitter and all these chat rooms. And
podcasts, which I wish yours would have been around back then. Would have saved me some time. But I was trading basically, chart patterns, momentum stocks. A lot of the popular chat rooms, I kind of been, watching them grow because they kind of all started evolving when I kind of got into trading, which was like, right around and after the financial crisis. So, my beginning trading is much different than how I trade now.
Okay. So, I mean, how did you get into trading? Like, were you working a job at the time? Were you still going to school? Obviously you didn't just make the jump into full-time trading. Like, how, just kind of put things in perspective for us.
I kind of been a hustler, I guess, my whole life. Actually at the time in college, I was selling counterfeit like NFL jerseys and purses and you name it. And that seemed to be some good cash, before, stuff hit the fan. But I was able to put away a decent bit of money that I was able to, fund a trading account with. And I had some help, along the way. Dad, I think, wrote me like a $2,000 check that I've been able to pay back. But, it's humble beginnings, I guess.
Okay. So you said that you were trading, stocks based on momentum and that sort of thing. Is that right?
Yeah. I mean, a lot of chart patterns. I love to draw lines on charts back when I first started. I think, ascending triangles and falling wedges and, flag patterns, pennants, that was pretty much my go-to. So a lot of technical analysis and a lot of, penny stocks. And then I kind of evolved to, I don't know if you call it evolve, but kind of switched paces to, high beta options. So like your Apple, Google, Netflix. And then I was kind of, the same idea. I was kind of just, drawing lines on the options charts or the underlying, and then buying or selling, calls and puts based on whatever my technical analysis was telling me at the time.
Okay. And how were you going through this period? Like, were you doing all right? Were you making money?
Yes, I would have periods where I would kind of, get ahead and get to a new equity high in the account. But I would inevitably give it back. And could never really figure out why. And it just seemed like, it just felt like someone was always out to get me. Like, I'd make some money and then give it back, make some money and give it back. So there's a lot of inconsistency, but, enough success to I think, keep learning and keep, chugging along.
Yeah. So you said that you didn't know why you were giving it back. Now with a lot more experience under your belt, do you understand why you were giving it back in those early days?
Yeah. I really didn't have much of a system, if you will. What really was, I would call it now, I call it escaping randomness. And I never was able to really escape randomness, if you will. So I think if I could simplify it, it's if you have like a coin toss, a coin that's 70% heads, 30% tails. But every time, the first couple flips happen, if they're not winners for you, if you're betting on heads at 70%, you'll make a tweak or an adjustment. But what that does is it kind of restarts you back at, coin flip zero or trade zero. And that's what I was doing. And, you need to flip the coin, 1,000 times to get that 70% to play out. But if you tweak, something and you go back to zero, you're back in those early coin flips that are essentially random.
Yes, that's a very good point. And I guess this is probably around the point where you started to pursue more of a quantitative approach to trading. Would I be right?
Sort of. So actually, I had, big change of heart, kind of change career paths, if you will. And I wound up moving down to Florida and met my boss and wound up taking a job as like a trading assistant at the high frequency trading firm that I work now. I was completely unqualified. I went in there, telling them about how I trade ascending triangles and you name it. And this is somebody that's, worked on Wall Street and worked for Citadel and, a market maker for the CME. And I could just tell that he's like, well, that's not really how I go about it. And that kind of opened my eyes up to, from the way that I taught myself was that there was technical analysis and fundamental analysis. And then I was kind of, my world opened up to this quantitative analysis, this third way, if you will. and that kind of, put me down a whole new path. I had to do it a different way to find, I think, consistency.
So why did you move to Florida in the first place? Did this job come up before you actually made the move, or how'd that work?
I just kind of moved on a whim. Yeah, and God works in mysterious ways, I guess. I can't really explain it.
Okay, so even though you walked into the office of this HFT firm and you were talking about how you trade with technical analysis and that sort of thing, and that wasn't how they do it. How did you end up getting a position there with that firm?
So the initial job was, I really just knew I wanted to be involved with the markets. So I really searched for anything. And this job was really just a trading assistant. So I really wasn't initially doing anything that was, making it to the market, if you will. Wasn't getting any money put behind it. So, like you hear the old stories out, people start off as like a clerk or, a runner on the floor. That's, kind of how I pictured, just in modern times, if you will.
And did you try to get any other trading jobs before you landed this one?
No, like I said, God works in mysterious ways. I just kind of lucked out. Right.
Cool. So once you started there, what sort of things were you doing?
Really getting used to just how to look at data, which is not really something is really, preached in the technical analysis world, if you will. It's, it's more visual, and they were obviously, much more, not much more, but they are data driven. So, I had to kind of, a lot of it was basically like, creating presentations or taking some of the data and then, making nice reports. But it's slowly morphed into where I was able to, do some of the analysis, with basic Excel, or, I taught myself how to program. So it, kind of transitioned into a more useful role, if you will.
Yeah. So when you say looking at the data, can you just maybe go into that a little further? Maybe give us some examples of like what sort of things were you actually looking for? What were you looking at in the data?
Well, I think I don't want to get too much into what we're looking at, but I mean, it's really searching for, edges. You're trying to, find some anomaly or, some persistent pattern that, can maybe lead you to make some money.
So once you did find something in the data that looked interesting to you, like what was the next step from there?
So then you gotta test it, back test it. And then from there, you can make a general assumption on, how good is this system, or this edge or this pattern that I found. And then from there, there's a series of tests that you want to put it through before it goes to the market. But at that point, I really didn't understand that. So I had what I thought I found these great edges or systems. And I was like, okay, I'm now down this quant road. I have these systems that have some data behind them. Let's trade them. And I still had inconsistent success. So it's, the learning process went on for years, I think. I mean, it's ongoing, obviously, but never ends.
Yeah. And once you'd been working in this firm for, a little while, did your prior conceptions about trading begin to change like quite a bit? You'd come from the School of Technical Analysis. Now here you were working in a high frequency firm who was all about just looking at the data. Did your prior conceptions about trading change in any dramatic way?
Yeah, absolutely. Just the whole idea of testing everything. Like, you hear a lot of things like, it's bullish if the market's above, whatever moving average. But it's like now I had a way I needed to test this. I couldn't just say something like that without having the data to prove it. And I think that was the biggest thing is that, there's a book I read, and I hate to give a free plug, but evidence-based technical analysis where, it's basically like there's subjective technical analysis, which is really what I was doing. And now I've transitioned to this objective technical analysis. And I think that's a major key.
Yeah. I mean, a lot of people, when they use technical analysis and they trade in a discretionary way, there's a lot of nuance, if I pronounce that right, to what they do. Was it hard for you to kind of remove that nuance into a way that you could programmatically test it? Well,
I kind of moved away from chart patterns because I think chart patterns are still and by chart patterns, I mean like the falling wedge and the ascending triangle, those things I mentioned earlier. I think those are tough to program and test. So I kind of moved away from that. Other than that, I think, you kind of let the data speak to you. You kind of let the data show you where the patterns are, as opposed to going and hunting. I mean, I'm a bit of a data miner now.
Yeah, and that's something I really want to pick your brain about when we get into things in a little bit. Just before we do, though, what are your views on technical analysis these days? I know you've obviously said it's not something you use anymore, but what are your views on technical analysis?
I don't want to discredit it because, things work differently for different people. And I'll never tell anybody not to pursue anything. I think, that was a valuable part of my journey, and it may be for somebody else. But for me, I think I need something, a little more concrete. I think it's a little voodoo magic, if you will, at times. But I think, there are ways that you can use it to actually, gain information. But it's just, you need to make sure the data is confirming.
Okay, sure. Yeah, I mean, that's a really good answer. So I want to pick up on a point you made a little earlier about how you learnt how to program. And I don't want to brush over this because it's a pretty big deal. Why did you decide to learn how to program, and how did you go about it?
Well, I more or less had to. I wanted to get out of the trader's assistant role, if you will, and kind of move into, the trade desk. If, everyone wants to be a trader. That's why I got into it. And I realized that Excel, really just wasn't going to cut it with the amounts of data that high frequency, firms go through. So I knew I had a program to get to the next level. And to be honest, to me, I think learning to program, it's the best trade I ever made, because if you think about it, the risk on it is very small, but the gains on it, it's asymmetric risk reward, hands down. It's the best trade I think somebody could make. And I look at it now as it's a superpower. I couldn't imagine trading without programming now.
Why do you think it is a superpower, like you say?
I just, for example, you see someone on Twitter, they'll mention a stat, and I can instantly go and program a couple lines of code to look for that same stat, and I have the same information. Or, you have an idea in the middle of the night or in the shower, I can instantly go test it out. Or just the whole idea of data mining in general is I can burn through, and people will probably hate that word, burn through, but I can whip through data and find patterns way faster than you can by hand. It's just such an advantage in so many different ways.
Yeah. So how did you actually go about learning to program? Like, where did you kind of start?
I think I read, a handful of textbooks. So C++ is obviously the main language we were using for the high frequency trading, just for, it gives you the fastest response time, if you will. So I kind of just picked one, knowing now that's probably a fairly difficult one to start with. But I read everything. I watched, YouTube videos, tutorials, Coursera, free courses. There's tons of resources, but I just had to, kind of be diligent, and was lucky enough to find, some people that would answer questions, when you get stuck, because, it's no easy task, but it's worth it.
Yeah. So how long did it take you to become somewhat fluent with our language? I think you said you started with C. Was it C+ or C? One of those.
Yeah, C++. They're kind of learned them at the same time. Really didn't understand the differences when I first started. Never really been exposed to, anything in that field. But it probably took, a couple months just to get like a basic understanding. But I kind of had an advantage of, being around programmers, all day and talking to them, and being in that environment probably made it, quite a bit easier. But yeah, it's a time consuming task, without a doubt.
Yeah. So when you say it took you a few months to become somewhat fluent in this programming language, is this something you were just doing after hours, or is this something you were doing, during the day at your job as well?
Yeah, I actually had the luxury of being able to do it on the job. I'd expressed to my boss, who's I couldn't speak highly enough about, but he was able. He put some basic tasks, if you will, together for me to kind of speed up the process for me. So, I built like technical analysis libraries because he knew that's what I was familiar with in C++. And I think that's probably a good way to start for anybody is, learn how to just read in data and then just, learn how to build a technical indicator, whatever your favorite one is from that, open, high, low, close data. That's essentially how I started.
Yeah. So do you have any other advice for someone who is considering learning how to program, like any tips or pointers for how to maybe speed things up a little bit? Because it is quite a big task, quite a big challenge to take on.
Yeah. I would say to make sure look at a few different resources, because I would read something and be stuck. And then I would read the same concept in another book or watch it, on a YouTube video, and it would completely click right away. So I think, sometimes you just don't see it from the way that author presented it. And the second one is try to find people that do it, that you can ask questions to, because you'll inevitably get stuck. And to me, being able to go to my boss or, someone else and say, hey, I have no idea what this means. And I've looked at 2 different resources or 3 different resources. I'm still stuck, and that you're going to need that, I think.
Yeah, and that first point you made, that's actually a really good point about looking at multiple resources. And, for anyone listening is probably aware that I've been learning how to program over the last 12 months or so. And Stack Exchange is awesome for that because, someone will post a question and pretty much every question you could think of has already been asked on that site.
Yeah, I still use that every day. I mean, that's a lifesaver, without a doubt.
And you see like a bunch of different answers to that question and different ways of doing it. And some ways are a lot easier to get your head around. They might not necessarily be the cleanest code. Usually the easiest sort of things to implement have the code's not as efficient as it could be. But yeah, it's good because you can see, different ways of doing what you want to be able to achieve. So yeah, no, good advice. And why did you decide to learn multiple languages? Like you started with C++. I know you also know, I think it's Java and Python now. Why did you decide to learn more than just the one?
Well, one was we used primarily a few in the office. So that was it was almost out of necessity. But I think it's beneficial because I think certain tasks lend itself better to different languages. Like I think, like the higher level languages like Python and Perl or R are real simple for just doing like the basic data analysis and searching for edges. But, if you really go to implement some highly complex strategy, you're probably going to want something with a little more control, like, C++.
Okay. So for anyone starting out, what language would you suggest?
I think Python. I actually was just talking to a buddy of mine, and he's been talking to recruiters for, quant jobs, and they all are like demanding Python. And to me, it's relatively clean. It's simple. There's so many open source libraries, free resources, and it seems to really be, growing in finance. It's almost like I felt obligated to learn it, to be honest.
When you're talking to your buddy who's looking for people who know Python as a programming language, what sort of other qualifications are they looking for? Are they just looking for someone who knows how to program in that language, or are they actually looking for some sort of higher education certificates?
They did. I think he mentioned, machine learning background is obviously preferred now. That seems to be the big buzzword. But other than that, I think it's probably, statistics, probability, anything math-based, physics is probably, high on the list. But yeah, I don't have much experience, to be honest, with that.
Yeah. No, that's cool. So let's talk a little bit more about your trading, your kind of approach. You hinted earlier that, you describe yourself as a bit of a data miner. Usually that's not a good thing in a trading sense. Usually when people hear that, they think, overfitting and that sort of thing. But explain to us why you kind of consider yourself to be a data miner and why that's not such a bad thing.
Okay. I just think there's just so much information. There's so much data that there's edges out there, but I may never find them just by pure luck. Like, I think, we talked briefly about, if you start with, this moving average cross of a 10 and 20, and I start with, 30 and 40, and yours turns out to be terrible and mine seems to work well. And then you keep searching until you eventually find mine. Are you data mining, or was I just lucky that I found it originally? And I think if you do enough to prevent against, the overfitting, and the over optimization, I don't think there's anything wrong with using the computer as a search tool and to find these edges.
Yeah. So as a data miner, let's just call it that, as a data miner, okay. What are you actually doing to find edges? Like, how are you finding edges in the data? Are you running machine learning algorithms and using machine learning techniques?
Yeah, I've done that, and you can be simpler than that too. But now I just kind of have built this almost master program, if you will, that kind of just you search for a fitness function. Let's say P&L to drawdown ratio or profit factor or win percentage or whatever it is you want. And you kind of just, search all these different combinations until you find strategies that, meet this threshold for that fitness function. So that you say, hey, I only want strategies that have a profit factor over 2.5, and you just run the search program until you find, X amount of strategies over 2.5 profit factor.
Okay, so doing this sort of thing, do you have a hypothesis to begin with? Like, do you have the sort of edges that you might discover? Is there almost a fundamental reason for why that might actually work? Or are you purely just, if the data shows there's an edge there, that's all you need? Yeah,
I don't have one going in. I just kind of am searching, like you said. But if it does seem to make like logical sense after I found these strategies, then I would put a little more confidence behind the ones that seem to make sense on their own.
Okay.
If that makes sense.
Yeah. And just so we're clear here and, we don't lose anyone, when you talk about finding edges, how do you explain that? What are edges in your view?
Oh, geez. We could probably do a whole podcast on this. Like, a simple way would just be something that has a positive expectation. So if you think of like the coin flip game, it's 50-50 chance of landing on heads or tails. But if the payout on heads is 2 and the loss on tails is only 1, then you would have a positive expectancy. And I think that's probably the simplest way that I could explain like edge. Like, that's the most rudimentary, explanation. There's plenty of ways that people define edge.
Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too big, risk-free, before you even pay a cent?
Whether you just got home to an orders of $30 or more, save.
Measures do you take to prevent curve fitting as much as possible?
This is I think the most important.
And, also mention that a lot of
Kroger 2026. Plus members get $0 delivery fees. Order now on Uber Eats. Orders of $30 or more save up to $25. Ends 4/30/26. See app for details.
Now, as we're talking about data mining here, and, also mention that a lot of people, when they hear data mining in a trading sense, immediately think curve fitting. What sort of measures do you take to prevent curve fitting as much as possible?
This is I think the most important part if you're data mining. So a few simple ones. I don't know that I want to give away all the sauce, but I think you need a minimum number of trades, in and out of sample testing, cross validation, where you would basically slice the data into pieces and test on the different pieces, keeping one of the pieces for out of sample and rotating that each time through. Some other ways are, making sure you don't use parameters that lend themselves to optimization, like looking at patterns, for example, is the high above the high of 2 ago is much better than just picking a moving average and finding the best length. Like I think, yeah, we could probably get deeper into that, but that seems to be a big mistake with data mining that a lot of people associate it with just optimization.
Okay. Yeah, well, let's break those few things down a little more. So minimum number of trades, how do you think about that?
Okay, so for every, I guess, rule in the strategy, I would like to see a minimum number of trades. So if I have, 3, 4, 5 rules in a strategy, then I want, at least 500 times each rule. So, 300 trades, I need 1,500 trades. Or 3 rules, rather, I need 1,500 trades, just to make a simple example.
Okay. So do you just want to explain, I think that's a good point you bring up, but do you just want to explain that, why you want more trades for the more parameters or rules that you have in a strategy?
That's tough for me to say. It generally has to do with allowing the law of large numbers to play out and make sure that you found something that's real. Like, for example, if you flip a coin, and again, to go back to this, but if you get 7 heads or 8 heads out of 10 flips, it's tough to say that coin is really 70 or 80% likely to land on heads. But if you were to flip the coin 1,000 times and it came up, 700 or 800 heads, then it's much easier to conclude that that's, not a fair coin. And I think the same thing can be said about trading. If, you only have a small number of trades, it's tough to say that that's a real, robust strategy. But if you, can show that the edge persists over a large number of trades, then you have much more confidence trading that, moving forward.
Yeah. I think it's probably also fair to say that the more rules that you add to a strategy, the easier it is to curve fit as well. Would that be correct?
Oh, yeah, absolutely. Yeah.
So how do you split up your in and out of sample data? Like, do you have a certain ratio that you like to work with?
Yeah. So usually I'll default with 35% out of sample, but I'm actually researching this now because moving that window size is actually resulting in me finding different strategies, which that's obviously I'm still working on why or how or what that means.
So you mentioned something very interesting to me, and that was about how you try to avoid using indicators or parameters that have a look back aspect to them. So that might be the highest high of the last 10 days, just as an example. If those are the sort of things that you try to avoid as rules for your strategies, what sort of things do you like to be the signal, or what sort of things do you like to focus on in your strategy?
Well, without giving away too much secret sauce, I think like non-parametric things, like I think, like counting measures are valid, and things that, I don't know how far I want to get, down this path, but yeah, like I think it's okay to use technical indicators and stuff that have look back parameters, but I just don't think it's smart to optimize those look back parameters. I think if you want to use one as like a regime filter or something like that, that's completely valid, and that's something that I'll do. But to optimize, should it be the 19 or the 27 or the 50-day moving average? To me, that's kind of murky water.
Okay. When you said counting measures, what's that referring to?
Like you could count consecutive higher highs.
Okay.
Or, consecutive, negative closes or something like that.
Yeah. Looking at your Twitter feed, you post a lot of screenshots of kind of signals that your systems are generating. They seem to be very focused around volume and volatility. Do these sort of things play a big impact?
Yeah. The two things that I really tend to like to look at, I think that like market regimes are very important, and I think that volume and volatility are great tools to put context around the market and define, kind of refine, I guess, what your expectations should be.
Obviously mentioned that your Twitter feed there. You posted on Twitter, this must have been a few months or a couple months ago, a really interesting graph. And on the left-hand side, it showed an equity curve just on its own. And then on the right-hand side, it showed Monte Carlo analysis or distribution. And you drew in that Monte Carlo analysis that where that equity curve actually sat. And I thought it was a very powerful graph. I'm actually going to pull it up and I'll put it into the show notes at chatwithtraders.com because I'd really like everyone who's listening to this to actually see that graph. I think it was very powerful. But I think a lot of people perhaps didn't really understand what was going on there. Would you like to explain the graph to us and make it, I know we don't have any visuals to guide us here, but just try and make it as simple as possible to understand what was going on there and why it's important to, I guess, understand this.
Yeah, I think there's like 3 key points that kind of turned my trading around. And I think all of them have to do with having unrealistic expectations. And I think like the simplest example is if you take a backtest drawdown, and then people will kind of size their system or allocate enough money to that system based on that worst case scenario, or maybe they take the backtest drawdown times 1.5. And that's kind of what I was doing, and that just wasn't enough. So then I learned about Monte Carlo simulation, which is basically a reshuffling of the order of the trades in its simplest form, and kind of recalculating an equity curve for each one of those reshuffles. And that's essentially what that graph that you're referring to is. And I think if you look at the single equity curve that I hand drew in to the Monte Carlo equity curves, you could see that back test was at the very top of the distribution, or it was one of the best performers, if you will, of the reshufflings. And to me, people will look at the single back test and think that, oh, wow, this made, I don't remember in that example what it made, but it made, let's just say it made 50 grand in, 100 trades or something, to keep it simple. And if you look at the distribution or the Monte Carlo curves from the reshuffling, 50 grand is highly unlikely to repeat itself in the next 100 trades. So when people begin to trade, they'll realize, after 50 or 75 trades that they're nowhere near that, that they're not going to make 50 grand in 100 trades, and they think that their system is broken. And it's not really a matter of it being broken. It's just a matter that you had unrealistic expectations going into the next 100 trades. And I think looking at that distribution and knowing where your equity curve is in that distribution helps you create more realistic expectations and can contribute a lot to survival and then ultimately success.
Yeah. Now it's a really important point. And like I said, I'm going to dig up that graph and I'm going to put it in the show notes at chatwithtraders.com. It'll actually be chatwithtraders.com/ the number of this episode, which I'm not sure what that is at this point. But you also talk a lot about variance testing. Is this much the same thing, or is variance testing slightly different?
So I have variance testing. It's similar in a way. But I noticed the big problem that I had when I was trading was, if you would have asked me, where do I expect to be in the next N trades, the next 100 trades, 500 trades, I couldn't have answered that, even a few years ago. And it's much more complex than just the average trade amount times that number of trades. You really need to think of it as a distribution or a possibility of outcomes. So this variance testing is essentially, it's like a simulator that takes the winning trades, the losing trades, and your winning percentage, and it creates these 1,000 hypothetical equity curves of where you could be in the next N trades. This is actually software I'm working on building to release to the public. But I think that knowing where to be in the next N trades is really important to success. But then with variance testing, what that is what if you vary your win percentage? Is your strategy still profitable? So what I do is I'll take a back test, and let's say it has a 61% win rate. But I want to know where will I be in N trades if in the next N trades my winning percentage is only 55%? Is it still a viable strategy? And I think this type of simulation is kind of missed by a lot of systems traders. And I think it contributes to the unrealistic expectations. I think you have to have a range of outcomes based on a variety of possibilities, because as we know, the market is never gives you really what you want.
Okay, Dave, well, let's talk about the 3 laws. I think you described it as 3 laws which you trade by. So let's spend a little time on each of these. I think they're each really interesting. Obviously, we were talking about these off air. Number 1 is you said that you much rather prefer asymmetric risk to reward. Would you mind explaining that for us?
Yeah, so I think you need to have bigger wins than losses. I think you want to have long vol characteristics as opposed to short vol characteristics, or probably better to say more like trend following versus mean reversion. Because and what I mean by that is, I'd rather have a lower winning percentage but a higher payoff than a very high win percentage and a very low payoff. Because I think as you move into real trading, you take a system from production and testing and you take it to live trading, the randomness happens and you never really get the expectation from the back test or whatever testing you want to do. And I think it's safer to have the long vol characteristics as opposed to the short vol characteristics. So I tend to prefer bigger wins than losses, and I'll sacrifice a little bit of my win percentage to achieve that.
Okay, that's fair enough. And number two, I think there's probably a better way to phrase this, but I think you said that all bets mean the same thing to your bottom line. I'll let you explain that one.
Yeah. So let's say that you have 10 systems that all have relatively the same characteristics, or you want to take even for discretionary traders, you want to take 10 trades off of the same pattern whenever they appear. It would not be in your benefit to have one of those trades be done with 5 times the size as the other 9, because if that one that you size up on wipes out 6 or 7 other winners, then you're really at a disservice to yourself, because you're really not allowing, and I don't want to give away the third law, but you're really not allowing, the expectation, the math to play out. You're kind of just putting all your eggs in one basket, even though you're making 10 trades. One of them, means a lot more to your bottom line.
Okay, so you're obviously saying this from the position of being a quant. For discretionary traders who do size up on certain trades and do risk more on certain trades, do you think that type of approach is flawed in some way?
Yeah. Like I said, I never want to discourage anyone from trying or testing anything. And what works for someone else or doesn't work for me, may work for someone else. So I'll, disclaim with that. But I do think that that's dangerous. I really try to avoid excitement in my trading. I think trading should be boring. And I want the expectation to play itself out over the 1,000 coin flips, as opposed to having 10 coin flips and you decide you want to bet your whole lot on the 8th flip. That's, to me, that's kind of crazy. If you want to bet your winnings from the 4th through 7th flips on the 8th flip, that to me is crazy. I kind of just want to stay in the game and I want to get to my 1,000 flips, if you will.
So that, of course, leads us into the third law that you trade by, and that is the law of large numbers. You want to execute your edge as much as possible. Do you want to explain that one a little further?
Yes, I think we kind of brushed upon it earlier. And again, to go back to the coin flip, if you have an unfair coin, or it's 70-30, I think was the numbers we used before, and you flip it 10 times, you might find that the tails, which was the 30%, might happen 7 out of those 10 times, or 8 times out of those 10 times. But if you flip that coin 1,000 times, then that heads that had the 70% chance is going to be around 700. And I think it's important, if you do the research and you find a positive edge, to allow that positive edge to play out. If you only do a couple of trades or coin flips, you might not experience what the expectation is just because of randomness. And like I said earlier, you need to escape that randomness. You need to get to a lot of number of trades assure, or ideally to assure, that your edge will play out.
Yeah, so I want to ask you a few questions around this because, this is something I've been given a little thought to lately myself. How do you actually increase the number of trades that your strategy produces?
I don't know that you can take an existing strategy and increase the number of trades. I think you probably have to, change time frames or change, the actual strategy itself. I think that's kind of dangerous water to just try to get an existing idea to trade more.
Well, that's kind of what I'm getting at. Like, because you want to tap into the law of large numbers, will you only trade a strategy that's perhaps an intraday strategy, like end of day strategies? You've only got a limited amount of data and obviously they take a lot longer to play out. Are you only focused on intraday strategies? Are you only focused on trades that, hold for 2-3 hours?
Yeah, I think obviously like the higher frequency data lends itself, to that, the law of large numbers is obviously much better. I think that's why there was such a migration towards that, that industry when computing became so prevalent in finance. But I think it's okay to still trade like daily timeframes and stuff. And I think like the variance testing I do or the Monte Carlo testing I do, if you're happy with those simulation results and they show you that, in let's say, 100 or 200 trades, this is where you can expect to be, and you're happy with that distribution, then that's fine. You can still find, I think, strategies to do that. I just think it's easier to get to a higher number, obviously with higher frequency data. And it doesn't have to be high frequency data, just, half an hour bars, 15-minute bars or something like that.
Yeah, okay. Would you ever consider, like, I don't know how you approach strategies in this sense. Like, do you create strategies that work on one market? Like, you might try to create a strategy that works on the E-mini S&P 500 futures. If you have a strategy that looks somewhat promising on that market, but the number of trades aren't high enough for your liking, are you going to bring in other markets and try and bring those into the basket of markets that your strategy trades on?
Yeah, that's definitely a way to go about it. You can definitely do that. It's not necessarily something I do. I do like to see robustness across markets, but I will kind of shy away from something that I don't think has enough trades. So it's tough for me to say. But yeah, I think robustness across markets is definitely preferred, although not, needed, assuming you have enough trades.
Yeah, and while we're still on this point, I'd like to ask you, how do transaction costs factor into this? Like, is there a point where you are better off trying to make more profit on each trade rather than trying to take more trades? Because each time you take a trade, you've got slippage, you've got brokerage fees and whatever else. Is there ever a point where, it pays to try and look for more profit in each trade?
Yeah, I think it is difficult, with like a retail account to allow this to play out, this law of large numbers, because you do run into very high transaction costs. But I'm not exactly sure how you can really combat that now that I think about it. And I'm kind of, in a situation where I haven't really had to think about this problem in a while. But I think there's probably some happy medium where you can get a strategy that doesn't kill you with transaction costs, but maybe doesn't have, 1,000 trades, maybe only a couple hundred or something. But I think it comes back to that, that variance testing and where do you think it's going to be? And are you happy with that distribution? Is it something you're willing to allow to play out or no? And you have to obviously factor in your transaction costs into that simulation.
Dave, I'd like to ask you a couple questions about high frequency trading, just in general, about the industry. As someone who's on the inside, usually, I guess, kind of in the media, HFT cops a really bad rap more often than not. Why do you think this is?
I hate to be the spokesperson for all of HFT. I think it's tough for me to say. I think a lot of the the bad rap it gets is from like the Michael Lewis book and what people call like latency arbitrage, which is actually not something that we do because we only trade futures through the CME. So we're only one exchange. And I think, the HFT, it's also very easy just to find a scapegoat. The trading is very tough. And I think, sometimes people just look for a scapegoat. I'm not so sure that a lot of the bad rap is justified. But I'm biased.
Yeah. No, that makes sense. And, as someone who is involved in high frequency trading, do you yourself see any negative aspects to it?
No. I mean, I think I'm biased, but no, I don't think, at least from my view, it's like, nothing, we don't do anything predatory. I'm not so sure that I, believe the claims in, that the book I mentioned. And no, I don't think it's bad in any way. I think, if anything, it's probably beneficial. And, I know people can find articles on both sides of this coin. But yeah, from my view, no.
Yeah. So how is the HFT landscape different from equities and futures? Like, is there perhaps some negative aspects about it in the equity space? Because obviously the market structure for futures is totally different.
Yeah, I just think that's like the one area that people really dislike is that the whole idea of, like I said, latency arbitrage, but where people race from exchange to exchange, or at least that's what people are, speculating is happening. And I think that is, that's a tough call, and a lot of different opinions on that, but it's, like I said, it's not something that we do, and it's not something I'm, too versed in, to be honest.
Yeah. And when we were speaking before the call, you said to me that you think the heydays of high frequency trading might be coming towards an end. What do you think the future has in store?
I don't know if it's coming to an end. I just think it's obviously much more difficult as time has gone on, as more people come into the space. And a lot of the strategies, get exposed, or people jump from shop to shop or something like that. But I think it's tough because we kind of have this debate in the office on, is it what I just mentioned? Is it, too many players and too efficient, or is it just kind of a product of the monetary policy, laid out by the Fed and the other central banks? Because that monetary policy, it really isn't conducive to a two-sided market, which is obviously what HFT needs. So it could be a mix, and I'm sure the truth, always lies somewhere in the middle. But yeah, it's obvious. It's definitely getting much more difficult. But to pinpoint my finger on it, I'm not sure.
Sure. Yeah. I mean, I'm actually hoping to get Manoj Narang on the podcast. We've actually been scheduled like 5 times to do the interview, but he's a busy man and hard to pin down. So I'm really keen to get him on and get his take on all of this.
That would be great.
I had his brother on, Rishi Narang, on like episode 54, I think, somewhere around that point, and he was awesome. Big fan of his book also.
Yes, yeah.
Anyway, Dave, this has been really good, man. I've thoroughly enjoyed this. Now, some of the things we've talked about here are a little bit tricky to implement and test and that sort of thing. You've been working on a software package, Build Alpha, I believe it's called. Do you want to just tell us a little bit about what you're working on and how listeners might be able to benefit from using that?
Yeah, that'd be great. And I enjoyed doing this too, by the way. Thank you very much for the opportunity. But yeah, I'm putting together some software that essentially would allow. I've been using it for a while, but I'm kind of building a public version that I'm thinking about licensing out. And what it will do is it basically would allow you to select from a list of signals. Maybe 500 at a time, 1,000 at a time. We're kind of working on the memory right now. And it would search for different strategies based on the exit criteria you provide it, and the fitness function you give it. And the fitness function, win percentage, payoff ratio, profit factor, Sharpe ratio, something like that. And all this is kind of built in. And then what it would do is it would search for these strategies and find the best ones given that criteria, those signals, and the fitness function. And then from there, you would be able to view the strategies, their equity curves. You would be able to run Monte Carlo analysis on it. You would be able to do my variance testing on it. And you'd be able to generate tradable code for each and every strategy. And I'm actually working on, being able to create portfolios. You can kind of pick and choose from these strategies it finds the one that create the distribution you like, and then add them to a portfolio. And then you can kind of analyze the portfolios the same way. So I think this is really cool software, and it is kind of like the culmination of, the tools and the process that I go through and have gone through. And I, kind of want to share it, and maybe I can help some people, speed up their learning curve, or, even, find some strategies or get an idea of how to go from signal to live trade.
Absolutely. So where can listeners go to find out more about this? Like, is it available at the moment? Do you have a website up for it? What's the deal?
Yes, I do have a website up. Hopefully by the time this airs, it'll be finished. We're, 95% done, I think. But it's buildalpha.com. And you can reach me at david@buildalpha.com, or at dburgh, DBURGH on Twitter.
Awesome. Buildalpha.com, and follow Dave on Twitter. Dave, once again, man, thank you very much for doing this. I truly do appreciate it.
Hey, man, I appreciate you letting me on. I'm honored. I think you're building something really cool here.
All right. Thanks, man. We'll talk soon.
All right. Thanks. Take care.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Ambition comes in all shapes and sizes. At First Citizens Bank, we roll with your goals because we're built for what you're built.
Chat with Traders is brought to you by the Pool.
What's up, traders? Big thanks for being here. On the podcast this week, I got the chance to catch up with Alex. We will keep his surname private, but he goes by AT09_trader on Twitter. Alex is a 22-year-old discretionary day trader who has seen really great results in the few years he's been grinding away at this. He trades small caps and he trades aggressively. As you'll soon hear, Alex is far from conservative. This conversation was recorded on the 16th of November after the close, right around the time when the madness in the shipping sector was unfolding. So we got talking about the ticker DRYS, how Alex racked up a $40,000 loss a day or two before our interview, although I should also mention he had his first $100,000 day shortly after too. We also spoke about how Alex got started, the types of trade scenarios that he looks for, areas that he's working on to improve, and also his venture into real estate, where he flipped a foreclosure property for a tidy profit, plus much more. Now, I'd like to remind you that nothing you hear on this episode, or for that matter, any episode, is to be treated as financial advice. Please remember, you are entirely responsible for your own trading decisions. And as this is the last episode before the 25th, I'd like to say, please have an awesome Christmas, enjoy time with your family and friends, and prepare yourself for a big year in 2017. Merry Christmas. Now let's go. Here's the conversation I had with Alex. Usually on this podcast, we don't talk specific about particular trades or certain events because it sort of tends to date things a little bit. But DRYS, the ticker for dry ships. This one we can't ignore.
Yeah, it's all over everywhere. Everyone's talking about it. CNBC is even talking about it.
Yeah, this is one for the history books. So, I mean, I'm really keen to get your take on it. How have you been trading it? When did this first come onto your radar?
I mean, okay, so basically I first saw it, I think it was that day, it was like very low volume. I think it went from 8 to maybe 16 or something like that. Slowly started to fade off. And then I really started to pay attention. I think it was the day after when it had a little bit of a weak open and then pushed towards 18. And then from there, I think just it trapped everyone. Everyone got stuck. It was just weird thing. Like I thought it was just going to be like a normal, a short squeeze after a couple of days, come back down. Nothing crazy. We've seen it a million times. All like these big traders that I speak to or I know of, they're all shorting. They're very comfortable. It's like nothing crazy. And then out of the blue, it rips faces off. It just blew my mind. I luckily did not have to borrow for it. So I'm sure I would have been one of those guys that got their balls squeezed too.
So why did that happen? Like, what was the driving force behind this? I mean, even to start off with, $8 to $16, that's a pretty big move in itself. Like, what was the driving force that led it to continue? Because, just to put things in perspective for people who might be unfamiliar with this or who haven't seen the chart, I think it was early November or even October, it was just trading at it was less than $1.
It's a reverse split. It just keeps selling off and then reverse splitting.
Right. And, it went from under $1 to over $100 within a matter of a couple weeks?
Yeah, not even a couple of weeks. I think it was Friday to what's today? Today is Wednesday. It hit 115 today, pre-market.
Yeah, it's a ridiculous looking chart. What was the driving force?
So what I think the driving force was the short sell restriction. I think was a big part of it. So the float is already low. I think it's less than a few million shares, whatever it is. And the problem with SSR is that once it goes high enough, the stock goes high enough, there really is no more sellers to push it down because they're not going to be selling on the bid. They're all comfortable. Everyone's fine. It's just going to be shorts putting it on the offer. As soon as the shorts are done, it's just going to keep ripping and ripping higher. And it's been a long time since we had one of those black swan squeezes. So a lot of shorts just felt really, really comfortable and they just got destroyed. And I mean, I would have been one of them too. If I had to borrow, I would have been smoked as well because we're all used to seeing these charts. We're all used to seeing these parabolic charts. And I guess just sometimes if you don't stick to your rules, all it takes is one day to blow you up forever. It's a scary thought, honestly.
So were you involved in trading this at all? I mean, you said right there you couldn't get the borrows for it, but were you trading the long side?
Yeah, I couldn't get the borrow, but I was trading the sympathy plays. I think it was EGLE was one of them. SINO was another one. TOPS was another one. So basically, the way these sympathy plays work is that they fuel off the main runner. So call DRYS the head of the snake, and everything else just falls in its path. So as soon as the head of the snake gets cut off, these stocks collapse with it. So my thesis was I couldn't get the borrows on DRYS. Why not short the sympathy plays? DRYS is not going to last forever. It's going to fall down. So these stupid stocks should fall too.
Okay, so these other stocks were up significantly as well?
Yeah, I think they were up 30, 40%. This was on Friday. So even before the crazy squeeze started, as soon as the massive squeeze from $30 to $60 to $90 to $100 started, these things started to go ridiculous. For example, I was short SINO. I think I had a $1.90 average or something like that. I managed to cover a few $1.60, and then I started adding your 2 and your 230, and then I was forced to cover. I was losing too much money. Turns out the next day, trading at 3 pre-market, then goes to 4, then goes to 5, 6, 7, and it almost hit 8 the same day. And then sold back down to 5. And now today, and after I was trading, it's above 8. It's at 860. So that could even go even higher. It just blows my mind that, a couple hours ago or a couple days ago, I was covering my short at $1.60 and I couldn't fill all the way. And now it's at $8. If I didn't stop out, that would be the end of my trading account. You know, it's just so scary to think that 1 or 2 days of just stupid trading or irresponsible trading, not sticking to your rules, could destroy you. It's scary. It blows my mind.
Yeah, I think there's a number of traders who have probably been hurt by this quite badly. So these other stocks, when you're talking about these sympathy plays, these other stocks really have no reason to be up by the crazy amounts that they do, other than the fact that they're in the similar sort of industry and sector as, in this case, DRYS. Is that what you're saying?
Exactly. So most of these stocks they're like garbage. So they have to raise money. They have ATM, warrants, everything. They're looking to raise as soon as possible. So my thesis on these sympathy plays is they're usually not going to run as hard or as fast or as high as the main one. So they seem a little safer to short. But when craziness like this happens, where DRYS hits 115, these things just lose their minds. They have low floats, some of them under 3 million shares. And it's crazy. For example, SINO has a float of, 2.8 million. And today it traded almost 42 million shares. The float rate rotated almost 12 times, 13 times. And it just keeps going up and up. Shorts get trapped and they have to keep covering to get out. It's crazy. It really is.
So, I mean, a lot of these stocks are still up quite a bit at the time that we're recording this podcast. I mean, how do you anticipate this is going to play out from here on?
So I guess I want to backtrack a little bit. So if these stocks, are going up, like, why would I short them? Why would I not buy them is what I guess a lot of people are talking about. Like, why not buy it? You have 200% upside rather than, blowing your account or something. And the reason for that is I'm terrified. I'm terrified of buying because today DRYS was halted. What if the next shipper gets halted? And I feel like I'll have that bad luck where the day I buy that stock, it's going to halt, so I avoid it.
Okay. Now, I saw you posted on Twitter, it was either yesterday or the day before, before when we were recording this, and we're recording this after the close, which on the 16th of November, 2016. You mentioned that you lost $40,000 the other day.
Yeah.
I got to ask you about that. What happened?
Yeah, so I was short one of the sympathy plays, EGLE, and I had some SINO as well. So EGLE, I had around 35,000 shares at something in the sevens average. And when DRYS was starting to pull back near like 45, I was confident that the stock was just going to fail back to 5 or whatever, Like I said, we've seen it a million times. Why is this time going to be different? And it just blew my mind when DRYS went from 45 to 65, broke a new high of the day, and I just had to get out of this EGLE stock. I took my loss on that. I took my loss on SINO, and before I knew it, I was down 40 grand. It sucked. It was a terrible feeling, but looking back now, I would have been down 100 grand or 120 grand if I held like an idiot,
Yeah, so obviously I presume that, you didn't anticipate to lose that much money going into this trade. Like you weren't prepared to risk that much money in these trades or that day. What went wrong?
What went wrong? I underestimated the staying power of DRYS. The stock is truly a black swan stock. It's like the KDIO, AQXP, all combined, It just, for a stock to go from 5 to 115 in less than a week is just something that you don't see every day. So these stocks are acting the way they don't. So in my mind, I say, I'm going to short it. I could be a little bit patient. Maybe I'll be down 10 grand. It's not going to be really much of a big deal. But if you don't stick to your rules, if you don't respect the chart, then, you could blow up in a day. It's really as easy as one bad day could screw you forever.
It's very true. It's very true. Anyway, man, let's get into some more. Let's rewind a little bit and let's talk a bit about how you got into trading. I know you've got a unique story around this. So, tell us what led you into trading. How'd you get into it?
Yeah, so basically it starts with my dad. So he came from Turkey to the States in the 1980s with his brother. So he didn't really speak any of the language. He didn't really have much money, but he was an entrepreneur at heart. So he started his own electronics business with my uncle, and it took off. In the 80s, electronics was hot. Everyone was buying left and right. Like, he really made a name for himself, and the money started pouring in. He started making a lot of money. And I guess for as long as I can remember, money was never an issue in our family. My dad had a lot. He worked really hard, and everything came really easy to him. So I think it was in the 2000s or whatever. He had a little extra money on the side, and he said, what do people with extra money do? Put it in the stock market. So he put his money in the stock market, and I guess I was younger at the time. I didn't really understand it, but all I can remember is he just kept making money. He would put in like some blue chip stocks, like nothing crazy, just like, I guess, watch it over a couple of days, not really day trading it, just, I guess, investing. But long story short, 2008, 2009, whatever it was, when the whole economy went to shit, people weren't buying things anymore from the electronics stores, and quickly our lives changed. Everything changed immediately. From having a lot of money, we went to having almost no money instantly. It was just big change. I think I was 15 or 16 at the time, and I didn't really understand it because I was so used to like everything coming easy to my dad. And it's I guess it's just a crazy story. So when I turned, I think it was 16 or 17, I had like a pretty decent car. I bought like some rims for the car, nothing crazy. So I thought in my mind, if my dad was making money in the stock market, why can't I do the same? We don't really have that much money anymore. I don't want to ask him for money. So I sold my wheels for, I think it was like $2,000. And I put it into like a TD account or an E-Trade account. And I just started like playing some stocks. I heard, I didn't find like much traction. I was mostly buying stocks and just losing. I was the guy buying at the top, and it was a terrible time. So I guess I was looking on like the online forums and whatnot, and I found like a penny stocking guru or whatever. So I subbed to him for like $100 or whatever it was. And I said, if this guy could do it, why can't I? What's stopping me? I'm sure I'm smarter than like most people. So long story short, I followed his trades and I lost a bunch of money. So I said, screw it. Trading's not for me. Whatever. I'm done with it. So I got a job at Starbucks. I started working a little bit more. And I said, I'm a smart kid. Maybe the first time it didn't work. Let me research a little bit more and let's see what happens, So I took the money I made from Starbucks. I put it into, I took the money from Starbucks. I bought a subscription for another chat room, and I learned about what shorting was. And this concept blew my mind. I said, if I'm buying at the top and the stock is going down, what if I just short where I was going to buy and, make some money? So there was a light bulb that went on in my head. So I found a broker that allows shorting, an offshore broker. And I put what money I had in there. And I think the first short trade I ever had was, I shorted 2,000 shares of VGGL at like $4. And within like 10 or 15 minutes, the stock went from $4 to $3.50, and I was up $1,000 instantly. And just, I can't explain to you the euphoria I felt. It was just, I was on top of the world. I felt like a king. I made $1,000 like from one trade, and I was hooked forever. I couldn't stop. Shorting became everything to me.
What a story, man. So just backtracking a little bit, when you first opened up that trading account, did you blow up that first trading account, or did you just decide that you were losing too much and that it wasn't for you?
The 2,000 account, I blew it up. I blew it up after a couple trades. It was gone before I knew it.
And was that the only account you've blown up to date?
I've blown up a lot. I can't even count. So after that VGGL trade, I started to pick up traction, and then before you know it, I was doing stupid stuff again. I was shorting anything that was up. I had no rules. I said, this stock is up 20%. Let me short it. What's going to happen? And after I started losing that money, I just kept, I kept working at Starbucks. I kept my job a little bit. I wasn't really making that much, but after blowing up like 5 or 6 accounts, these are small accounts, like say $1,000 or whatever. After blowing that up enough times, I said, what would work on the short side? What are all these big traders in this chat room doing that I'm not doing? Like, what am I missing? What is the golden road? What is whatever it is, what is the secret sauce of trading that I'm missing? And The thing is, I found, I guess the strategy that most people were using was they're shorting stocks that are trash, that don't really have any reason to be up. And long story short, that strategy worked a lot for me. And then I evolved that strategy into shorting the sympathy plays of running stocks. So mostly when these stocks run, like the sectors run, whether it's forklifts, Ebola, whatever it is, they usually have sympathy plays that other people are chasing or wanting to be that next big runner. Most of the time, I guess with smaller accounts, you don't really have to borrow for that big one. So I found that having to borrow for these sympathy plays was not only cheaper, it was also a little bit easier, you know?
So you said that you were trading accounts that were only a couple grand, and I think you even said maybe one was like $1,000. Like that's pretty tough going. Like how were you managing to trade with such a small account, and how did you get around the pattern day trader rule?
Okay, so I use one of those offshore brokers that allows you to have like a $500 account minimum, and they give you 6 times leverage. So let's say you have a $1,000 account, they let you have $6,000 in buying power intraday. So that led to my blowing up happening even faster, you know, because I was playing on margin, and just losers just start to add up and add up and add up until I said, screw it, I can't lose anymore. I'm sick of this. Screw Starbucks. I want a better life for myself.
And now these offshore brokers, that in itself, it sounds very dodgy. Is it dodgy? Are there any risks of using a broker like this?
I mean, I think so. I mean, the whole concept is sketchy anyway, but without these offshore brokers, I wouldn't be where I am today. I didn't have enough money to pass the pattern day trader rule. I didn't have enough money to open up like 3 accounts. I just had to pray that this thing wasn't really a scam. You know, whenever I complained and yelled at them 10 times, I eventually got my money, and the routing was terrible. Everything was terrible. Like, it's just, this pattern day trader rule is such a stupid thing to me. $25,000 to trade as much as you want. Like, it just, I don't understand it. I think it's so stupid.
So now that you're well above that, you're obviously not with an offshore broker any longer.
Exactly.
Okay, sure. Now, I just want to put things into perspective here, because when at the start of this call, you know, I asked you about losing $40,000 just the other day. And here you are, you started out working at Starbucks. Like, just put that into perspective for us. How much were you earning at Starbucks?
Oh, my God. I don't even want to say it because it sounds so stupid, but I was making, I think it was like $100 a week after taxes. I put $60 in my gas tank for my car, and then whatever I had left over, I would spend on my ex-girlfriend. So I basically had nothing at the end of the week.
And how many hours were you working a week?
I think because I was still in school at the time. I was still in like high school and college or whatever. So I had to balance both. So I think I was working like 25 hours a week or 30 hours a week at Starbucks and the rest at school.
Sorry, you're working 25 hours a week and making $100?
Yeah, it was nothing. I was getting paid minimum wage, like as little as it was terrible. Just thinking now that money meant so much to me, and losing $40,000 doesn't even faze me anymore. It just blows my mind.
Man, that's so savage.
Yeah.
Okay, so at what point did you feel comfortable? I mean, obviously there wasn't much risk in losing and leaving Starbucks because you weren't making a whole lot of money. At what point did you make the decision to just go full into trading?
So basically, again, it's going to sound funny, but my girlfriend broke up with me, so I was a little bit upset. So I said, screw it. Why am I going to spend money on this stupid girl when I could be, saving up some money and starting to trade? So after that moment, I guess I was a little bit upset. So I dove full into trading to get my mind off everything. I started researching. I started watching some DVDs. I started to do everything that I could just so I could stop thinking about this person. And it's worked out amazingly. Couldn't be happier.
How long have you been trading for all up, and how old are you right now?
Okay, it's been, I think, 2.5 years. It's going to be 3 years in February, and I'm 22 now. I just turned 22.
That's incredible, man.
Yeah, thanks.
Good going. One of the things which is so crazy about your story is how quickly you've been able to pick this up and get a grasp of, how to trade your way in the markets. I mean, how have you been able to pick up these concepts so quickly?
I guess the best way to say it is I'm addicted to trading. Like, this trading is on my mind 24/7. The first thing I do when I wake up is I check the quotes on some tickers that I'm watching. Midday, I'm just thinking, no matter what, it's always on my mind. Before I sleep, it's on my mind. What am I going to do the next day? How am I going to plan my trades? I'm out with my friends. I'm drinking. I'm thinking, okay, what's the next stock that's going to be in play? How do I nail the stock? What do I have to do to become the best of the best in trading? It's become an obsession in my head. It's become like the only thing I think about. It might not be healthy, but I love it so much that I can't stop. It literally is. It means everything to me.
So obviously you've got a clear obsession for trading. Do you have an obsessive personality, like by nature? Like, does this, can you track this back to things in your teenage years that you were like, that just really obsessed about?
So basically, I guess like when I want to do something, I try to be the best at it, whether it's trading, whether it's in school, whether anything, no matter what, I try to be the best in anything that comes in my way. So with trading, it was a challenge because you could never master the market. The market is always going to be smarter than you. So it just blew my mind that like, no matter how hard I study, no matter what, the market is ever changing. So even we saw with all these shippers, they're blowing everyone's minds because these moves are crazy. They're absolutely nuts. And it's something that we're not used to. It's something that the market is doing. We have to get used to it eventually. This might be the new norm. What if these new shipping stocks are going to happen more often? What if the next sector is, who knows, like coal stocks or whatever, We just always have to be adaptive. We always have to be learning. And the moment we stop adapting is the moment we're done.
So maybe walk us through your typical day. You said that pretty much from the minute you're up till when you go to bed, you're just thinking and obsessing about trading. Walk us through a typical day.
Yeah, so basically, I don't really get much sleep at night. I guess I have like a sleeping problem or whatever it is. So I'm usually up pretty early. So let's say a normal day, I'm up at like 5 a.m. I wake up, check the quotes, go shower, think about trading. What am I going to do? And then I start checking the pre-market gappers to see what's up on the day. I do a little bit of research before the market's open. I usually just hang out like really early, between like 5 to 7 a.m. And then from 7 a.m. to 8 a.m., I'm always like on the screens watching how the stocks are acting, how they're trading pre-market. Like, is there like a trend that's forming? Is there some sort of news that came out? Like, what is moving these stocks? And by the time the open comes up, I usually have a plan set up. Sometimes I write it down on a piece of paper. Other times I just wing it. But mostly I find more success when I just write down my plan and stick to it. So, for example, let's say tomorrow there's these shipper stocks are flying again. So I'll probably wake up in the morning, see how they're acting. Did they gap up? Did they gap down? Which stock am I most interested in? Why is that? And then form a plan. For example, I'm going to try to find the weakest shipper amongst all these stocks, the weakest, the relative weakness. And then from there, I'm going to plan my trades according to the support and resistance of that stock and then get my orders ready. And then by the time the market opens, hopefully if they spike up hard enough, they'll hit my orders and we'll get the day going.
Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance fell to savings? And now you can also have pay a cent. Click
fit for your ambition. First Citizens Bank.
It really shows in my trading, if I'm
in trading so far, what would you say have been the biggest challenges that
we roll with your goals because we're built for what you're building. Fit for your ambition. First Citizens Bank.
In the years that you've been trading so far, what would you say have been the biggest challenges that you had to overcome?
I think it's in my nature to be very stubborn. I am incredibly stubborn no matter what situation I'm in. And that really shows in my trading. If I'm trading a stock with size and it's going against me, I say, screw it. I have the money to sustain. What if it goes, let it keep going up higher? I could take some blood, let the stock kick me in the balls. I'm stronger than that. And it just shows on situations like this, like DRYS. If you're short at, let's say, $30, you have 1,000 shares at $30 short, and it goes to 40. You say, I'm down 10 grand. No big deal. I could sustain that. What happens when it goes to 100 and you're down 70 grand? It's crazy. So that's something I struggle with now. I have to learn to cut my losers faster. I usually cut them too late. I usually cut them when the pain is too big and I'm just like, I can't deal with this anymore. If I cut my losers earlier, I would probably be a millionaire by now. It's just crazy, but it's in my brain to be so stubborn. And if I could just fix that problem I have, I would be such a better trader on so many different levels.
Have you made any effort, like any real conscious effort to try and change that? Like, is there anything you've tried?
Yeah, so I've tried using stop losses and they've been helping, but I always feel like when I get stopped out, it's always at the top, you know? So what I've been practicing is setting the stop loss on half my position and then seeing what happens next. If the stock goes even higher, then I'll stop out the rest of my position by myself. If the stock goes lower after my stop, I'll just re-add it back, half my position. So that way it's a little bit of a balance. You know, sometimes the stop will take over, sometimes I'll take over, depending on the situation.
Right. So when you get into a trade, do you have in your mind like a predetermined amount that you're willing to risk on that trade?
Not really. No, I never set a predetermined amount that I'm willing to lose. I usually just play it based on the chart, you know. So, for example, EGLE, when I lost, $40,000, I said, you know, worst case scenario, the stock is going to go against me and I'm going to probably lose like 10 or 20 grand. Like, it's not a big deal. Like, I thought to myself, you know, whatever. This is a winner. This is a sure thing. I know it's going to drop. So I said, you know, it's not going to be really much of a big deal. But then when DRYS started to reverse, I said, oh shit, maybe I'm fucked. Maybe I have to cover. Maybe I have to take my loss. So I didn't even look at the P&L. I just had to get out of the chart as quick as possible. And then I saw the damage and I was like, shit, this sucks. But luckily the stock, this EGLE is up like $3-4 more since I covered. So I guess I did the right thing for now.
Right. So I want to stay on this for a little longer. I don't want to skip over this. You know, I think it's very interesting that you approach things this way because it kind of goes against a lot of the, you know, conventional wisdom, if you want to call it that's floating around, is having either a stop loss or a predetermined price point or knowing what's going to cause you to get out of that trade. But you're not really like that.
Yeah, I think that's going to cause too much emotional trading. If you say like my number is, let's say, for example, my maximum loss is $10,000 in a trade. I mean, it is the smart thing to stop out at that certain point, but sometimes I guess it's my nature too that I like to risk a little bit more. So I'm a very risky person. I like taking risks like in any situation. So when I see the stock going against me, sometimes depending on the situation, instead of stopping, I'll just add a little bit more. And I'm not going to add to the point where I'm add till oblivion. I'm going to add where it makes sense. And if I'm wrong with that add, I'll take it off 10 cents higher, 20 cents higher. But at least I tried, you know?
So when does it make sense for you to add to a losing position?
It depends. Like, so for example, let's say this EGLE, it went from, I think the day I was short, I think it hit $8 and then started to sell back off and then ramped a little bit again to like $7.50. So what I do, let's say I had like a 720 average, 730 average, whatever it was, and it was at $8. So when I saw DRYS reversing at that point, EGLE started reversing. So I said, this might be it. It's time to add. So I added there. The stock went down a little bit more. But then when the whole thesis of DRYS changed, when it reversed itself, that's when I knew, okay, this thesis isn't going to sustain. I have to get out no matter what.
I don't know. I don't really know how to word this correctly, but a lot of what you're doing in managing your trades once they're on is just trying to really gauge the emotion of the market and really trying to work out, like, I guess where price is going, like everyone is, but like you're managing the trade extends a lot further than from the point where you get into the market and have a predetermined stop, really tracking and trying to have a really good read on where the market's going.
Yeah. So, I mean, if you say like, I'm gonna play EGLE, I'm gonna lose $5,000. As soon as I lose $5,000, I'm gonna be out. The moment you lose $5,000, you're gonna be fucked up in the head a little bit. You're gonna say, I lost, I suck, whatever. And that's going to cloud your judgment for when the reversal really does happen. So I'm okay with taking the loss if I have to at a certain point, but I'm not going to say I lost 40,000, I'm done for the day. I'm going to say, okay, I lost 40,000. I suck. I was an idiot. This was avoidable. But when the stock reverses, I'm going to be right back in there hitting it with size. It's not going to be just to make the money back. It's going to be because I was wrong in the short term, but I have to reattack. I have to hit the stock. I'm not going to sit in a corner and cry if I lose. That's what people are going to do, and they're never going to succeed. You have to overcome that loser, even if it's 5,000, 10,000, 20,000, whatever it is. You have to think past that and focus on being the best trader, being in the best trade that you could be.
Okay, so this has probably become a little bit easier for you to do now that your account's a lot larger, but in those earlier days when you were trading accounts that were really just a few grand, were you much the same? Like how has your trading changed from when you were trading, let's just say a $5,000 account to what you're trading now, like a few $100,000?
Yeah, so when I was trading with a smaller account, my idea was do not short any bit of size until the reversal is confirmed. I said I have too little money to risk that if I'm shorting before the reversal, I'm asking to get wiped out. But now with a bigger account, I guess I have the leeway to short a little bit early, to throw out some feelers into parabolics or throw out some feelers into bigger size charts and slowly add on the way down rather than let the stock collapse and then add. It's a little different, but it's been working for me.
In that same sort of period, was there any defining moments or turning points, things that changed for when your average P&L for the day went from perhaps maybe a few $100s to, a few $1,000s? Was there any big changes that you made to your trading that started to ramp up the pace that you were growing your account?
I increased size, but it was just consistent gains. What grew my $5,000 account and what grows my accounts now is very, very different. So what grew that $5,000 account was consistent gains every single day. No matter what, I would show up to the market. I could make $500. I could make $1,000. And then I'd cut my day off. I'd take a nap. I'd do whatever I had to do. And I was just growing my account every day, slowly but surely. Now, what I try to do is I try to find those perfect opportunities, those 90% opportunities, and trade those. So that doesn't mean trading every single day. That means maybe trading once a week or twice a week or maybe once every other week. I try not to trade every day. I try to trade only when my specific setup shows up. So for example, this week I've been trading every single day. I haven't left the computer because my setups are there. I keep telling everyone these shippers are crazy. They're going to be a once in a lifetime opportunity, both on the long side and the short side. So I can't afford to leave my computer for a second. These opportunities are so big that when the time comes, I have to hammer them lower. It's crazy to me, honestly.
Do you really think it is a once in a lifetime opportunity though? Or is that a little bit of FOMO?
Sure. I guess it's not a once in a lifetime opportunity, but it's been kind of slow in the small cap world, and seeing a stock go from 5 to 115 in less than a week is going to light up everything. Everything is going to be lit up for a few weeks. So after these shippers run, let's say some chat rooms are going to try to pump the next big thing. And when that happens, they're not going to have as much fuel as this one did. So the fade is going to be even bigger. So I'm trying to stick to the market, stay on my computers to try to anticipate those trades and short them on the way down.
Now, I just want to pick up on something you said there. You said another chat room might try to pump a certain stock. Is that really the way that it works? You know what I mean? Does a chat room actually have the power to be able to really drive a stock price higher like that or lower even?
It depends on the subscriber base. So let's say one chat room, whatever, let's say they have 1,000 members, right? And the main guy is buying 10,000 shares of an incredibly illiquid stock. This stock trades, let's say 500,000 shares a day, on a regular day. This guy's buying 10,000, 20,000 shares. If a quarter of his chat room buy 1,000 shares, that's already 250,000 shares, right? So it's just going to push the stock much higher. And then what happens when everyone starts to sell, or when everyone when there's no real demand for the stock, it's going to go back down. So I live for these chat rooms. I pray that they buy everything, because usually it goes right back down instantly.
I mean, we might have already covered this a little bit, but let's just go through it again and maybe a bit more in general terms, I think. So what are the qualities of your ideal trade or your ideal setup, scenario, whatever you want to call it?
Okay, so my ideal setup are these sympathy plays that are going on right now. So basically what I'm sure most people thought is when DRYS was halted, everyone said that these stocks are toast. They're collapsing. They're nothing. That's it. The head of the snake is gone. Short these to oblivion. And when DRYS halted, these stocks went down almost instantly. But to everyone's surprise, they held a bid. They started trapping shorts again. They went even higher and higher and higher. And they're still continuing to squeeze people. So now, since DRYS is halted, there are other shipper stocks that are still going up that are, quote unquote, the new index for shipper stocks. For example, SINO is the most powerful. It's at nearly $8 or $9, whatever it is right now. So tomorrow morning, depending on how SINO moves, it's going to fuel these other stocks higher. So tomorrow, what my plan is going to be is when SINO starts to reverse, I hit a different sympathy hard. I short it as hard as I can and hope that it's time for these to reverse. And if I'm wrong, if SINO starts to reverse, I'm just going to take my loss. I can't fight these shippers. They're too strong. But basically, my strategy is find the main stock that's running and short their sympathies when the main one starts to reverse. That's what I try to do. That's usually my best, most profitable setup.
Okay, and when you say you're going to try and hit these hard, what does that mean?
I'm going to short as much as I can. So let's say it's going to be 10,000, 20,000, 40, 50,000 shares. I'm going to try to short it and hold it for a few days, because we all know that after the hype is done, they're going to go back to normal. They're going to go back to where they came from. Stocks that went from 2 to 10 are going to go back to 5 by the end of the week, and then they're going to go back down to 2 by the end of the month. So what I'm going to try to do is when the main stock starts to reverse, when the new head of the snake is cut off, I'm going to short sympathy plays and hold for as long as possible for as much downside as possible. Because we all know these stocks really, they have to raise money. They're toxic companies. There's no real reason to be up rather than a sympathy play. So as soon as all these longs get stuck, it's going to reverse.
So I might have misheard you there, but did you say you might hold these for a few days, or you'll hold them for definitely overnight?
Yes. So right now, the shippers have not reversed. So I'm not holding anything overnight yet. But when they do reverse, I plan on holding maybe 2 or 3 days, because usually the bleeding doesn't stop in one day. They continue to bleed for a couple more days. So that's also something that I'm trying to work on. I'm usually quick to cover. I'm usually quick to take my money and run. But I've realized that for more successful traders, that if you wait a few days, if you stick around for that quote unquote hard money that you just have to wait and be patient for, the payoff really is worth it. The money is really there for your taking. Because after a day or two, traders are just looking to the next stock that's moving. They forget about this stock and it just starts to sell off when no one's looking.
Now, from the way you've been talking, it sounds as though you hold pretty large positions. How do you adjust your position size when you're holding a trade overnight? Is that something you do?
It really does depend on the situation. So when a stock is below the VWAP level, that is my tell that usually it's very weak on the day, selling off under VWAP, closing near lows. I think to myself, what reason do I have to cover? Like, it's probably going to go lower the next day, but maybe I'll take off like a third of my position or half of my position, just so that in that case where it goes a little bit higher, I've locked in some money, and worst case scenario, I'll just reshort it tomorrow a little bit lower.
Now, throughout this episode, we've been talking a lot about the shipping container stocks, but just more broadly speaking, how do you identify these sectors and industries that are starting to gain momentum?
Well, usually there's a lot of people on Twitter talking about it, or chat rooms are talking about it. But when they start to stick, when something like this sticks, before it was let's say Ebola or forklifts or whatever it was, when they start to have these sympathy plays in the similar sectors that every single person is talking about, every single person on Twitter, every single person in a chat room, they're only trading these stocks, that's when you know that there's something going on here. This is when DRYS goes from 5 to 105 or 100, whatever it was. It's going to get people talking. It's going to get people, everyone's going to be curious. Everyone's going to have it on their screen. Everyone's going to be watching every tick of it. It's just, the more eyes that are on it, the crazier everything could get.
And what would you say is your ratio of trades on the long side compared to the short side?
It's pretty pathetic, but it's usually 99% short and 1% long. And the only time I long is usually when I lose in a short. Let's say, for example, it was I think it was CANF, like a while back, a few months back, whatever it was. I ended up losing $20,000 on the short. And I said, okay, the short isn't working. The stock looks like it's going to go higher. So let me buy it. Let me reverse my bias. Let me reverse my position and just buy the stock. I ended up buying the stock with a bunch of size. I ended up selling for, I think it was a $50,000 win. So it ended up being a $30,000 win on the day after the $20,000 loss. So usually when I long, it's because my short position didn't work out. I see the chart is going to reverse, so I reverse my bias.
Okay. Now, these are not small numbers that we're talking about. Like, you're 22 years old. You make me feel old. No. What do your friends and family think of your trading efforts and the amount of success that you've seen so far?
Basically, my friends really have no idea how much money I'm making. They just know that I trade stocks and that I'm doing well for myself. They have no clue about the numbers. If I tell them, they just won't understand. It'll blow their minds. Like, they'll say I'm crazy, I'm an idiot. Like, what am I doing? You're risking too much. And I say, I'm 22. This is the time to risk. I really have nothing to lose. I have no bills. I have no mortgage. I live with my dad. Like, I think that's one of my benefits too. I don't really have to think about bills. I don't have to think about where I'm going to put my money. Like, what am I going to do? If I have a good month or a good week, I'll wire out some money and keep it in my bank account, save for like a rainy day. And that's about it. I don't really spend that much money out. I really don't have much of a reason to spend except going out on the weekends with my friends.
So why do you not share this sort of thing with your friends?
I don't think they'll understand it. I don't know. I feel like maybe it might be a little bit of showing off, and I just don't think they'll really get it. They know that I trade stocks. They know that I short stocks, but I don't really get into like numbers too much unless I'm talking to someone from the trading community. Then I'm like an open book. I tell them everything. No matter what, send me a question about my numbers and I'll tell you, because they'll understand. They'll know what I'm going through. My friends really, they don't know the stock market, so they won't understand much of anything.
Sure. And what do most of your friends do?
One of my friends does real estate and jewelry. The other friend owns a hardware store. Another one is doing pre-med. He's going to be like a surgeon. The other one's going to be a physical therapist. So I guess they're eventually all going to be doing well for themselves. So.
No, that's really cool, man. Outside of trading, I want to talk to you about this. I think it was earlier this year in 2016, or maybe it was 2015. Anyway, doesn't really matter too much. You renovated a house and flipped it. So tell us a little bit about that. Like, why did you decide to do this?
Yeah, so I think it was 2015, the Las Vegas Conference Traders for a Cause. I met a guy, Louis, Monaco trader on Twitter, and he made most of his fortune from not trading, but from real estate. So he trades just because he loves it, but most of his money is from real estate or venture capital or whatever else he does. So we met up at Vegas. We talked a little bit by the pool, and he said, what are you doing? Like, what is your long-term plan? And I said, I have some money in the bank. It's just really chilling there. It's not really doing much. And he's like, have you ever thought of real estate? And I'm like, like in the back of my head, I thought about it, but it sounds like a lot of work. Maybe it's not for me. And he just gave me some pointers, some tips. He mentioned his story about how he started in real estate. And I guess there was like he planted a seed in my head. He said, you could do it. You're not a dumb kid. You're pretty smart. a lot of people could do it. It's not a problem. So I think the conference was in, let's say, October or November. The market started slowing down November to December in 2015. So I said, screw it. Why not get into real estate? What do I have to lose? I'm going to learn a lot. It's going to be a cool experience. The market's slow. So I guess I started doing research about what is like a potential good property to buy and flip and whatever. So I ended up coming up upon like foreclosure properties, and I started looking at a bunch of them, and I eventually found one that I enjoyed like that. I said, this one has potential. I see the vision in this house. So long story short, I ended up buying the house, and I guess that was the easiest part of it, buying the house. And then I had to think, like, how the hell am I going to do this? I have to hire a guy to do it. I have to hire a contractor, a plumber, an electrician, some guy to do the masonry at the front of the house, a roofing guy. And it was really overwhelming because it's like trading for the first time. You really have no clue what you're doing. You could press a couple buttons, maybe you'll be lucky, but really, like, you have no clue. So I said, what the hell am I going to do? So I started interviewing. It's funny because I started parking my car outside a Home Depot at like 7 a.m. and calling contractors from their vans, like from the numbers I saw in their vans, and just saying, hey, I have a house in this area. Do you mind if you could come in and maybe give me an estimate on what the work would cost? So I called, I think it was like 30 people, and they all came in. They gave me like varying quotes from like $20,000 to like $70,000 to like fix the house. And you can't ever choose like the cheapest guy because you don't know what kind of work he'll do. You can't choose the most expensive guy because it's not going to fit your budget. So I was a little bit frustrated. So I went out to drink with my friends, and I guess I got a little drunk and started telling him my problems. And one of my friends, he actually owns a hardware store. So he deals with contractors every single day. They come in to buy paint. They come in to buy like anything. So I said, if you find me a good contractor, I'll buy all my materials from your hardware store. And he's like, done, deal. So literally he found me a guy. He was one of the cheaper guys. My friend vouched for him, and I said, all right, let's do this guy. Let's use this guy. And long story short, he had a couple friends that were electricians and plumbers and whatnot. So I guess it all worked out. But yeah, so the work started, and he would just call me and he'd say, I need this, this, and this. And I'm like, all right. And I would go to the Home Depot or whatever it was and just find the materials. Like, I had to choose the hardwood floors, the paint, the kitchen materials, everything. And this is all like my first time doing anything. So I had to I basically winged everything. I didn't know what the hell I was doing. I went to Home Depot. I went to all these like tile specialty stores, like a kitchen store, whatever it was. And I started picking things out that, I would like in a house. So I picked dark wood floors. I picked the paint color. I picked the kitchen with granite countertops. And I guess before I knew it, everything started to come together. I mean, there were a bunch of problems like in between, like contractor nickel and diming for like stupid things or like stupid problems coming up. But as annoying as they weren't that hard to overcome. It just took some common sense and like some negotiation to fix all these problems. And the whole process from buying the house to selling the house was about, I think, 4 months. And then there was like another 2 or 3 months of like attorney review, making sure the buyers could get a mortgage and all this stuff. And it was really an interesting experience. I learned a lot. I learned about how crooked these contractors could be. I learned how important like my friendships could be with my friends. We help each other. And overall, like the whole experience was cool. But in the back of my head, I was still always thinking like, I miss trading. Like when I was doing this house project, I wasn't trading that much. I was trading once a month, and like just so I could get like my addiction settled. Like there really wasn't much plays or whatever it was. And I was just thinking like, this real estate thing is cool, but trading really is where my heart is. Like it's still what I'm thinking about. Like, so when the house got sold, I started trading again. I had more time to trade again. And I guess the timing was right. Everything was right. And all these stupid stocks, like these sympathy stocks or these low flow plays were back again. And no hesitation, I was back in my element. There was no, it was like riding a bike. I knew exactly what I was doing. And it turned out to be one of my most profitable months of the entire year. I did really well the first month I came back. And since then, it's just trading's been on my mind 24/7.
Right. So do you have any plans of doing, another venture into real estate?
So like I said, my contractor was nickel and diming me for everything. And it was just so frustrating and annoying. Like by the end of it, I was just so sick of him. So, I mean, I think a lot of this whole real estate thing depends on your team. It depends on who you're working with. Are they people you could trust? Are they honest people? Are they people that aren't there to screw you? And my guy, as much as my friend vouched for him, he was there to screw me a little bit, He's there to make his money, whatever it was. And from that guy, just that one guy, discouraged me from doing this whole thing again. But if I found the right team, honestly, I'd be happy to do it over again. It was a really cool experience. I loved the feeling of turning a garbage house. There were holes in there, and smelled like shit. It was terrible in there. And I'm glad, I turned it into something that someone could live in. They're gonna start a family in there, and it's just all from a stupid garbage property that if they saw before, they would never think about buying it.
Yeah. So if you did do it again, or when you do it again, obviously the team is a big one. You'd make sure you had a better team or a team that you click with. Is there anything else you would have done differently? How did you go budget-wise? I know it's very easy to go over budget when you're renovating a house or, and picking the wrong house. It's very easy to lose money in real estate, just as easy as it is in trading, I think, to a certain level. Is there anything else you would have done differently?
So the area that I bought the house in obviously wasn't the best area possible because it was very, very cheap. So the way I did the house is basically everything I loved, everything I thought would look cool. But all those things take a lot of money. They cost a lot of money. So what I should have done differently is not think about what I want. I had to think about what buyers in the area want. And that would have saved me a lot more money. Instead of using granite countertops or decent appliances, I could go with the cheapest appliances and the cheapest countertops, and the house would still sell, So I guess I was doing it for the first time. I didn't really know what I was doing, but now that I know a little bit better, I know what it takes to flip a house profitably. It depends on the area. It depends on the kitchens, the bathrooms, or whatever. And I just learned that I was cheaping out on the bathrooms a little bit. And I know now that if I wasn't cheaping out on the bathrooms, the house would sell a little bit better. I was garbage. The bathrooms I thought were garbage, but I don't know. I mean, I made some money on the house. For my first project, I made some money. I'm happy about that. I was ready to break even or even lose a little bit of money just so I could get that knowledge, but I'm glad everything really worked out.
Yeah. Oh, that's good, man. That's good. And I think you went into it with the right attitude as well. I mean, learn before you earn in some ways. So, no, good on you, man. That's awesome. Anyway, Alex, let's leave it at that. Is there anything else you want to add? Anything you want to share with listeners before we call this a wrap?
I guess the most important thing is that when you're trying to grow a small account, always focus on consistency. Find a setup that you're really, really good at, a setup that you'll win at, and trade that. You have no reason to trade something like Facebook if it's moving on earnings just so you get a rush or whatever. Find something that you're good at. Find consistent profits, and your account will grow really fast. I couldn't believe how fast my account grew when I was being consistent, trading every day, trading setups that were there for me. It's just the little things add up. It might take time, but trust me, it adds up faster than you'll imagine.
So where's the best place that listeners can go to find out more about you?
I guess my Twitter or my blog, they're both on my Twitter. I guess my Twitter is ATO9_trader, and my blog is ATO9trader.blogspot.com. So, I mean, I have some story about my real estate thing there. And I post on Twitter pretty regularly about some trades I'm in or some thoughts. So that's about it.
Excellent, man. And can you just repeat your Twitter handle one more time in case someone missed that?
It's AT09_trader.
Okay, good stuff. Alex, thank you very much for coming on the podcast, man. It's been a blast to speak with you. Thanks very much, man.
Definitely, man. Thanks for the opportunity.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
In every business, there's a moment when things click. That moment starts and handled with care.
Chat with Traders is brought to you by Pool 100,000.
Expecting to own the dream.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey team, what's going on? I really hope you had an incredible Christmas day, ate yourself silly, and had plenty of laughs. For this episode, being 105, I asked Brendan Poots onto the podcast. Brendan is the founder of a sports betting hedge fund, the Prihoma Group. The main sports which Prihoma bet on include football, as in soccer, cricket, golf, and also horse racing and tennis. Prihoma set up shop in Melbourne, Australia in 2010 and more recently have expanded with a second location in Gibraltar, which is in Europe. Since inception, at the time of recording this, December 2016, Prihoma's Cloney Fund has returned a little over 220%. The fund has had no losing years. Worst losing month was minus 6.4%. Best month was plus 11.8%. And the fund makes positive returns 77.8% of months. From listening to our chat, you'll get great insight to how Brendan runs his operation, from getting investors to buy in, to controlling risk and minimizing the volatility of returns, and how the fund makes money trading sports games. Naturally, there are many crossovers to financial markets, which you'll pick up on. I had a great time speaking with Brendan, and I hope you'll enjoy listening. Now, just a small announcement before we get to the meat of this episode. So I've recently struck up a bit of a deal with Edgewonk for Chat with Traders listeners. Now, I'm sure many are already aware of Edgewonk, but if not, the simplest way of putting it is Edgewonk is a journaling tool built specifically for traders. And I know I don't need to emphasize just how important journaling is, as it's something we discuss frequently on this podcast. But the cool thing with Edgewonk is it takes your journaling entries and trades and shows you metrics for how you're performing and areas that you can improve on. Ultimately, Edgewonk helps you to discover your edge. It's got a lot of awesome features. Visit edgewonk.com, that's E-D-G-E, Edgewonk, W-O-N-K, edgewonk.com, and enter traders during checkout to score $20 off any package. For full transparency, I do receive a small kickback for anyone who purchases using the coupon code TRADERS, but the price is not inflated in order for me to be compensated. Like I mentioned, it'll actually save you $20. And I'm done. I'm Aaron Fifield, your host. Please welcome my guest, Brendan Poots. Sounds like you've had a pretty hectic week.
Yeah, well, this is one of the big things we trade on is the English Premier League and the European football.
Okay.
And this week they've got 3 full rounds. So they had a full round on Saturday, Sunday. They had a full round on Wednesday, Thursday, and they've got a full round this Saturday, Sunday. So there's been 30 matches we've had to go through and do our work with. So it's been quite hectic. And then when you throw in the cricket, which is going on at the moment, that's our other big sport. Yeah, it's been a big week.
Okay. And Christmas is coming up. So what are you doing? Are you shutting down over Christmas?
No, that's historically our busiest time, because you can imagine the same happens with the football, for instance. You'll have games on Christmas Eve, Then you'll have another round on just Boxing Day and the next day, and then you've got another round on New Year's Day. So you've got another 3 sets of games in the space of 10 days. And then you've got, whenever there's these public holidays, like Easter and Christmas, that happens to be when there's a lot of sport. So subsequently, I tend to take my family's in Perth, mum and dad and brother, so I'll probably head back there early in the new year when there's a little bit of a lull.
Yeah, and when you get these big games happening around public holidays, does that bring more opportunity to make more money during those times, or not so much?
Yes, no, absolutely. There's so much more money that's being traded that obviously one of the keys to our success so far has been making sure that our trade size per match is proportionate to the total volume that will be traded on the match. So you don't want to be putting a really big bet on a match where there's not a lot of liquidity, because effectively you're betting against yourself. Whereas when you have these really big matches, there's so much liquidity that it doesn't matter because basically if we have a big trade and it goes wrong, we need to be able to get out. So you want to be trading an amount which the market will tolerate and will let you get out if things go wrong. Which is why we don't do it. To give you an example, an English Premier League match, a typical English Premier League match will have somewhere between 10 and 20 million dollars traded on the platforms that we use. Those same platforms in an AFL match will have 300,000. So if you have a $20,000 bet in an AFL match, you're effectively almost 10% of the pool, and then you can't get out. So the bigger match, yeah. So we tend to focus on the most liquid sports because A, we think we've got an edge there, and B, it allows us to stake accordingly.
Okay. So this might be a bit of a strange question. I mean, me personally, I've never put a bet on a sports game in my life. So forgive me if this is kind of a weird question to ask, but how does it work? Because I always was sort of under the impression that the bookmaker says, we've got this game, these are the payout odds for if this team wins or whatever the situation is, that's how much you make, otherwise you lose your bet. But you're like talking about this as though it's kind of like an active marketplace where, there's liquidity issues and that sort of thing. Like, how does that work? Are you betting on a different sort of, I don't know if exchange is the right word, but a different kind of platform than what retail people are playing on?
Yeah, well, there are a few different global exchanges. So they work in global sports betting exchanges, and they work exactly the same as your typical stock market exchange, which is buyers and sellers meet, and they facilitate that meeting. But the big difference, and this is what has allowed our business to grow and develop, is the advent of in-play sports betting. So whereas previously, and we're talking probably 15 to 20 years ago, sports betting used to be a binary outcome, and you're exactly right in the way you described it. You used to put a bet on, and then you'd have to wait till the end of the match for the result, and you'd either win or you lose. But with the advent of in-play betting, what happens now is that as soon as the match starts, you can still bet. And as a result of that, say, for instance, you've got a bet on a team that's, let's say it's $2 each of two teams. You'd never get that with the bookmakers because they have their commission in there. But say you've bet on a team at $2 and it's a binary outcome, so it's a win-lose match, so the draw's not in there like it is in football. So say it's a rugby league or an AFL match, and your side goes to 20 points in front, say. So then the odds will have changed. So the side that's now 20 points in front, their $2 will now be $1.40, and the side that's now 20 points behind will have gone from $2 to $3 $3.40 or something like that. So the market started at $2. Now the market's at $1.40, $3.40 or something like that. So what you can do, you can now bet on the other side at $3.40 a certain amount of your money to cover up. So then you've got, no matter who wins the match, you'll make a profit. Does that make sense?
It does, yeah. So just backtracking a little bit, do you still have the option to play or to bet on a in-play game and as well as bet for like a binary outcome?
Yes, you do. And what we do, we'll have an opening position, which will be pre-match. So typically what will happen is matches on the weekend, for instance, the soccer in England, those markets will have already come up. So the market's there now and you can have a bet. And what tends to happen is the early markets are somewhat inefficient. But as you get towards kickoff, that's when all the money comes in and the markets sort of even themselves out a little bit. So if we look at a game today and we think that the market's wrong, we'll take a position today. But then once that match starts on the Saturday night, 48 hours time, we will monitor that position and we will trade that position depending on how the match goes. So if our side that we think we've taken the initial position on goes way in front, we will then back the other side to close out a profit and hedge our position. If it's the other way round, we will then hedge out so we mitigate our loss. So it's no longer you win or you lose outcome. It's now you can win or you can win or you don't lose as much. So for instance, a bad trade for us now would typically be a 20 or a 30% loss of our initial investment, whereas previously it would have been 100%. So in that instance, what's happened? We've made a bet on a side. They've gone behind. They've gone further behind. Okay, what do? We need to start hedging our position by either backing the opposition or betting into other markets so we mitigate our loss.
Well, we're going to get into this much deeper, but before we go too much further, do you want to fill us in on your background prior to founding the Prohoma Group?
Okay, well, I'm Irish by background. Okay, so one of the golden rules of being an Irishman is that you love to have a bet. So I was brought up in an environment where having a bet was the typical Saturday morning was spent with my dad and my brothers over the kitchen table looking at the form guide. So I'd been exposed to the joys of punting from a very young age. Now, through school and university, I used to have a bet and what have you. And then at the end of my university degree, which was a degree in chemical engineering, I chose to pursue a professional sporting career. I was a cricketer, and so I went over to England to play county cricket for Sussex. Now, my benefactor, the guy that sponsored me, who got me the club side and provided me with the house and the car and all the things that go with it, he was a bookmaker, and he had two shops in Surrey, in the south of London there. And I was playing cricket by day, and then with the long nights, I would go work in one of his shops and be a bookmaker at night. So that was my first entree, I guess, into the professional side of sports betting, for want of a better term. Well, horse race betting and sports betting, because back then sports betting wasn't so big in Australia, but it was certainly big in England. So fast forward 4 years, when I'd realised I was not going to cut the mustard as a cricketer, I then went and worked in investment banking, finance, venture capital type industries, where I was analysing, I was looking for value, trying to find a share. If we valued a share at $2, but it was trading in the market at $1, then that's a buy. And I thought, okay, that makes sense. That's interesting. But one of the things that was the downside of that is it's very slow moving. You don't tend to buy a share at $1 and then an hour later it's $3. It might be 6 months later or a year later. So then in 2006, I was very fortunate to earn a scholarship to complete my MBA studies at Columbia University in New York. And that was 2007 was when I went. And then obviously in 2008, there was the financial crisis. So your typical Columbia MBA graduate would pursue a career in consulting or with one of the major banks, being a trader or investment banker, one of those areas. But all those jobs had dried up. And having already worked in those industries, I didn't want to go in as a 32-year-old, 33-year-old lackey. So what I decided to do was I thought, where would I want my money during the financial crisis? I thought, well, I want to have my own personal money somewhere which is liquid, somewhere which is non-correlated, and somewhere where I really knew what was going on. Obviously, the global financial crisis was catalyzed by ratings agencies, manufacturing ratings of the mortgage-backed securities and a lot of other nefarious type activities. So I said, well, I know sport. Betfair, I understand that it's growing. There's a Betfair global exchange. So how about I apply those principles that I've been educated and then previously I professionally used in the realm of sports betting or trading or investing, depending on how you want to term it. So in 2008, 2009, I started with my own money and I started building my own very antiquated algorithms and fairly much focused on a little bit of horse racing, but predominantly cricket and football or soccer. And then in 2010, I decided, well, I've done this now for a couple of years. I've got decent returns. I started speaking to some friends about it, and they said, yeah, we'd give you some money. In 2010, Prioma Capital was formed as a sports hedge fund, and that's the origin of where we started, how we started, and since then, your typical client for us now has gone from being a friend who would give me $10,000 or $20,000 to now people who we have never met giving us a couple of $100,000, $300,000, $400,000, $500,000 to manage. So that is the origin of how we started and where we've got to today.
Okay, so you started the fund in 2010, yeah?
Officially, yes. That's when it was registered as a business. I was trading my own money and figuring out the strategies in 2008, 2009, but I started taking external investors' money in 2010.
Okay. And, you mentioned earlier that you'd been kind of placing bets all throughout your, even your childhood and then throughout your schooling days and that sort of thing. During that time, were you just having a punt or were you actually being somewhat strategic about your betting?
Okay, it started as a punt, but then it morphed very quickly into a strategic way of betting or trading. And effectively, I was from the periods of about the age of 26 when I finished my cricketing career or basically gave up the dream of playing professionally. For the next 4 years, my goal was to pay my rent every month with winnings from betting on sport. So that's when it became quite strategic.
Okay. And were you able to achieve that goal?
I was, yes. And that was, that was what sort of lit the fire underneath me for when, because after that was when I went over to university in America and I pretty much paid for my university degree. The scholarship paid for the tuition and the accommodation, but certainly the running costs of living in New York had to be paid somehow. And I pretty much paid them via gambling or betting or investing on sport, depending on how you look at it. Yeah, so that was what gave me the confidence to say, okay, this can be done if you approach it in a methodical manner. One of the tricks, and certainly when I interview people for any positions within our firm, one of the disciplines that is definitely required is with sport, there's always another race, there's always another match. It's coming at you thick and fast. So you need to really be able to outline a strategy and then cherry pick your matches or your races to play in, because you can quite easily get yourself dug into a hole because there is just so much coming at you.
Yeah, so starting the fund, were there any regulation issues, any hoops that you had to jump through to do this? Because, I think sports betting hedge funds are pretty few and far between. Did you have to do any, was there any additional challenges than what there is to normally managing money?
Well, yes, there is. And that takes us to where we are now in terms of our offshore office in Gibraltar. But certainly starting off, the Australian fund operates as a small-scale private fund, which is limited to the number of investors, and that is one of the ASIC rules. So you're limited to the number of investors, retail, I guess, who invest less than $500,000. So that limits you. So as long as you stay below that threshold, you can operate as a private small fund, which is what we've been doing. But clearly, that's how we started, and it was obviously the lowest risk, lowest cost way. But given the success that we've had, we've just now registered a Gibraltar fund.